cost sheet. Right. Sir, what is the meaning of costing? Cost ascertaining program is called as costing. Cost ascertaining program is called as costing. Right. What are the steps involved in cost ascertaining program? Collecting, classifying, recording, allocating and analyzing the total cost. So, next step, prepare a periodical statement. Nowadays, it is called as cost sheet for ascertainment of cost. For ascertainment of cost. Right. So, collecting the cost information. Here, total program divided two main aspects, sir. So, this is the production department. This is the production department. This is the selling and distribution department. In production department, conversion of raw material into finished good. In selling and distribution department, marketing activity, product marketing activity. So, here manufacturing activity or production activity, here marketing activity. One more department, this is service department, calling as admin department. Admin department providing services to production department and providing services to selling and distribution department. Okay. So, finally, all these expenses are added in a particular order. Then we get total cost. Add margin or profit, then we get selling price. Right. Now, what are the transactions took place in production department? First one, raw material issued to production. Raw material issued to production. So, this type of material cost is calling as direct material cost. So, direct material cost. Next, wages charged to production. This is calling as direct wage cost. Next, except these two, any expenses incurred relating to the production is calling as direct expenses. So, up to this part, these three elements collectively known as prime cost. Prime cost. Next, raw material issued to factory. Production department is nothing but factory. Factory maintenance. So, raw material issued to factory cleaning. 3 Lysol bottles are issued for factory cleaning. These material items are calling as indirect material cost. Raw material issued. Raw material issued for factory maintenance. For factory maintenance. That is calling as indirect material cost. Stores and spares are used for factory, that is also calling as indirect material. So these are the examples for indirect material cost relating to factory. Next, indirect wage cost. Indirect wage cost. Payments made to indirect labor who are not involved in production activity. Just like example, supervisor salary. So indirect wage cost. Indirect wage cost. So indirect wage cost incurred. So payments made to indirect workers relating to factory is nothing but indirect wage cost. Next, indirect expenses. Indirect expenses relating to the factory. Factory rental charges. Expenses on assets relating to factory, that is depreciation on machinery. Depreciation on machinery. Factory telephone charges. Factory telephone charges. So these are the examples for factory indirect expenses. So factory indirect material, factory indirect wages, factory indirect expenses collectively known as factory overheads. Factory overheads or production overheads or manufacturing overheads. Prime cost plus factory overheads equal to factory cost. Factory cost. Then good ready. Then these units are sent to laboratory for testing its quality. Definitely company maintain a laboratory. So expenses incurred for laboratory is calling as quality control cost. Quality control cost or product inspection cost. So factory cost, add quality control cost. Quality control cost. Next, last edition, present edition, some amendments, some improvements are made in the product. That duty done by the research and development department. So research and development cost also charged to factory cost, research and development cost. Next, admin department providing services to production department, that is calling as administrative overheads related to production. Administrative overheads related to production. Admin overheads related to production. Related to production. So then we get COP, cost of production. Cost of production. Sometimes some products required protective packing, that is calling as primary packing. In that case, primary packing cost also charged to factory cost. Add primary packing cost. Add primary packing cost. Then we get COP. Then we get COP. Then we get COP. So these are the transactions included in COP. Raw material issued to production, direct material cost. Wages charged to production, direct wage cost. Except these two, any expenses incurred related to production, direct expenses. These three collectively known as prime cost. Next, raw material issued to for factory repairs and maintenance, indirect material cost. Next, payments made to indirect workers related to factory, that is supervised salary, that is indirect wage cost. Next, indirect expenses. Except these two, any expenses related to factory. So that means factory rental charges, factory telephone charges, depreciation on factory machinery. So these are the examples for indirect expenses. So factory indirect material, factory indirect wages, factory indirect expenses, collectively known as factory overheads. So prime cost plus factory overheads equal to factory cost. After completion of the good, then goods are sent to laboratory for testing its quality. Here definitely company maintains a laboratory. So that is cost incurred for laboratory is nothing but quality control cost or product inspection cost. Next, here some improvements are made in the product, that duty done by the research and development department. So expenses incurred for research and development team, that is research and development cost, that is also added to factory cost. Next, admin department providing services to factory, that is admin expenses related to production. Next, some products requires protective packing. So here protective packing is calling as primary packing, that is also a part of cost of production. So that should be charged to factory cost. So finally we get COP. Here adjust the inventory levels relating to finished goods. Opening should be added, closing should be deducted. So opening should be added, closing should be deducted. Add cost of opening inventory of finished goods. Opening inventory of finished goods less cost of closing inventory of finished goods. We get COGS. COGS. Okay. Now charge the selling and distribution expenses. Selling and distribution expenses also calling as marketing expenses. Next, admin expenses related to sales, that is the general admin expenses. So plus marketing expenses means selling and distribution expenses plus admin expenses related to sales, that is the general admin expenses. Then we get the cost of sales. Cost of sales, that is also called as total cost. Add required rate of profit, then we get to sales. So this is the pro forma of cost statement. Here scrap one important element, sir. Scrap arrays in case of material section, in case of production section. Scrap arrays in case of raw material, in case of production. So in case of raw material, scrap arrays treatment, it should be deducted from raw material purchase cost. So in case of production, it should be deducted from factory cost. So this is the main important point, sir. Scrap arrays in case of raw material, scrap arrays in case of production activity. In case of production activity, simply deducted from factory cost. In case of raw material, simply deducted from raw material purchase cost. Next, sir, inventory of finished goods, inventory levels of finished goods. Treatment, it is adjusted to COP. Opening should be added, closing should be deducted, then we get COGS. Next, inventory levels of work in progress, sir. Inventory levels of work in progress adjusted to gross factory cost. So prime cost plus factory overheads equal to gross factory cost. Then adjust the inventory levels of work in progress. We get the net factory cost. Net factory cost simply calling as factory cost. Suppose if there is no inventory levels relating to work in progress, in that case gross factory cost becomes factory cost. Next, inventory levels of raw material. Inventory levels of raw materials adjusted to raw material purchase cost. Opening should be added, closing should be deducted. So therefore raw material purchase cost, add inventory levels relating to raw materials, then we get cost of raw material consumed. Cost of raw material consumed. Okay, right. So this is the format of cost sheet. Right. While preparing the cost sheet, following items to be ignored. While preparing the cost sheet, following items to be ignored. Number 1, pure financial items. Pure financial items. Pure financial items. Pure financial items. Next, non-cost related items. Non-cost related items. These two items are appearing only in the financial books, not in cost books. These two items are appearing only in financial books, not in cost books. So, pure financial items. Examples. A. Any expenditure incurred in connection with the collection of debtors, like bad debts, reserve for bad debts. Next, cash discount allowed to customers. Next, B. Any expenditure incurred in connection with raising the capital. At the time of fundraising, following expenses incurred: preliminary expenses, underwriting commission, expense on issue of shares or debentures, discount on debentures. So these are the examples. Next, any expenditure incurred in connection with serving the capital. Serving the capital means, so at the time of fundraising, some promises are given by the company. So for debenture holders, promise is interest on debentures, interest on capital, interest on loans. Next, dividend on shares. So these are the examples of pure financial items. So while preparing the cost sheet, these items completely ignored. Next, non-cost related items. Expenses having no direct or indirect relationship with the production activity. So that is donations, capital expenditure, next, capital losses. Example, sir: loss on sale of fixed assets, loss on sale of investments. Capital expenditure, sir: purchase of fixed assets, suppose purchase of plant for factory use, purchase of computer for office use, purchase of salesman for selling and distribution department. So these are the examples for capital expenditure. So capital expenditure appearing only in the financial books, not in cost books. Next, direct taxes like income tax and wealth tax. Next, profit and loss appropriation items. Interim dividend paid, proposed dividend. These are the examples of appropriation items. Appropriation account debit items. Next, amount transfer to any reserves. Next, write off intangible fixed assets. That means write off goodwill, write off patents, write off trademarks, write off copyrights. So write off intangible fixed assets. So these are the examples of non-cost related items. So expenses having no direct or indirect relation with production. So these items completely ignored while preparing the cost sheet. Next, non-operating incomes. Incomes having no direct or indirect relation with production. So examples: interest on debentures from other company interest received on other company debentures, interest received from other company debentures, dividend received from other company shares, rent received from other assets. So these are the examples for non-operating incomes. Share transfer fees, interest received, bank fixed deposits. So these are the non-operating incomes. These incomes having no direct relation or indirect relation with the production. So these items are appearing only in financial books, not in cost books, right? So this is the introduction for cost sheet. Okay, right. Now take one problem. Assignment 1, sir. Assignment 1. Raw material opening 2,28,000. That is the cost of opening inventory of raw material 2,28,000. Cost of closing inventory of raw material 3,05,000. These two elements were adjusted to raw material purchase cost, sir. Opening should be added, closing should be deducted. Next, freight inwards, that is the carriage and purchase of raw material, it should be added to raw material purchase cost, sir. Next, direct wages paid. So it is a part of prime cost, sir. Direct wages outstanding at the end of the period. So outstanding should be added to corresponding expenses, sir. Next, factory overheads. Here factory overheads are estimated on 20% of prime cost. So prime cost into 20%, then we get absorbed factory overheads, then we get the gross factory cost. Adjust the inventory levels of work in progress. Opening inventory of work in progress, closing inventory of work in progress. Opening should be added, closing should be deducted, then we get the net factory cost. Net factory cost simply called as factory cost. Next, administrative overheads related to production, sir. So that should be added to factory cost. Ultimately, we get cost of production. Next, distribution expenses means selling and distribution expenses charged to COGS, sir. Next, finished stock opening 1,217 units. Sale of scrap of raw material. It should be deducted from raw material purchase cost. Next, the firm produced 14,000 units of output during the year. So, production in quantity plus opening stock in quantity, that is total availability in quantity. Here production quantity 14,000 units plus opening stock in quantity 1,217 units. Total availability 14,000 plus 1,217 is equal to 15,217 units minus closing stock. Here closing stock not mentioned in the problem, but sales value directly given in the problem. Sales 14,153, sir. So total availability minus sales. So then closing stock equal to 1064. If there is no information about the inventory valuation, please follow the FIFO method, sir. So that is the main important point. Here selling price per unit equal to 618. So question is asking prepare cost sheet of the firm. Right. See the solution, sir. So this is the solution, sir. So units produced 14,000 units. Units sold 14,153. So raw material purchase cost, add freight inward, adjust the inventory levels. Next, sale of scrap of raw material should be deducted from raw material purchase cost. Then we get direct material consumed. Next, direct wage cost including outstanding prime cost. Next, factory overheads estimated 20% of prime cost. Then we get the gross factory cost. Adjust the inventory levels of work in progress. We get the factory cost. Next, factory cost means net factory cost. Admin overheads related to production, sir. Admin overheads related to production. Then we get cost of production. Here inventory levels adjusted, sir. Value of opening stock of finished goods, closing stock of finished goods. So finally, cost of goods sold. Add selling and distribution expenses. Here selling and distribution expenses, important point, sir. Distribution expenses, 16 rupees per unit. Sir, general admin expenses, selling and distribution expenses. These two cost elements varies with sales volume. Remaining all cost elements varies with production volume, sir. Note this point. General admin expenses, selling and distribution expenses varies with sales volume. So here sales volume equal to 14,153, sir. 14,153 into 16. Okay. 2,26,448. Therefore, cost of sales. Here sales value directly given in the problem. So sales value, cost of sales difference is the profit. So this is the solution, sir. Next. Question number 2, sir. The following data relates to the manufacture of a standard product during the month of April. So here raw material cost 1,80,000, direct wage cost 90,000, machine hours worked 10,000 hours, machine hour rate 8 rupees per hour. So that means 1 hour machine running in the factory, estimated overhead amount equal to 8 rupees. So during this period, actual machine hours worked 10,000 hours, sir, into rate equal to 8 rupees, sir. Therefore, absorbed factory overhead amount equal to 10,000 hours into 8 rupees. That is equal to 80,000 rupees. 80,000 rupees. Next, administrative overheads, sir. Here administrative overheads 35,000, but here not clearly mentioned, sir, whether it is related to production or it is related to sales. So there is no clear information. In that case, take the assumption. Some people says, sir, assumed as related to production. Some people says assumed as related to sales. You can take anyone, sir. So completely your choice, sir. Right. So here, suppose assumed as related to production, then it is charged to factory cost. Next, selling overheads per unit 5 rupees, sir. Selling overheads also varies with the sales volume. Here sales volume 3,600, sir. Production volume 4,000, sir. Here closing stock equal to 400, sir. Here opening inventory levels nil, sir. Okay. Now see the solution. Raw material cost 1,80,000, direct wage cost 90,000, prime cost equal to 2,70,000. So factory overheads, working hours 10,000 hours, rate per hour 8 rupees. So therefore estimated factory overhead amount equal to 80,000. So here administration overheads assumed as related to sales. Assumed as related to sales. Some people say, sir, assumed as related to production. Sir, completely your choice, sir. You can take any model. So both are valid, sir. So here in this problem, assumption is assumed as related to sales. Okay, right. So factory cost becomes cost of production. Then adjust the inventory levels of finished goods. We get cost of goods sold. Then add the administrative overheads. Here assumed as general admin expenses. Assumed as general admin expenses. That means assumed as related to sales. Next, to selling overheads varies with the sales volume. Finally, cost of sales or total cost. Compare with sales revenue. Ultimately, we get the profit. So this is the problem. Next. Next one. The following data are available from the books and records of Q Limited for the month of April 2020. Direct labor cost equal to 1,20,000, sir. So that is 120% of factory overheads. So therefore factory overheads equal to 120% of factory overhead amount equal to 1,20,000. Factory overhead equal to 1,20,000 divided by 120%. 120%. That is equal to 1.2. So 120% of factory overhead equal to 1,20,000. Factory overhead equal to 1,20,000 divided by 1.2. 1,20,000 divided by 1.2 is equal to 1 lakh, sir. Factory overhead equal to 1 lakh. Next, cost of sales equal to 4 lakhs. So sales amount equal to 5 lakhs. Account show the following figures. Inventory levels of raw materials given in the problem. Cost of opening inventory of raw material 20,000. Cost of closing inventory of raw material 25,000. Cost of opening inventory of work in progress 20,000. Cost of closing inventory of work in progress 30,000. Cost of opening inventory of finished goods 50,000. Cost of closing inventory of finished goods 60,000. Other details, selling expenses. Next, general and admin expenses 18,000. You are required to prepare the cost sheet. Sir, here one thing is missing, sir. So that is the raw material purchase cost. Raw material purchase cost. So raw material purchase cost missing, sir. So here cost of sales directly available in the problem. Then start with cost of sales in reverse procedure. Cost of sales in reverse procedure. So automatically we get the raw material purchase cost. Raw material purchase cost. Then start the cost statement. Then start the cost statement. See the solution, sir. So here working out, sir, calculation of cost of raw material purchase. Start with cost of sales in reverse mode direction. In reverse mode direction, add becomes lesser, less becomes add. In reverse mode direction, add becomes less, less becomes add. So automatically here raw material purchase cost equal to 1,65,000. 1,65,000. Then start the cost sheet, sir. Then start the cost sheet. Cost of raw material purchase, then adjust the inventory levels, then we get cost of raw material consumed. Add direct labor cost, we get prime cost. Add factory work charge, we get gross factory cost. Adjust the inventory levels relating to work in progress, then we get the net factory cost or cost of production. Adjust the inventory levels relating to finished goods, we get the cost of goods sold. Add selling expenses and general expenses, we get cost of sales. So here cost of sales equal to 4 lakhs, sir. Sales amount equal to 5 lakhs. That is given in the problem. Then balance in figure equal to 1 lakh. So this is the problem number 3. So here raw material purchase missing factor, sir. So easily find out the raw material purchase cost by using reverse procedure. Here cost of sales directly mentioned in the problem. Take the cost of sales, start the reverse procedure. Ultimately we get the raw material purchase cost. This is the main point, sir. Now let us discuss material cost controlling chapter. Material cost controlling chapter. There are certain techniques to be used for material cost controlling, like EOQ, that is economic ordering quantity. Economic ordering quantity. Next, stock levels. Stock levels. Next, ITR, inventory turnover ratio. Next, pricing issue methods. Pricing issue methods, that is FIFO and LIFO and weighted average. Next, ABC analysis. So these are the techniques to be used for material cost controlling, sir. Next, the first one, economic ordering quantity, simply calling as EOQ. So economic ordering quantity is that quantity at which TOC, total ordering cost, and TCC, total carrying cost, are minimum. Where these two cost elements summation is minimum, that order size is nothing but economic order size. Where TOC and TCC is minimum. That order size is calling as economic order size. So generally at the time of raw material buying, some additional costs are incurred, namely ordering cost and carrying cost. So these two cost elements summation where it is minimum, that order size is calling as economic order size. This can be calculated in three modes. Number one, a formula based method. Number two, trial and error method. Number three, graphical method. Graphical method. So number one, trial and error method, sir. Trial and error method. Next, number two, formula based method. Formula based method. Number three, graphical method. Graphical method. Now discuss trial and error method, sir. Trial and error method. Right. Now, sir, here daily demand pattern is uniform, sir. Therefore, raw material usage pattern also same. So, raw materials are used evenly throughout the year, sir. Raw materials are used evenly throughout the year, sir. Throughout the year. Raw materials are used evenly throughout the year. So, that means daily usage is uniform. Per day usage equal to 150 units. Therefore, annual usage of raw material, 150 units. Annual usage of raw material equal to 150 units. Here inventory levels relating to raw materials nil. Therefore, annual usage becomes annual demand of raw material. Annual demand of raw material. Annual demand of raw material equal to 150 units. Reason here inventory levels relating to raw materials nil. So that annual usage becomes annual demand, that is denoted by A. Next, ordering charges per order. Ordering charges per order. Ordering charges per order in brackets O equal to ordering charges per order in brackets O, that is denoted by O, sir. 9,000 rupees. So here one point very important, sir. Whatever quantity you should order, whatever quantity you order, ordering charges remains constant. So quantity irrespective, sir. So irrespective of quantity, sir. Here main point, quantity irrespective, ordering charges per order remains constant. Okay, right. So 9,000 rupees. Next, the unit price of raw material. Unit price of raw material. Unit price of raw material. Unit price of raw material equal to 150 rupees, sir. Sir, here small mistake, sir. Annual usage of raw material 150 into 12, sir. 54,000 units, sir. 54,000 units. This is also 150 units into 12, that is 54,000 units, sir. Annual means per month into 12, sir. So 150 into 12, 54,000 units. Here annual usage becomes annual demand. Ordering charges per order 9,000. Next, unit price of raw material 150. Next, carrying charges. Carrying charges per unit per annum. Carrying charges per unit per annum equal to 300 rupees, sir. 300 rupees. Sir, unit price of raw material 800 rupees, sir. 800 rupees. So, these are the details. So, here raw materials are used evenly throughout the year. Per day usage equal to 150. Annual usage equal to 54,000 units. Annual demand also 54,000 units. Reason here inventory levels nil. Therefore, annual usage becomes annual demand. Ordering charges per order 9,000 rupees. It includes what are the expenses? Freight charges, loading and unloading charges, documentation work, that is the billing work. Next, the unit price of raw material equal to 800. Carrying charges per unit per annum. It includes storage cost, insurance cost, cost of obsolescence. Next, cost of working capital, that is the interest cost. Interest on capital invested in raw material purchase. So, these four elements collectively known as carrying charges per unit per annum. Okay. So, this is the data. Now, calculate the economic ordering quantity or economic order size, simply calling as EOQ. First one, annual demand 54,000 castings, 54,000 units. Order size. So, this is the trial and error method. Please take one trial. 100 multiples or 200 multiples or 400 multiples or 600 multiples. Completely your choice. My choice is 600 multiples, sir. 600 units. So, if company follows 600 units order size for buying 54,000 castings, in that case, number of orders 54,000 divided by 600 is equal 90 orders. Total ordering cost per annum. So, 90 orders into ordering cost per order. 90 into 9,000. 90 into 9,000 equal to 8 lakhs 10,000. Next, total carrying cost. Total carrying cost half of the order size into C. So, 600 by 2 into C, carrying cost per unit per annum 300, sir. 90,000. Next, TOC and TCC summation cost, that is the total annual cost. Total annual cost 9 lakhs. 9 lakhs. So, if company follows 600 units order size, additional cost amount equal to 9 lakhs other than material cost, sir. So, material cost equal to annual demand or annual purchase 54,000 units into 54,000 units into 800 rupees, that is 432 lakhs. This is the raw material purchase cost. So, here company follows 600 units order size for buying 54,000 units. Here additional cost incurred for this order size equal to 9 lakhs. Next, 54,000 units. If company follows 1200 units order size for buying 54,000 units, orders 45 orders, sir. A by order size, annual demand divided by order size, 45 orders. So, 45 into 9,000, 4 lakhs 5,000. Next, 1200 by 2 into 300. 1200 by 2 into 300. 1,80,000. 1 lakh 80 plus 4 lakhs 5,000. 5 lakhs 85,000. Next, 54,000 units. If order size is 1800 units, 54,000 divided by 1800 is equal to 30 orders. Here 30 orders into 9,000, 2 lakh 70,000. Next 1800 by 2 into 300, 2 lakh 70,000, 5 lakhs 40,000. Sir, here one thing is observed, TOC equal to TCC. Where TOC equal to TCC, at that point total annual cost is minimum. Minimum, sir. Suppose if company follows above 1800 units order size, definitely company incurs extra additional cost. See that 54,000 units. Suppose if company follows 2000 units order size, this is above 1800, sir. In that case, number of orders 54,000 divided by 2000 is equal to 27 orders. 27 orders into 9,000, 2 lakhs 43,000. Next 2000 by 2 into 300. So 1000 into 300, 3 lakhs, 5 lakhs 43,000. 5 lakhs 43,000. So here, if company not ordering EOQ, in that case extra additional cost incurred equal to 3,000, sir. So here 1800 is calling as economic ordering quantity or economic order size. Economic ordering quantity or economic order size. So here specialty TOC equal to TCC, where TOC equal to TCC, that additional cost is minimum. Where additional cost is minimum, that order size is calling as economic order size. Suppose if company not ordering EOQ, definitely company have to incur extra additional cost. Suppose if company follows 2000 units order size, in that case extra additional cost equal to 5 lakhs 43 minus 5 lakhs 40, 3,000, sir. So this is the trial and error method. So here economic ordering quantity or economic order size equal to 1800 units. 1800 units. Suppose if supplier offer a discount, in that case unit price varies with order size. If supplier offer a discount, that means unit price varies with order size. In that case, decision making is based on three element summation, TOC plus TCC plus raw material purchase cost. In the above example, unit price remains constant. That means discount offers nil. If there is no discount offers, in that case unit price remains constant at any order size. So that decision making is based on just two element summation, TOC plus TCC. Where TOC and TCC is minimum, that order size is calling as economic order size. Sometimes supplier offer a discounts. In that case unit price varies with order size. In that case decision making is based on three element summation, TOC plus TCC plus raw material purchase cost. Where these three element summation is minimum, that order size is calling as economic order size. TOC formula, sir. TOC formula, number of orders into ordering cost per order. Ordering cost per order. Next TCC, sir. TCC. TCC. Average inventory into carrying cost per unit per annum. So ORR, average inventory, how to calculate, sir? Half of the order size. Half of the order size into carrying cost per unit per annum. Into carrying cost per unit per annum. That is denoted by C. Next, raw material purchase cost. Raw material purchase cost equal to annual purchase quantity of raw material. Annual purchase quantity of raw material. Annual purchase quantity of raw material into unit price of raw material. Unit price of raw material. So annual purchase quantity of raw material into unit price of raw material. So that is the raw material purchase cost. Next, total annual cost equal to TOC plus TCC. Total annual inventory cost equal to TOC plus TCC plus raw material purchase cost. Raw material purchase cost. So this is the trial and error method. In case supplier offer a discounts, in that case unit price varies with order size, so that decision making is based on three element summation, where these three element summation is minimum, that size is calling as economic order size. So this is the trial and error method. Next, formula based method, sir. Formula based method. EOQ equal to square root of 2AO by C. 2 into A, 54,000 units into ordering cost per order 9,000 divided by 300 equal to 1800 units. 1800 units. The main objective of economic ordering quantity or economic order size is to minimize the additional cost. To minimize the additional cost. If company ordering EOQ, then additional cost is minimum. Suppose if company not ordering EOQ, definitely company have to incur extra additional cost. Sometimes supplier offer a special discount offers. In that case, decision making is based on three element summation, where the three element summation is minimum, that order size is calling as economic order size. So this is the economic order quantity formula based method. Next, to time gap between two orders. Here company follows 1800 order size. So company order size, here company order size is equal to 1800 units. So according to company order size, time gap between two orders, sir. Time gap between two orders. Time gap between two orders. Time gap between two orders is equal to time gap between two orders equal to number of days in a year divided by number of orders in a year. So here number of days in a year, for example, given in the problem 360 days, 1 year equal to number of orders in a year according to company order size, number of orders to be placed in a year. So number of orders to be placed in a year equal to number of orders to be placed in a year equal to A by order size. A 54,000 castings divided by order size 1800, 30 orders. So 30 orders. 360 divided by 30, 360 divided by 30 is equal 360 divided by 30 orders, sir. 12 days. So that is the time gap between two orders. So every 12th day, a fresh order shall be made for purchase of raw material. So the main objective of EOQ to minimize the additional cost. So this is the first technique, sir. This is the first technique, economic ordering quantity. Next to stock levels. So main objective of stock levels to avoid the production interruption, to avoid the stock out risk, maintain the perfect stock levels. So here two models are there, with the safety stock, second model without safety stock. Suppose if company maintains safety stock, in that case two-bin system will be followed, sir. So this is the larger portion, this is the smaller portion. Larger portion contains company order size. Here company order size equal to 1800 units. Smaller portion contains safety stock. Here safety stock equal to 600 units. In the above example, no safety stock, but in this example, company maintains safety stock. So company order size 1800 units, so company maintains safety stock 600 units. So here one thing, sir, suppose if company not maintains safety stock, in that case total carrying cost equal to 2,70,000. Am I right? But if company maintains safety stock, in that case total carrying cost equal to sir, half of the order size into C plus safety stock into C. Here no need of average, sir. Reason, here no daily uses. In smaller portion no daily uses, sir. So don't take the average. Directly safety stock into carrying cost per unit per annum. In larger portion take the average. Reason, here daily usage equal to 150, sir. So here daily usage there. So that take the average. So half of the order size into carrying cost per unit per annum. So 1800 divided by 2 into carrying cost per unit per annum. Carrying cost per unit per annum equal to 300 rupees plus safety stock 600 into 300. So 900 into 300 to 2,70,000 plus 1,80,000 equal to 4 lakhs 2,70,000 plus 1,80,000, 4,50,000. So, if company maintains safety stock, in that case total carrying cost equal to half of the order size into C plus safety stock into C. Next, reorder point or reorder level. Sir, here normal lead time equal to 6 days. Maximum lead time equal to 10 days. For example, normal lead time means delivery from supplier generally takes 6 days, but as much as 10 days. Delivery from supplier generally takes 6 days, sir, but it can take as much as 10 days. That means in general lead time equal to 6 days. In case delay, 10th day confirm, sir. 10th day confirm. So 6th day may not come, 7th day may not come, 8th day may not come, 9th day may not come, but 10th day confirm, sir. Therefore, maximum lead time equal to 10 days, normal lead time equal to 6 days. Delivery from supplier generally takes 6 days, but it can take as much as 10 days. That means in general time 6 days, sir. In case delay, 6th day may not come, 7th day may not come, 8th day may not come, 9th day may not come, but 10th day definitely come. So, here daily usage equal to 150 units. 150 units. Normal lead time equal to 6 days. So, therefore lead time consumption, normal usage into normal lead time, 150 is equal to 900 units. 900 units. So, here company order size is 1800. After 2 days, this inventory level becomes 1500. Next, after 4 days, this inventory level becomes 1200, sir. 1200. Next, after 6 days, this inventory level becomes 900. So, this is the equal to lead time consumption. This is the equal to lead time consumption. Then immediately place the fresh order for purchase of raw material. Therefore, ROL equal to LTC plus safety stock. LTC plus safety stock. Here LTC means normal consumption per day into normal lead time 900, sir. So, larger portion inventory level gradually decrease day by day and touch the lead time consumption, then immediately place the fresh order for purchase of raw material. So, formula LTC plus safety stock equal to 1500. So, this 1500 inventory level at which a fresh order for purchase of raw material shall be made. So, ROL, reorder level, it is the level of inventory at which a fresh order for purchase of raw material shall be made. So, 900 plus 600 equal to 1500. So, formula LTC plus safety stock. LTC means normal consumption into normal lead time. Normal lead time plus safety stock. Here normal consumption per day equal to 150. Normal lead time equal to 6 days. Safety stock equal to 600. 900 plus 600. 1500 castings. 1500 castings. That is ROL. So, it is the level of inventory at which a fresh order for purchase of raw material shall be made. Next, maximum level, sir. So, maximum level means it is the level of inventory beyond which inventory should not cross. larger portion 1800 should not cross, smaller portion 600 should not cross. Therefore, total bin inventory level 2400 should not cross. That is the maximum stock level. Maximum stock level. So, maximum level. Maximum stock level equal to larger portion plus smaller portion EOQ plus safety stock. Safety stock. Next, minimum stock level. Minimum stock level. Minimum stock level. It is the level of inventory beyond which inventory will not be allowed to fall. So, in smaller portion, definitely to be maintained 600 units. So, 600 units will not be allowed to fall, sir. So, minimum stock level is nothing but safety stock. Safety stock. Next, average stock level. Average stock level. Average stock level equal to maximum level plus minimum level by 2. Maximum level plus minimum level by 2. Here also second alternative, sir. Minimum level plus half of the reorder quantity. Half of the reorder quantity. So, this is the with safety stock model. So, next without safety stock. So, here company doesn't maintain safety stock, sir. This is the single bin. In above example, 2 bin system, but it is the single bin system, sir. Only company order size, sir. Company order size. Here, normal consumption per day. Normal consumption per day. Normal consumption per day 150. Average, maximum consumption per day 150. Reason, here raw materials are used evenly throughout the year, so that maximum consumption per day also 150. Minimum consumption per day 150. Reason, here raw materials are used evenly throughout the year, therefore maximum consumption, minimum consumption, normal consumption all are same. Next, normal lead time equal to 6 days, sir. Maximum lead time equal to 10 days. 10 days, sir. Maximum lead time equal to 10 days. Minimum lead time equal to 2 days. 2 days. So, while calculating the order levels without safety stock model, please consider 3 times. Normal lead time 6 days, maximum lead time 10 days, minimum lead time too early. In that case, minimum lead time equal to 2 days. Here company order size 1800 castings or 1800 units. Raw material name castings. So, company order size equal to 1800 units. So, here no safety stock, sir. So, if there is no safety stock, place the order too early. Place the order too early. In above case, reorder level equal to 1500. So, 900 plus 600, 1500 level. So, idea. Suppose here 1800 after 2 days, 1800 level becomes 1500. reason daily usage equal to 150, 2 days usage equal to 150 is 300, so 1800 level becomes 1500 sir. Then immediately place the order. So here orders are to be placed immediately, so too early. So this 1500 is nothing but ROL. So that is how to calculate 1500 sir. And maximum consumption into maximum lead time, maximum consumption into maximum lead time. So here maximum consumption 150 into maximum lead time equal to 10, therefore 1500. Right. Now so this is the ROL 1500. Order size gradually decrease and touch the 1500, then immediately place the fresh order for purchasing of raw materials. Okay, right. So at 1500 fresh order shall be made. So this fresh order may be received in 2 days or 6 days or 10 days. So here 3 options are there: 2 days or 6 days or 10 days. Suppose order received within 2 days, order size sir, order size 1800. So at 1500 fresh order shall be made. Order received 1800, total 1800 plus 1500, 3300 minus 2 days consumption, 2 into 150, 300. So final answer 3000. Suppose order received in 2 days, within 2 days, order received within 2 days, in that case bin inventory level equal to 3000. Next, within 6 days, in that case at 1500 inventory level fresh order shall be made. Next, order received within 6 days 1800. So 1500 plus 18, 3300 minus 6 days consumption, 6 into 150, 900. So 3300 minus 900 is equal 2400 sir. So suppose order received within 6 days, in that case bin quantity equal to 2400. Suppose in 10 days, again at 1500 fresh order shall be made. Order received 1800 within 10 days. So total 3300 minus 10 into 150, 1500. So 3300 minus 1500 is equal to 1800. Out of these 3 options, maximum inventory level equal to 3000. This is the inventory level at which inventory should not cross. It is the level of inventory beyond which inventory should not cross. So how to calculate sir? Maximum level equal to ROL 1500 is nothing but ROL plus order received ROQ. ROQ means company order size. Company order size is nothing but EOQ sir. So sometimes company, a supplier offer a discount. In that case ROQ, special order size sir. In general there is no information about the company order size. In that case EOQ becomes ROQ. So here ROL 1500, order size 1800, order size means ROQ minus 2 days consumption, minimum consumption into minimum consumption into minimum lead time, minimum consumption into minimum lead time. So ROL 1500 ROQ 1800 minus minimum consumption 150, minimum lead time 2. So final answer 3000 units. 3000 units. Sometimes questioner is asking calculate minimum stock level in case of without safety stock. So in that case, at 1500 units, fresh order shall be made. Fresh order shall be made. In general, lead time equal to 6 days. So 6 days consumption 6 into 150, 900. So 1500 minus 900 is equal to 600. This is the minimum stock level. So minimum stock level, it is the level of inventory at which, beyond which inventory will not be allowed to fall. So it is the level of inventory beyond which inventory will not be allowed to fall. So this is the minimum stock level. This is the minimum stock level. This is the minimum stock level. ROL minus lead time consumption. ROL minus lead time consumption. Minimum stock level. Minimum stock level equal to ROL. Minimum stock level equal to ROL minus lead time consumption. ROL minus lead time consumption means normal consumption into normal lead time. Normal lead time. Right. Sometimes there is a delay in case of delivery of raw material. So this is the danger zone. This is the danger zone. So question is asking calculate the danger level. Danger level. Lead time for emergency purchase. Lead time for emergency purchase. Lead time for emergency purchase. Lead time for emergency purchase into average consumption per day. Average consumption per day. Lead time for emergency purchase into average consumption per day. This is the danger level. Next to average stock level, same. Maximum level plus minimum level by 2. There is second alternative, minimum level plus half of the reordering quantity. So this is the stock level, sir. The main objective of stock levels to avoid the stock out risk or to avoid the production interruption. That is the main objective. Next, inventory turnover ratio, sir. The main objective of inventory turnover ratio to minimize the carrying cost, sir. To minimize the carrying cost. So inventory turnover ratio measures the speed at which the raw materials are consumed. For example, X Limited company produces a single product P. X Limited company produces a single product P. It requires two raw materials. Raw material item A, raw material item B. Inventory turnover ratio 30 times. Inventory turnover ratio 40 times for raw material B. 1 year equal to 360 days. So which one is the fast moving item, sir? More the number of times, faster is the movement of raw material. Therefore, huge fund allocated to raw material B, lesser amount allocated to raw material A while purchasing the raw material. While purchasing the raw material, huge amount allocated to fast moving item, lesser amount allocated to slow moving item. Here more the number of times, faster is the movement of raw material. So suppose ITR in days equal to number of days in a year 360 days divided by ITR in times 30 times. So 12 days. Here ITR in days equal to 360 divided by 40 is equal to 9 days. So according to days, lesser the number of days, faster is the movement of raw material. Lesser the number of days, faster is the movement of raw material. So according to times, more the number of times, faster is the movement of raw material. According to days, lesser the number of days, faster is the movement of raw material. So this is the ITR. ITR in times equal to cost of raw material consumed divided by cost of average inventory of raw material. Cost of raw material consumed divided by cost of average inventory of raw material. Sir, how to calculate cost of raw material consumed, sir? Opening inventory of raw material plus purchase minus closing inventory of raw material, then we get cost of raw material consumed. Cost of average inventory of raw material equal to cost of opening inventory of raw material plus cost of closing inventory of raw material divided by 2. Here one important point, sometimes if there is no opening inventory of raw material, in that case closing inventory of raw material, don't take the average, sir. Closing inventory of raw material directly treated as average inventory of raw material. So average inventory of raw material means opening inventory of raw material plus closing inventory of raw material by 2. If there is no opening inventory of raw material, in that case closing inventory of raw material should be treated as average inventory of raw material. So this is the ITR. Okay. So next pricing issue method. So FIFO method, LIFO method, weighted average method, sir. Next ABC analysis. So these are the techniques for material cost controlling. Okay, right. So assignment 1, sir. Compute EOQ and total variable cost for the following. So EOQ means annual demand of raw material, that is denoted by A. Unit price of raw material 20, ordering charges per order 16. So what are the elements involved in carrying cost, sir? Storage cost 2, next to insurance cost 2, next to cost of obsolescence 2, next to interest cost, interest on capital invested in raw material purchase. So these three elements collectively known as carrying cost. So summation 2 plus 12, 14 plus 6, 20%. So 20%. So here carrying charges varies with unit price. That means if unit price increase, carrying charges also increase. If unit price decrease, carrying charges also decrease. So that 20% applied on unit price of raw material. 20% of 20 rupees is equal to 4 rupees. So that is C. This is O. Then apply the square root of 2AO by C. 2AO by C. So ₹4 C, ordering cost per order 16 rupees, annual demand 5000. So 200 units. 200 units. Next, Determine the total variable cost that would result for the items. Sir, variable cost, that is the associated cost of order size. Variable cost of order size or associated cost of order size or TOC and TCC or total annual cost of order size. So sometimes questioner is asking calculate variable cost of order size. Sometimes questioner is asking total annual cost of order size. So how to calculate sir TOC plus TCC? TOC means number of orders into ordering cost per order. Number of orders equal to A by company order size. Here company order size equal to EOQ. So we get TOC. Then TCC equal to half of the order size into carrying cost per unit per annum. So here total ordering cost per annum. Here number of orders, so A by annual demand by order size. So 5000 units divided by 200 units, that is the number of orders into ordering cost per order 400 sir. Next total carrying cost half of the order size into carrying cost per unit per annum, that is also 400. Here one thing is observed, at EOQ order size TOC and TCC are equal. So total variable cost of order size equal to 800. This is also calling as associated cost of order size. This is also called as total annual cost of order size. Next, determine the total variable cost if an incorrect price of 12.8 is used sir. Suppose here unit price 1200 sir. Suppose incorrect price 12. If incorrect price 12.8 is used, then what is the variable cost of order size? So if unit price changes, automatically carrying cost changes. Carrying cost changes. So that is 20% of 12.8. 20% of 12.8. 20% of 12.8. So 2.56. Then revised EOQ equal to 250 units. Then calculate the variable cost of order size. Ordering cost, number of orders into ordering cost per order. So 320. Number of orders into ordering cost per order. So number of orders equal to A by order size. Here A equal to annual demand of raw material 5000 units. Order size, if there is no information about the order size, then simply follow the economic order size. Here economic order size 250. So number of orders into 16 rupees, therefore 320. Carrying cost also 320. So at EOQ size, TOC and TCC are equal. So if incorrect price of 12.80 is used, then in that case variable cost of order size equal to 640. So this is the problem number 1 sir, assignment 1. Next to assignment 6 sir. From the details given below, calculate reordering level, minimum level, maximum level, danger level. So here reordering quantity is to be calculated on the basis of following information. Reordering quantity means company order size sir. Reordering quantity means company order size. Company order size. So cost of placing and purchase order is 4000, that is denoted by BO. Number of units to be purchased during the year equal to 5 lakhs rupees. 5 lakhs units. So purchase, number of units to be purchased means annual demand sir. Purchase price per unit inclusive of transportation cost 50 rupees. Okay. Annual cost of storage per unit equal to 10 rupees. This is denoted by C. Next, lead time details sir. Here delivery from supplier generally takes 10 days. That is the normal lead time. So that is the average lead time equal to 10 days. Maximum lead time equal to 15 days. Minimum lead time equal to 5 days. For emergency purchase lead time equal to 4 days. Rate of consumption equal to Average consumption per day 1500 units, maximum consumption per day 2000 units. Sir, minimum consumption, sir. Average consumption equal to maximum consumption plus minimum consumption by 2. So 2 into 1500, 2 into 1500, 3000, sir. So here maximum 2000 plus minimum finding factor is equal to 3000. Therefore, minimum consumption equal to 1000 units, sir. 1000 units. 1000 units per day. So here company order size. So given information is used for calculating the company order size. So that is EOQ, sir. EOQ. So reordering quantity, that is company order size. So given information, as per given information, company order size equal to square root of 2 AO by C. That means here company order size equal to EOQ, sir. So ROQ equal to EOQ. So if there is no specific information about the order size, then EOQ treated as ROQ. So that is equal square root of 2 into 5 lakhs into ordering charges per order 4000 divided by 10 rupees. Divided by 10 rupees. Divided by 10 rupees. Right. So value sixth problem. This is, so here EOQ 20,000 units, sir. 20,000 units. Next, what they are asking this question, reorder level. Sir, in this problem, there is no specific information about the safety stock. That means here company doesn't maintain safety stock. So this is without safety stock model. So in without safety stock model, ROL equal to maximum consumption into maximum lead time. Maximum consumption into maximum lead time. Maximum consumption into maximum lead time. Here maximum consumption, sir. Here maximum consumption per day 2000 units. Maximum lead time, sir. Maximum lead time. Maximum lead time 15 days. 15 days is equal to 30,000 units. 30,000 units. Yes, exactly 30,000 units. Next, B, minimum level, sir. Minimum level equal to ROL. Minimum level equal to ROL minus LTC. Lead time consumption. Lead time consumption means normal consumption into normal lead time. Normal consumption into normal lead time. So ROL 30,000, sir. Here normals are not available, sir. Then take the average values. So average consumption 1500 units into 10 days. So normal lead time, that means average lead time 10 days. If normals are not available, then take the average. So 30,000 minus 15,000 equal to 15,000 units. 15,000 units. Yes, 15,000 units. That is the minimum level. Minimum level. Next, maximum level, sir. Maximum level equal to ROL plus ROQ minus minimum consumption into minimum lead time. Minimum consumption into minimum lead time. ROL 30,000 plus ROQ. Here ROQ already calculated, sir. ROQ 20,000 units. 20,000 units minus minimum consumption to minimum lead time. Here minimum consumption equal to 1,000 into minimum lead time 5 days. So 30 plus 20, 50, 50 minus 5, 45. 45,000 units. Correct. Next one, danger level. Danger level equal to lead time for emergency purchase into average consumption, sir. Here lead time for emergency purchase equal to 4 days. 4 days into average consumption per day equal to 1500 units. 1500 units. That is equal to 6,000. Yes, 6,000. So this is the inventory levels. Inventory levels. Next one. Tenth problem. The following data calculate the inventory turnover ratio and the number of days for which the average inventory is held. Advise which of the two materials is fast moving, sir. Here 1 year equal to 360 days. So first of all we have to calculate the inventory turnover ratio in times. Inventory turnover ratio equal to ITR in times. ITR in times equal to cost of raw material consumed. Cost of raw material consumed divided by cost of average inventory. Cost of average inventory. Cost of raw material consumed, sir. Cost of opening inventory of raw material. Cost of raw material purchase minus cost of closing inventory of raw material. 2,70,000 plus 90, 3,60,000. 3,60,000 minus 1,10,000. 1,10,000. So that is the 2,50,000. 2,50,000 divided by average inventory 1 lakh. So 2.5 times. 2.5 times. 2.5 times. Next, here opening inventory 1 lakh, purchase 4 lakhs 40, 5 lakhs 40. So 5 lakhs 40 minus 60. 5 lakhs 40,000 minus 60,000. 4 lakhs 80,000. 4 lakhs 80,000 divided by cost of average inventory 1 lakh 60 divided by 2, 80,000. 80,000. So 4 lakhs 80,000 divided by 80,000. 6. More the number of times, faster is the movement of raw material. Therefore, material Y is the fast moving item, sir. More the number of times, that is faster is the movement of raw material. So here material Y is the fast moving item, so that huge amount allocated to material Y, lesser amount allocated to material X, that affects to minimize the carrying cost. Okay. Next, in days, 360 divided by 2.5, sir. 360 divided by 2.5, that is 144 days. 360 divided by 6, that is 60 days. So lesser the number of days, according to days, lesser the number of days, faster is the movement of raw material. So according to days, lesser the number of days, faster is the movement of raw material. Therefore, material Y is the fast moving item. Material Y is the fast moving item. So this is the problem number 10, right? So this is the material chapter set. Next, employee cost controlling. 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 Right. The main objective of this chapter is to reduce or to minimize employee cost per piece. Employee cost per piece. So the main objective of this chapter is to minimize the employee cost per piece. How to achieve, sir? To increase the employees' output levels, to increase the employee output levels, to increase the employee output levels, to increase the employee output levels, ultimately we get minimize the employee cost per piece. How to increase the employee output levels? To give attractive wage payment, to give attractive wage payment, attractive wage payment. Ultimately, we get increase the employee output levels. Finally, to minimize the employee cost per piece. So, starting step to give attractive wage payment, that affects to increase the employee output levels, that affects to minimize the employee cost per piece. So, basically, wage payment methods are two types, sir. Wage payment methods are two types. 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 Time rate system, time rate system, piece rate system, piece rate system, time rate system, piece rate system, sir. Under time rate system, wages equal to T into R. So, payments made on hourly basis. A worker is paid at a fixed rate per hour. A worker is paid at a fixed rate per hour, at a fixed rate per hour, at a fixed rate per hour, a worker is paid at a fixed rate per hour is called as time rate wage system. So wage is equal to T into R. T into R. T means actual working time. R means hourly wage rate. Hourly wage rate. Under time rate wage system, two incentive plans, that is the bonus plans. Halsey premium plan. Premium means basic plus bonus. Bonus is nothing but premium. So in Halsey premium plan, worker gets basic wage and also gets bonus. That bonus is calling as premium. So to attract the customer, introduce the bonus plans, ultimately to increase the production, finally to minimize the employee cost per piece. So Halsey premium plan. Next, row 1 premium plan. Row 1 premium plan. So under time rate scheme, two incentive plans are there. One is Halsey premium plan and another one is row 1 premium plan. Halsey premium plan. Halsey premium plan is equal to basic wage plus bonus. Here basic wage is equal to T into R, bonus equal to 50% of time saved into R. 50% of time saved into R. So in this plan, one demerit exists. If worker speed increases, bonus also increases. That affects product quality decreases. In this plan, if worker speed increases, earnings also increases. That means bonus also increases. That affects product quality decrease, orders decrease. So that is fully negative, sir. So to control the carelessness speed, to introduce the row 1 premium plan. Row 1 premium plan. Under row 1 premium plan, bonus is maximum up to 50% of the time allowed. So here quality maintained. So quality product produced under row 1 premium plan. Reason, under row 1 premium plan, here bonus not increase to speed. So that means here bonus is maximum when actual working time equal to 50% of time allowed. So this fact already known to the worker, so stick on that speed, that impact to maintain the quality product, so that here row 1 premium plan introduced. Under row 1 premium plan, under row 1 premium plan, basic wage plus bonus. Basic wage T into R, bonus time saved TS by ST into T into R. TS by ST into T into R. So this is the row 1 premium plan. One important note point, sir. Actual time taken equal to 50% of time allowed. Time allowed. Suppose time allowed equal to 8 hours, but time taken equal to 4 hours. That means here actual working time equal to 50% of the time allowed. At that point, bonus under Halsey plan is equal to bonus under Rowan plan. Under Rowan scheme, bonus is maximum at this point. Suppose worker working time equal to 49% of time allowed, definitely bonus decreases under Rowan premium plan. But in Halsey premium plan, bonus increases. So, under Rowan premium plan, bonus is maximum at working time equal to 50% of the time allowed. Suppose worker working time below 50% of time allowed, that means 49% of time allowed, gradually bonus decreases under Rowan premium plan. In Halsey premium plan, bonus increases. So, that's why if worker speed increase definitely plays under Rowan premium plan. That affects quality product achieved, sir. So, actual working time equal to 50% of time allowed. At this point, bonus under Halsey plan, bonus under Rowan plan are equal. So, this is important point. Next, piece rate system. Piece rate system. Under piece rate system, a worker is paid at a fixed rate per piece produced. A worker is paid at a fixed rate per piece produced. Per piece produced. A worker is paid at a fixed rate per piece produced. So, this is purely linkage between performance and reward. Performance increases, reward also increases. This is very expensive to the company. So, compared to Halsey premium plan and Rowan premium plan, it is expensive, it is very costly to the company. So, under piece rate system, labor cost per piece is more than Halsey premium plan and Rowan premium plan. It is very expensive, it is very costly compared to Halsey and Rowan. So, under piece rate system, VS equal to number of pieces produced into piece rate per piece. Piece rate per piece. Number of pieces produced into piece rate per piece. Sir, here piece rate per piece completely based on standard hourly output. Piece rate per piece completely based on standard hourly output. Standard hourly output. So, piece rate per piece calculation completely depends on standard hourly output. For example, standard hourly output equal to 10 units, sir. Standard hourly output equal to 10 units. Hourly wage rate equal to 10 rupees. Then calculate piece rate per piece. Formula standard output, standard time allowed for 1 unit, standard time allowed for 1 unit into R, that is hourly wage rate. Sir, standard time allowed for 1 unit, sir. In given information, standard hourly output equal 10 units. That means 10 units allowed time equal to 10 units allowed time equal to 1 hour. 1 unit allowed time equal to question mark. 10 units allowed time equal to 1 hour. 1 unit allowed time equal to question mark into R, hourly rate 10 rupees. Sir, 10 units allowed time 1 hour. 1 unit allowed time equal to 0.1 hour. 0.1 hour into 10, that equal to 1 rupee. So this is the piece rate per piece. Next, the number of pieces produced into piece rate per piece, that is called wages under piece rate wage system. So it is very costly to the company, it is very expensive to the company compared to Halsey and Rowan schemes, right? So this is the piece rate per piece. So piece rate per piece formula, standard time allowed for 1 unit into R. Here 10 units allowed time equal to 1 hour, 1 unit allowed time equal to 0.1 hour into 10, that is equal to 1 rupee. Now take the problem. Right. Now take the problem. Right. CRD 4, sir. CRD 4. Mr. A worker takes 15 hours to complete a piece of work. A piece of work means here worker produces number of pieces, sir. One piece. CRD 4. Here worker produces number of pieces. So number of pieces produced by a worker equal to 1 piece. Time allowed for this work 20 hours, sir. Standard time allowed for 1 piece. Standard time allowed for 1 piece equal to 20 hours. Next, actual working time for a piece equal to 15 hours, sir. Actual working time for a piece, that is AHRT, is equal to 15 hours. Standard time allowed for 1 piece, that is denoted by SH. So standard time allowed for 1 piece equal to 20 hours. Actual working time for a piece equal to 15 hours. 15 hours. So time saved equal to SH minus AH. SHE 20 hours, AHE 15 hours, that equal to 5 hours. That equal to 5 hours. Now, wage rate per hour equal to 5 rupees. Wage rate per hour, that is R, equal to 5 rupees hourly rate. Hourly rate 5 rupees. Sir, piece rate per piece how much, sir? Piece rate per piece, piece rate per piece equal to, piece rate per piece equal to formula standard time allowed for 1 unit, sir. Standard time allowed for 1 unit into piece rate per piece. Piece rate per piece. Standard time allowed for 1 unit equal to 15 hours, sorry, 20 hours. 20 hours. Next, piece rate per piece, sorry, here standard time allowed for 1 unit, standard time allowed for 1 unit into R, sir, into R, R equal to 5 rupees. 5 rupees. So, piece rate would be based on standard hourly output. Here, standard time allowed for 1 piece equal to 20 hours. So, 20 hours into hourly rate equal to 5 rupees. So, therefore, piece rate per piece equal to 100 rupees. So, compared to wholesale, that means labor cost per piece under wholesale, row 1, labor cost per piece under row 1. So, compared to that plans, it is very costly. I will prove, sir. I can prove, sir. So, here piece rate per piece equal to 100 rupees, sir. Right. Here material cost incurred for a piece 50 rupees. Factory overhead recovery rate equal to 100% of wage cost. Calculate the factory cost of work under the following methods of wage payments. Okay. So, first of all, we have to calculate direct wage cost for a piece of work under row 1 premium plan, next wholesale premium plan, next piece rate plan. So, first row 1 premium plan. Row 1 premium plan. Row 1 premium plan. Row 1 premium plan. Formula. Earnings equal to formula direct wage cost or direct employee cost. Direct wage cost. Here 1 piece per piece. Here number of pieces produced 1 piece, direct wage cost per piece equal under row 1. Formula basic wage plus bonus. Basic wage plus bonus. Basic wage T into R plus bonus equal to TS by ST into T into R. So, working time equal to 15 hours. Hourly rate equal to 5 rupees 75. Am I right? Actual working time 15 hours, sir. Hourly rate 5 rupees 75. Next, time saved equal to 5 hours. Divide by standard time equal to standard time allowed 20. Standard time allowed 20. 1 piece. Okay. So, into 15 into 5. So, in this problem, number of pieces produced 1 piece, sir. So, 75 plus, so 75 into 5 divided by 20, 18.75. So, earnings under row 1 premium plan, 75 plus 18.75, 93.75, sir. So, that is the earnings under row 1 premium plan. So, per piece divided by number of pieces produced, one piece. So directly direct wage cost per piece equal 93.75. So, sir, first direct employee cost or direct wage cost according to row 1 93.75. Therefore, direct wage cost per piece equal to 93.75 divided by number of pieces produced, one piece. 93.75 divided by one piece is equal 93.75. So, direct wage cost per piece, direct wage cost per piece is equal total earnings under row 1 divided by number of pieces produced, one piece is equal to 93.75. Under piece set system, piece set per piece equal to 100 rupees, sir. But under row 1, 93.75, sir. So, savings per piece under row 1 equal to 100 minus 93.75, that is the 6.25. 6.25. So, number 2, wholesale plan. Wholesale plan. Wholesale plan. Direct wage cost or direct employee cost is equal to basic wage T into R plus 50% of time saved into R. Time saved into R. Set T, working time 15 hours into hourly rate is 5 rupees plus 50% of time saved. Time saved here, time saved equal to 5 hours into hourly rate 5 rupees. So 75. So 2.5 hours into 5. 2.5 hours into 5. 2.5 into 5. 12.5. So final earnings 87.5, sir. So total earnings under wholesale plan 87.5. So direct wage cost per piece equal to 87.5 divided by one piece. That is equal to 87.5. Please observe, sir, compare with piece rate per piece. Here piece rate per piece 100 and wholesale per piece cost 87.5. So therefore savings per piece according to wholesale 12.5, sir. So one thing is clear, sir. Piece rate system is very costly to the company compared to wholesale and row 1. Okay. Now working notes completed, sir. Now factory cost under these three systems. So compare to statement of factory cost. Compare to statement of factory cost. So first plan, row 1 plan. Next plan, wholesale plan. Next plan, piece rate system. Piece rate system. Material cost incurred for this work. Direct material cost incurred for this work 50 rupees. 50. Direct wage cost incurred for this work under row 1 plan. Direct wage cost incurred for this work equal to 93.75. Under wholesale plan 87.5. Under piece set system, number of pieces produced into piece set per piece. Here number of pieces produced one piece into piece set per piece 100 rupees. 1 into 100, 100 rupees. So prime cost 93.75 plus 50. 143.75. Next 50 plus 87.5. 137.5. Next 150. Add absorbed factory overheads. Absorbed factory overheads charged. Here rate given in the problem, sir. Here rate equal to 100% of wages. That is 100% of wages. Sir, here wage cost incurred under row 1 plan 93.75. So actual wage cost incurred into rate. Here actual wage cost incurred 93.75, rate 100%, therefore 93.75. Next, actual wage cost incurred under wholesale plan 87.5 into rate 100%, 87.5. 87.5. Next, 100 rupees. 100 rupees. So finally, factory cost. Factory cost. Factory cost. So factory cost 93.75 plus 143.75 is equal to 237.5. 237.5. Next to 137.5 plus 87.5 is equal to 225. Next 250. So this is the problem set. Okay, right. So here two formulas are very important, sir. Effective rate of earnings per hour. Effective rate of earnings per hour equal to total earnings of a worker. Total earnings of a worker divided by T. So in this problem, total earnings of a worker according to row 1 93.75, sir. So 93.75 divided by working time equal to 15 hours. 15 hours. So effective rate per hour equal to 93.75 divided by 15 is equal to 6.25 per hour. Normal rate per hour 5 rupees, but effective rate per hour 6.25. So sometimes question is asking calculate effective rate of earnings per hour. Effective rate of earnings per hour equal to total earnings of a worker divided by T. Okay. Now I am going to discuss next topic, labor turnover rate. Labor turnover rate. What is the meaning of labor turnover? In simple words, changes in composition labor force. Changes in composition labor force is nothing but labor turnover. If changes increases, labor turnover rate increases. Ultimately productivity decreases. That affects employee cost per piece increases. Employee cost per piece increases. For example, workers at the beginning of the period, 10 employees. Out of 10, 2 members, 1 member left, 1 member discharged. Number of workers left undischarged. 2 employees. 1 employee left, 1 employee discharged. Number of workers left and discharged 2 employees. That is calling as separations. Next, number of workers recruited on account of existing vacancies. that is calling as number of replacements during the period. Number of replacements during the period. So this period is December month, sir. December month. So workers at the beginning of the period during the month of December, 10 employees. Number of workers left and discharged during the month of December, 2 employees. Workers recruited on account of existing vacancies, that is the number of replacements during the month of December, 2 employees. 2 employees. Next, number of new recruits. Number of new recruits, 2 employees. Now, workers at the end of the period equal to, workers at the end of the period equal to, end of the period equal to. Workers at the end of the period, how to calculate, sir? Workers at the beginning of the period minus separations plus replacements plus new recruits. So, workers at the beginning of the period 10 minus separations 2 plus replacements 2 plus new recruits 2. So, equal to 12 employees. 12 employees. So, this is the formula. Workers at the end of the period equal to workers at the beginning of the period minus separations plus replacements plus new recruits. 12 employees. 12 employees. Right. Average number of workers, average number of workers during the month of December. Workers at the beginning of the period 10, workers at the end of the period 12 divided by 2 equal to 11 employees. So, here clearly says, here changes occurred in composition of labor force. What are the changes? 2 members left and discharged, 2 members recruited on account of existing vacancies, and 2 members freshers. So, this is the changes in the composition of labor force. So, that is expressed in rate, that is the labor turnover rate. Labor turnover rate. Labor turnover rate or employee turnover rate. Employee turnover rate. Employee turnover rate. So, what are the changes? 2 members separations, that means left and discharge. 2 members recruited on account of existing vacancies. 2 members new recruits. Divide by average number of workers on roll during the period of December, 11 members. So, into 100. 6 divided by 11 into 100. That is equal to 54.54%. 54.54% approximately. So, this is in this period separations, replacements and new recruits. So, this is employee turnover rate under separation, replacements and new recruits. This is calling as flux 2 method. This is calling as flux 2 method. Flux 2 method. Under flux 2 method, LTR equal to number of separations, number of replacements, number of new recruits, divided by average number of workers into 100. So, 54.54. So, changes increases, that is changes in the composition of labor force increases. LTR also increases, labor turnover rate also increases. Changes in the composition of labor force increase, labor turnover rate also increases. Output levels output levels decrease. Suppose if workers output levels decrease, employee cost per piece, employee cost per piece, employee cost per piece, employee cost per piece increases, employee cost per piece increase, that is negative sign to the company. Suppose changes decrease, LTR decrease, output levels increase, employee cost per piece decrease. So, main motive to control the changes in the composition of labor force. Ultimately, labor turnover rate decreases. So, labor turnover rate decreases, ultimately output levels increase. Output levels increase, employee cost per piece decrease. That is the main objective of this chapter. So, it is the good sign. It is a good sign. Good sign. But in this organization, in this example, labor turnover rate, here separations 2 employees, replacements 2 employees, new recruits 2 employees. So, changes in the composition of labor force rate equal to 54.54%. Out of that, separation percentage how much, replacements percentage how much, new recruits percentage how much. So, sometimes question is asking, please calculate separations percentage, replacements percentage, new recruits percentage. So, separations percentage 2 by 11 into 100. That means under separation method, labor turnover rate percentage is equal to number of separations divided by average number of workers into 100. So, 2 by 11 into 100, 2 divided by 11 into 100 is equal to 18.18%. Next, replacements method. Under replacements method, number of replacements divided by average number of workers into 100. So, 18.18%. 18.18%. Next, new recruits 2 by 11 into 100. So, 18.18%. So, finally, summation 18.18 into 3. 54.54% tallied. So, in the examination question is asking employee turnover rate or labor turnover rate separation percentage, labor turnover rate replacements percentage, labor turnover rate new recruits percentage. So, these three collectively is calling a flux 2 method. So, sometimes question is asking employee turnover rate separations and replacements percentage. So, separations and replacements percentage. So, LTR under separations and replacements, LTR under separations and replacements method. This is also calling as flux 1 method. This is also calling as flux 1 method. So, flux 1 method equal to number of separations plus number of replacements divided by average number of workers into 100. So, number of separations to 2 sir, number of replacements 2 sir, average number of workers 11 sir into 100. So, 4 by 11 into 100 sir, 4 divided by 11 into 100 is equal to 36.36%. So, here 18.18. So, finally 36.36%. Sometimes question is asking these two summation, that means replacements and new recruits. Replacements and new recruits. Replacements and new recruits. Replacements and new recruits method. This is also calling as total joinings method. That is also calling as accessions method. So, under accessions method, under total joinings method, formula LTR equal to number of replacements plus number of new recruits divided by average number of workers into 100. So here number of replacements 2 sir, number of new recruits 2 sir, average number of workers 11 sir into 100. So 4 by 11 into 100, 36.36%. So finally LTR percentages, LTR rates under separation method, next under replacement method, next third one under new recruits method, next 1 and 2 sir, 1 and 2 is nothing but under flux 1 method, next to 1 and 2 and 3, that is under flux 2 method, 2 and 3 sir under accessions method, So these are the 6 methods. This is the brief introduction for employee turnover. Now take the problem. Assignment 15 sir. Assignment 15. Right. From the following information, calculate employee turnover rate. Separation method, replacement method, new recruitment method, flux method. That means flux 2. Flux method implied meaning flux 2. So, your number of workers on 1st January 2019, 3,600. Number of workers on 31st December 2019. So, 1 year period, sir. 1 year period. So, workers at the beginning of the period 3,600, workers at the end of the period 3,790. So, changes occurred. So, that means employee turnover occurred. So, please calculate the rates: separation method percentage, replacement method percentage, new recruitment method percentage, flux method percentage. Flux method means flux 2. Right. During the year, 40 workers left, 120 workers were discharged. So, separations during this period. Separations. 120 plus 40, 160. 160 employees or 160 workers. 350 workers were recruited during the year. So, total joinings or number of accessions equal to 350. Of these, out of 350, 150 workers were recruited because of exits. So, number of replacements number of replacements equal to 150. Number of replacements equal to 150. Number of replacements equal to 150. Next, number of new recruits. Rest of the people, number of new recruits. So 350 minus 150, 200, sir. 200. Okay. Data ready. Under separation method, formula number of separations divided by average number of workers. Here average number of workers 3600 plus 3790 divided by 2. So 3695. 3695. So separation method, sir. Workers left and discharge. So that is the separations 160 divided by average number of workers into 100. Into 100. So finally 160 divided by 3695 into 100, 4.33%. Replacement method, number of workers replaced divided by average number of workers into 100. Here number of workers replaced, sir. Here number of workers replaced. Number of replacements 150, sir. 150 divided by average number of workers 3695 into 100, 4.06. Next, the new recruits, sir. Here number of new recruits equal to 200, sir. 200 divided by 3695 into 100, 5.41%. Flux method, sir. So flux method. Here questionnaire mentioned flux 1, sir. But my advice, please do the flux 2 method, sir. Please do the flux 2 method. So flux 2 method, number of separations 160, number of accessions, number of, okay, this is also flux 2 method, sir. Very good, very good. So number of accessions means number of replacements and number of new recruits. So here adjusted, sir, number of separations plus number of replacements plus number of new recruits, nothing but number of accessions. Okay. So 160 plus 350 divided by, so average number of workers. Very good, 13.80. So these three are at 4.33 plus 4.06 plus 5.41 equal to 13.80. 80. So that is the proof, sir. Okay. So this is the employee turnover rate. Now, next, overheads cost controlling. Sir, in cost accounting, estimated overhead cost, that is also called as absorbed overhead cost. Absorbed overhead cost. In cost accounting, estimated overhead costs or absorbed overhead costs charged. Estimated overhead cost or absorbed overhead cost charged to a specific job. Charged to a specific job. But in financial accounting, actual overhead cost charged to a specific job. So absorbed overhead cost charged to a specific job, sir. In cost accounting, estimated overhead cost or absorbed overhead cost charged to a specific job. But in financial accounting, actual overhead cost charged to a specific job, so that it may arise or over absorbed overhead cost. Sometimes actual overhead cost is more than the estimated overhead cost. That is calling as under absorbed overhead cost or unabsorbed overhead cost. Unabsorbed or under absorbed overhead cost equal to actual overhead cost minus absorbed overhead cost. So suppose estimated overhead cost equal to 10,000, but actual overhead cost incurred equal to 12,000. So extra overhead cost incurred equal to 2,000. That extra overhead cost is called as under absorbed overhead cost, simply unabsorbed overhead cost. Sometimes estimations are more than the actuals, that is called over absorbed overhead cost. Over absorbed overhead cost. Over absorbed overhead cost equal to absorbed overhead cost or estimated overhead cost minus actual overhead cost. So in the examination, questioner is asking calculate under or over absorbed overheads and also give the treatment in cost accounting. So procedure for calculating the under or over absorbed overheads. Procedure. How to calculate under or over absorbed overheads and give the treatment. Step 1. First step, calculate overhead recovery rate per hour. Overhead recovery rate per hour or overhead absorption rate per hour. Calculate overhead recovery rate per hour or overhead absorption rate per hour. So this can be calculated from experience data or budgeting data. Sometimes budgeting data provided, sometimes experience data provided. Then calculate overhead recovery rate. Sir, overhead recovery rate means estimation of overhead amount for 1 hour. So first we have to estimate the overhead cost for 1 hour, sir. 1 hour direct labor force working in the factory, how much amount of estimated factory overhead? 1 hour direct labor force working in the factory, then calculate estimated overhead amount. So overhead recovery rate per hour, that means estimated overhead cost for 1 hour. So first we have to calculate estimated overhead cost for 1 hour. So estimated overhead cost for 1 hour. So this can be calculated either from experience data or from budgeting data. So formula, overhead recovery rate per hour from experience data, EOH by working hours. Sometimes budgeting information provided. In that case, budgeted factory overhead cost, simply budgeted overhead cost. Budgeted factory overhead cost, simply budgeted overhead cost divided by budgeted working hours. Suppose EOH amount 1 lakh, sir. Working hours 10,000 hours, sir. Equal to 10 rupees per hour. So that means 1 hour direct labor force working in the factory, 1 hour direct labor force working in the factory, 1 hour direct labor force working in the factory, estimated overhead amount equal to, estimated factory overhead amount equal to 10 rupees. 1 hour direct labor force working in the factory, estimated overhead amount equal to 10 rupees. So that means first of all we have to calculate estimated overhead cost for 1 hour. Here estimated overhead cost for 1 hour equal to 10 rupees. 10 rupees. Step 2. Step 2. Calculate estimated overhead cost by using the following formula. By using the following formula. By using the following formula. Estimated overhead cost or absorbed overhead cost. Absorbed overhead cost is equal to actual hours worked during the period, actual hours worked during the period or actual hours worked for a specific job into actual hours worked during a period or actual hours worked for a specific job into overhead recovery rate per hour. Sir, here actual hours worked during a period 10,000 hours, sir. 10,000 hours. Overhead recovery per hour 10 rupees, sir. So therefore estimated overhead cost for 10,000 hours equal to 1 lakh. 1 lakh. Next, step 3. Calculate actual overhead cost incurred. Actual overhead cost incurred. So here actual overhead cost incurred equal to, here actual overhead cost incurred equal to, here actual overhead cost incurred equal to 1,20,000. So here actual overhead cost incurred 1,20,000, but estimated overhead amount equal to 1 lakh. So that is calling as under absorbed overhead cost, simply calling as unabsorbed overhead cost. Here actuals are more than the estimations. Here actual overhead cost is more than the estimated overhead cost, that is called as under absorbed overhead cost. So next to step 4, determination of under absorbed overhead cost. Determination of under absorbed overhead cost. So under absorbed overhead cost simply calling as unabsorbed overhead cost. Unabsorbed overhead cost. Unabsorbed overhead cost is equal to actual overhead cost minus absorbed or estimated overhead cost. Here actual overhead cost incurred 1,20,000. 1,20,000. Next, absorbed overhead cost equal to 1 lakh. So therefore 20,000 rupees. 20,000 rupees. Now investigating the reasons. So that is the next step. Step 5. Investigating the reasons. Reasons for unabsorbed overheads. Unabsorbed overhead cost. Reasons for unabsorbed overhead cost. A. Sir, 40% due to factory inefficiency, sir. So, due to factory inefficiency, 40% of 20,000 is equal to 8,000 rupees. Sir, is it abnormal or normal, sir? That is abnormal, sir. That is factory inefficiency, internal effect. So, due to factory inefficiency means due to employee inefficiency, 8,000 extra overhead cost incurred, sir. Next, B point. Due to increase in overhead rates, that means increase in indirect material rates, increase in indirect labor rates, increase in indirect expenses rates, simply calling as due to increase in overhead rates. Is it normal or abnormal, sir? This is normal. This is normal. This is abnormal. So, 60% of 20,000 equal to 12,000. So, reasons for under-absorbed overhead cost. Due to factory inefficiency, 8,000. Due to increase in overhead rates, 12,000. So, factory inefficiency shall be treated as abnormal. Increase in overhead rates shall be treated as normal. Now, treatment in cost accounting. Step 6. Treatment in cost accounting. Treatment in cost accounting. Treatment in cost accounting. A. Here unabsorbed overhead amount due to factory inefficiency 8,000, sir. Unabsorbed overhead cost of 8,000 rupees. Unabsorbed overhead cost of 8,000 rupees on account of factory inefficiency. On account of factory inefficiency shall be treated as abnormal. Shall be treated as abnormal and thus be charged to costing profit and loss account. So, journal entry, sir. Journal entry. Costing profit and loss account debit to factory overhead control account or overhead control account. So, excess debit balance cancelled. That means credit the overhead control account. So, excess debit please cancel, sir. Treatment credit the overhead control account. So, 8,000 rupees. Ultimately, cost records profits decreased by 8,000 rupees as per this entry. Next, B points. Balance under absorbed overhead amount. Balance unabsorbed overhead cost. 12,000 rupees due to increase in overhead rates. due to increase in overhead rates shall be charged to customer. Customer means produced units. Shall be charged to produced units. Shall be charged to produced units by using supplementary overhead recovery rate per unit. So this is calling as supplementary overhead recovery rate per unit. Second time charge is called as supplementary charge. So here balance unabsorbed overhead cost 12,000 rupees due to increase in overhead rates shall be charged to produced units by using supplementary overhead recovery rate per unit. Here production details, sir. Production details available in the problem. Units sold 10,000 units, sir. Next, units in stock. So that is the finished stock. Finished stock units 1,000 units. 1,000 units. Equivalent work in progress 1,000 units. So cost of work in progress units converted into equalize. Suppose 2,000 work in progress units, 50% completed. So 2,000 units, 50% completed. For this cost amount, number of units fully completed, sir, 1,000 units fully completed. That is called as equivalent work in progress units. Okay. Now supplementary overhead recovery rate per unit. Supplementary overhead recovery rate per unit is equal balance unabsorbed overhead amount. Balance unabsorbed overhead amount. Balance unabsorbed overhead cost divided by equivalent units produced. Equivalent units produced. Balance unabsorbed overhead amount 12,000 rupees divided by equivalent to units produced 12,000 units. 12,000 units. Therefore, 1 rupee per unit. 1 rupee per unit. So this is the supplementary overhead recovery rate per unit. So second time charge is nothing but supplementary charge. Now, how much amount charged to cost of sales account, sir? Amount charged to cost of sales account. Amount charged to cost of sales account. That equal to amount charged to cost of sales account equal to. Here cost of sales units 10,000 units, sir. 10,000 units. Supplementary charge per unit, sir, 1 rupee. Therefore, amount charged to cost of sales account 10,000 rupees. 10,000 rupees. Next, amount charged to finished stock account. Finished stock account. So amount charged to finished stock account. Here finished stock units 1,000 units, sir. Second time charge each unit 1 rupee, sir. Therefore amount charged to finished stock account 1,000 rupees. Ultimately finished stock value increased by 1,000 rupees. Next, amount charged to amount charged to work in progress account. Work in progress account. Here work in progress equivalent units, sir, 1000 units. 1000 units. So supplementary charge 1 rupee. So per unit, therefore 1000 rupees. So now journal entry, sir. Now take the journal entry. Journal entry. Sir, cost of sales account debit. Cost of sales account debit 10,000 rupees. Finished stock control account debit. Finished stock control account debit 1000 rupees. Work in progress control account debit. Work in progress control account debit 1000 rupees. 2. Factory overhead control account. Simply overhead control account is equal 12,000 rupees. So this is the procedure for determination of under or over absorbed overheads and also pass the journal entries. Okay, see the problem, sir. Take the problem, sir. Assignment 10. Assignment 9, assignment 10. Right. Assignment 10. In a manufacturing unit, factory overheads was recovered. So that is the estimated at a predetermined rate. Step 1 that is at 25 rupees per man day. 25 rupees per man day. The total factory overhead expenses incurred is equal to 41,50,000. 41,50,000. So actual man days worked 1,50,000 man days. Okay. Here step 1 ready, sir. Step 1 overhead recovery rate per hour, per man days, per man day, per man day is equal to 25 rupees, sir. 25 rupees. See, right. So 25, sir. Actual working days 1.5 lakhs man days. 1,50,000 into 25. So 37 lakhs absorbed overhead cost equal to absorbed overhead cost 1,50,000 man days into 25, 37 lakhs 50,000. But actually incurred 41,50,000, sir. So here actual overhead cost actual overhead cost is more than absorbed overhead cost. So 41,50,000 minus 37,50,000. Sir, 4 lakhs, sir. 4 lakhs. 4 lakhs. Unabsorbed overhead cost 4 lakhs. Right, start the investigation, sir. It was found that 60% of the unabsorbed overheads was due to defective planning. So 60% amount, sir. 60% of 4 lakhs, 2 lakhs 40,000, sir. Remaining 40% due to increase in overhead rates, sir. 1,60,000, sir. Now treatment for 2 lakhs 40, that is abnormal, sir. So unabsorbed overhead amount of 2,40,000 on account of defective planning shall be treated as abnormal and thus be charged to costing profit and loss account. Entry costing profit and loss account debit to overhead control account 2,40,000. Okay. Next, balance unabsorbed overhead amount 1,60,000, sir, due to increase in overhead rates, sir. So shall be charged to units produced. Here units produced, sir, 40,000 units produced, sir. 30,000 sold, 10,000 in stock. So finally 40,000 units produced, sir. So 1,60,000 divided by 40,000 is equal to 4 rupees per unit supplementary rate, sir. Supplementary order rate 4 rupees. Then how much amount charged to cost of sales account, sir? 30,000 into 4, 30,000 into 4, 30,000 into 4 equal to 1,20,000. 1,20,000. So amount charged to cost of sales account 1,20,000. Amount charged to finished stock account, sir. So 10,000 into 4, 10,000 into 4. So that is the 40,000. So therefore journal entry equal to cost of sales account debit 1,20,000. Next finished stock control account debit 40,000 to overhead control account 1,60,000. So this is the treatment in cost accounting, sir. So first model completed, sir. So we'll continue next class, right? This is the factory premises, sir. Factory premises. Production department P1, production department P2. Service department 1, service department 2. Direct material cost 10 rupees. Direct wage cost 10 rupees. Indirect material cost 10 rupees. Indirect wage cost 10 rupees. In P2 department, direct material cost 20 rupees, direct wage cost 20 rupees, indirect material cost 20 rupees, indirect wage cost 20 rupees. 20 rupees. Okay, right. So this is the 1 day experience, sir. 1 day experience, sir. 1 day working hours, sir. Working hours of each department 8 hours, sir. Here S1 department, sir. S1 department direct material cost 10 rupees. Direct wage cost 10 rupees. Indirect material cost 10 rupees. Indirect wage cost 10 rupees. Direct material cost 20 rupees. Direct wage cost 20 rupees. Indirect material cost 20 rupees. Indirect wage cost 20 rupees. Next. So above data, individual items. Now common expenses. Lighting expenses, lighting charges 100 rupees, lighting charges 100 rupees, P1 light points 20, P2 light points 20, S1 light points 20, S2 light points 20. Now question is asking calculate overhead recovery rate per hour of each production department. Question is asking calculate overhead recovery rate per hour of each production department. Sir, each production department, P1 department EOH by working hours. Working hours 8 hours, sir. Then calculate EOH amount. In P2 department, calculate EOH amount divided by working hours. So what is the procedure? First, prepare the primary distribution summary. Primary distribution summary. Primary distribution summary. So statement showing distribution of overheads among production departments and service departments. That is calling as primary distribution summary. Particulars. Basis, ratio, total, production departments, P1, P2, service departments, S1, S2, S1, S2. So, in primary distribution summary, what are the steps involved, sir? Number 1, allocation of overheads. Number 2, apportionment of overheads. Sir, what is the meaning of allocation of overheads? Individual overhead cost elements are directly charged to respective departments, that is called allocation of overheads. Please collect the individual cost elements. First one, direct material cost. Sir, direct material cost of P1 department, it is a part of prime cost, it is not a overhead. Direct material cost of P2 department, it is a part of prime cost, it is not a overhead. Direct material cost of S1 department, it is a overhead, sir. Reason, in service departments there is no production activity, so that whatever expenses incurred in service departments, that should be treated as overheads. Next, S2 department, direct material cost of S2 department, it is a overhead, that is 20. Right. Next, direct wage cost. Direct wage cost. Direct wage cost. Direct wage cost of P1 department, it is a part of prime cost, it is not a overhead. Direct wage cost of P2 department, it is a part of prime cost, it is not a overhead. Next, direct wage cost of S1 department. Direct wage cost of S1 department, it is a overhead, sir, 10 rupees. Direct wage cost of S2 department, that is 20 rupees. That is 20 rupees. 20 rupees. Next, indirect material cost. Indirect material cost of P1 department, 10 rupees. Indirect material cost of P2 department, 20 rupees. Next, indirect material cost of S1 department, 10 rupees. Next, 20 rupees. So, indirect material cost to indirect labor cost to indirect expenses are collectively known as overheads. All indirect cost is calling as overheads. So, directly charge. Next, indirect wage cost. Indirect wage cost of P1 department, it is a overhead, 10 rupees. P2 department, 20. S1, 10. S2, 20. So, this work is calling as allocation of overheads. Allocation of overheads. So, individual overhead cost elements are directly charged to respective departments, that is called allocation of overheads. What next, sir? Apportionment of overheads. Apportionment of overheads means common overhead cost items. Common overhead cost items. Common overhead cost items are distributed on a suitable base. Common overhead cost items are distributed on a suitable base and then charge it to respective departments. And then charge it to respective departments. So here common overhead cost items, sir. One item, lighting charges. So for all departments, lighting charges equal to 100 rupees. Then it is apportioned, it is distributed. So lighting charges distributed on what basis, sir? Light points. Here light points in each department having 20 light points. Therefore, ratio 1:1:1:1. So, lighting expenses are lighting charges. Lighting charges. Lighting charges. Here total, so 20, 20, 60. 60. Lighting charges, so on what basis it is apportioned, sir? Light points. Light points. Light points. Ratio 1:1:1:1. Total amount, sir. Total amount. Sorry. Total amount 100 rupees. So 1/4 of 100 rupees, 25, 25, 25, 25. This work is calling as apportionment of overheads. Common overhead cost item. Common overhead cost item distributed on a suitable base. Common overhead cost elements are distributed on a suitable base and then charged to respective departments. That is called apportionment of overheads. So, allocation work completed, apportionment work completed, then we get total overhead cost of each department. So, total overhead cost of P1 department 45 rupees. Total overhead cost of P2 department 65 rupees. 65 rupees. Okay, right. Next, so 40 plus 25, 65 rupees. Next, 80 plus 25, 105 rupees. So 105 plus 65 plus 65, 105 plus 65 plus 65 plus 45, 280, sir. So 100, 60, 160, 220, 250, 280, correct. So primary distribution completed, sir. Next, second distribution. Second distribution means reapportionment of service department overheads. Reapportionment of service department overheads to production department. Reapportionment of service department overheads to production department is called as secondary distribution. Secondary distribution. Reapportionment of service department overheads to production department is called as secondary distribution. Right. Secondary distribution can be done by way of three methods. Direct method, stepladder method, next reciprocal method. Sir, direct method. Suppose factory having two production departments and two service departments. S1 providing services only P1 and P2. So that means service department providing services only to production departments. Next, S2 providing services only P1 and P2. So no services between the service departments. No services between the service departments. That means service departments providing services only to production departments, that is called as direct method. That is called as direct method. So in this example, S1 department total overhead cost incurred 65 rupees. 65 rupees. That should be incurred for the providing the services to P1 and P2 in equal ratio, 1:1. Next, S2 department providing services cost amount 105. So here also providing services 1:1 ratio. Now secondary distribution summary. Secondary distribution summary. Secondary distribution summary. Secondary distribution summary. Basis, particulars, basis, ratio, total. Next, production departments, P1, P2, service departments, S1, S2. So first we have to collect the totals as per primary distribution. So as per primary distribution, as per primary distribution, total overhead cost of P1 department 45 rupees. P2 department 65 rupees. S1 department 65 rupees. S2 department 105 rupees. So total, grand total 280 rupees. 280 rupees. Now restart the secondary distribution. Reapportionment of service department totals to production departments 65. Reapportionment of service department totals, service department overheads. Reapportionment of service department S1 overheads. Ratio that is available in the problem here 1:1 is to 0:0. That means no relation between service departments, no services between service departments. So here service departments providing services only to production departments. That's why it is called as direct method. 65 into 1/2 sir. 32.5. Here also 32.5. Okay, next. Next, 105. Reapportionment of S2 department overheads. That is given in the problem. 1:1, that is 0:0. 0:0. That means no services between the service departments. 105 into 1/2. 52.5. 52.5 hyphen. So after making the second distribution summary, service department totals becomes 0. This is nil. This is nil. Now estimated overhead cost of P1 department. Estimated overhead cost of P1 department 45 plus 32.5 plus 52.5 is equal to 130. 130. Next 65 plus 32.5 plus 52.5 is equal to 150. Total 280. So EOH cost of P1 department, EOH cost of P2 department ready. Then determine the overhead recoveries. So calculation of overhead recovery rates per hour of each production department. Of each production department. Of each production department. So here production departments, so P1, P2. Particulars. EOH. Here EOH amount equal to 130, 150. B. Working hours. Working hours. Sir, here 1 day experience, sir. 1 day experience means 1 day working hours equal to 8 hours. 8 hours. Here also 8 hours. So each department working hours 8 hours. Now overhead recovery rate per hour A by B 130 divided by 8 16.25 150 divided by 8 18.75. So interpretation, sir, 1 hour direct labor force working in the P1 department, estimated factory overhead amount equal to 16 rupees 25 paisa. 1 hour direct labor force working in the P2 department, estimated factory overhead amount equal to 18.75. So that means in this chapter, first we have to calculate estimated overhead amount per hour, sir. Estimated overhead cost per hour. So estimated overhead cost per hour is calling as overhead recovered per hour. Formula EOH by working hours. So this is the direct method, sir. This is the direct method. Next reciprocal method, sir. P1, P2, S1, S2. S1 providing services to P1, P2 and S2. S2 providing services to P1, P2, S1. So here please observe, sir, there is a cross service between the service departments. There is a cross service between the service departments. So please observe these two diagrams. Here S1 only provider. Here S1 provider and also receiver. S1 provider and also receiver. Okay. S2 also provider and receiver. Right. Suppose P1, P2, S1, S2. S1 providing services to P1 50%, P2 25%, S2 20%. S2 providing services to P1 60%, to P2 30%, to S1 10%. So please observe relation between service departments. So here S1 providing services to S2, S2 receiving from S1 20%, S1 receiving from S2 10%. Okay, right. So please observe the diagram, sir. Is it clear? In reciprocal method, S1 having a dual force, So that means down arrow and up arrow. So total overhead cost of S1 equal to total overhead cost of S1 equal to total overhead cost of S1 equal to cost of providing service plus cost of receiving service cost of providing service plus cost of receiving service. So total overhead cost of S1 equal to cost of providing service value always available in primary distribution summary table. In primary distribution summary table, 65 is the value of providing service available in primary distribution. So 65. Next, cost of receiving service. Here 10% service receiving from S2. So 10% of total overhead cost of S2 department. So that is equal to S1 equal to 65 plus 0.1 S2. So this is the algebraic equation. For S1. Next, total overhead cost of S2 department is equal to cost of providing service plus cost of receiving service. So S2 equal to providing service value available in primary distribution summary table. So this is the primary distribution summary table. Providing service value equal to 105. Plus cost of receiving service. Here S2 receiving service 20% from S1. So 20% service receiving from S1. So 20% of total overhead cost of S1. So S2 equal to 105 plus 0.2 S1. This is equation 2. So these two algebraic equations solved, then we get S1 total overhead cost, S2 total overhead cost. This algebraic method developed by simultaneous person. So that's why it is calling as simultaneous equation method. So under simultaneous equation method, first we have to calculate total overhead cost of each service department and then distribute share. So and in reciprocal method, each service department not only provider but also receiver, that is the dual force, provider and also receiver. So provider and also receiver, provider value available in primary distribution, receiver value available in percentage, so that frame the algebraic equations, solve the algebraic equations, then we get total overhead cost of S1, total overhead cost of S2. This method developed by simultaneous, that's why it is calling as simultaneous equation method. Simultaneous equation method. Simultaneous equation method. So here two algebraic equations ready. S1 equal to 65 plus 0.1 S2. S2 equal to 105 plus 0.2 S1. Solve 1 and 2 equations. Solve 1 and 2 equations. S1 equal to 65 plus 0.1. S2 equations are 105 plus 0.2 S1. 1s1 65 0.1 into 105 0.1 into 105 10.5 plus 0.2 into 0.1 0.02 S1 1s1 minus 0.02 S1 equal to 65 plus 10.5 is equal to 75.5. So 1 minus 0.02 0.98 S1 equal to 75.5. S1 equal to 75.5 divided by 0.98. 75.5 divided by 0.98 is equal to 77.04. 77.04, approximately 77, approximately 77. So therefore total overhead cost of S1 equal to 77 rupees. 77 rupees. 77 rupees. Next, substitute S1 value in equation 2. So equation 2, S2 equal to 105 plus 0.2 S1 77. So 77 into 0.2 plus 105 is equal to 120.4, approximately 120. So total overhead cost of S2 equal to 120. Now distribution of service department overheads to production departments. Distribution of service department overheads to production departments, that is calling as secondary distribution. So here production departments P1, P2, particulars S1 department overheads already calculated. S1 department overhead cost to 77, sir. So out of that 50% P1, 25% P2. So 50%, that is 50% comma 25% of 77. 50% comma 25% of 77. So your S1 department overheads 77, sir. Out of that 50% charged to P1, 25% charged to P2. So 77 into 50%, 38.5. 38.5. 1 minute. Here first gathering the overheads as per primary distribution. As per primary distribution, as per primary distribution values, this is the primary distribution. So as per primary distribution values of P1, P2, 45, 65, 45, 65. Now S1 department overheads distributed to P1, P2. S1 department overhead 77 distributed to P1, P2, 50% to P1, 25% P2. So 50% of 77, 38.5. Next 77 into 25%, 19.25. Next S2 department overheads, that is 60-30, 60%, 30% of S2 department overheads. Here S2 department overheads 120. So 120 into 60%, 72. Next 120 into 30%, 36. So finally we get estimated overhead cost of P1 department, P2 department. So 45 plus 38.5 plus 72 is equal to 155.5. 155.5. Next 65 plus 19.25 plus 36 is equal to 120.25. Now calculate the recovery rates. So calculation of overhead recovery rate per hour. Calculation of overhead recovery rate per hour. P1 department, P2 department, particulars. So formula EOH by working hours, A equal to EOH. So EOHs are calculated under reciprocal method 155.5. 155.5. In P2 department 120.25. 120.25. B working hours. Here 1 day experience, sir. 1 day means here working hours equal to 8 hours each department. 8 hours. A by B equal to overhead recovery rate per hour. A by B. So 155.5 divided by 8 is equal to 19.4375. So that means 1 hour direct labor force working in the factory, estimated factory overhead amount equal to 19.4375. Next 120 divided by 120.25 divided by 8 is equal to 15.03125. So this is the reciprocal method. So direct method completed, reciprocal method completed. So no services between the service departments, that indicates direct method. There is a cross service between the service departments, that indicates reciprocal method. Sir, what is the meaning of step ladder method, sir? Only one side service between the service departments. Here step ladder method. Suppose factory having 2 production departments and 2 service departments. S1 providing services to P1, P2, S2. S2 providing services only P1, P2. So, please observe relation. Only one side service between the service departments. S1 providing services to S2, but S2 not providing services to S1. Another thing is also observed, sir. Here S1 providing services 3 departments. S2 providing services only 2 departments. So that's why one thing is observed, sir. Here S1 department providing services to more departments, so that it should be apportioned first. Which service department providing services? Which service department providing services to more departments, that should be apportioned first. So here S1 providing services to 3 departments, but S2 providing services to 2 departments. So S1 should be apportioned first. Right. Another diagram, sir. P1, P2, S1, S2. P1, P2, S1, S2. Suppose here S2 providing services P1, P2, S1. Next, S1 providing services only P1, P2. So, in this example, S2 providing services 3 departments, S1 providing services 2 departments. So, in this example, S2 providing services to 3 departments, S1 providing services to 2 departments. Which service department providing services to more departments, that should be apportioned first. Another example. Suppose P1, P2, S1, S2, S3, S4. S1 providing services to P1, P2, S2, S3, S4. So, this department providing services 5 departments. So, S1 department providing services to 5 departments. So, that is why it is apportioned first. Next to S2 providing services to 4 departments. S3 providing services to 3 departments. S4 providing services to 2 departments. So, next to down arrow, S2. Sir, once down arrow, then door closed, sir. So, once service providing, then door closed. Right. P1 receiver, P2 receiver, S3 receiver, S4 receiver. So, 2 down arrows, sir, 2 hyphens. Next, S3 providing services to P1, P2, S4. So, 3 down arrows, sir, 3 hyphens. S4 providing services to P1, P2. So, this is the step ladder method. Only one side service between the service departments. Here, there is a logic. Please attach the down arrows. That's why it is calling as step ladder method. Okay. See the problem. Assignment 2. Messrs. NOP Limited has its own power plant and generates its own power. Information regarding power requirements and power used are as follows. Sir, needed capacity production department A 20,000 horsepower, B 25,000 horsepower, service department X 15,000 horsepower, Y 10,000. Used during the quarter ended September 2018. So 16,000 actual working, 16,000, 20,000, 8,000. So this is the budgeted capacity. This is the actual capacity. During the quarter ended September 2018, overhead cost of generating power amounted to 12.6 lakhs, out of which 4.2 lakhs were considered as fixed. Variable part, sir. Variable part, see the printed solution. variable part. So, right. So, variable part to 12.6 minus 4.2, sir. 12.6 minus 4.2 variable overhead cost. So 12.6 minus 4.2 is equal to 8,40,000. 8,40,000. Next, service department X renders services to department A, B and Y. So here A, B, X, Y. Service department X renders services to A, B, Y. Right? Next, there is the ratio 6:4:2. Whereas department Y renders services to AB 4:1 hyphen. So that's why here one side service set. So this is step ladder method. Next, the direct labor hours of department A 67,500 hours, B 48,750 hours. So prepare overhead distribution sheet. So that is the second distribution summary by using step ladder method. Reason, only one side service between the service departments. See the solution. First, variable overheads, sir. Variable overheads 8,40,000. So variable overheads always varies with actual output, sir. So that is our horsepower of hours used. Here horsepower of hours used, sir. Here horsepower of hours used. Horsepower of hours used 16,000, 20,000, 8,000. So horsepower of used. Okay, ratio. Right. Next, fixed overheads. Fixed overheads always depends on the budget capacity. So here budget capacity also mentioned in the problem. 20,000, 25,000, 15,000, 10,000. Okay, right. Next. So use that ratio, divide. Okay. So total overheads 3,60,000, 4,50,000, 2,70,000, 1,80,000. So total overhead cost ready. Total overhead cost ready, sir. Okay. So here fixed overheads ratio, budget capacity ratio 20:25:15:10. 10. So 20 plus 25 plus 15 plus 10. So 70. So here total amount to fixed amount to 4,20,000. 4,20,000 divided by 70 is equal to 6,000. 6,000. So 20,000 into 6,000, 2,40,000. Sorry, 1 minute, sir. Here 20,000 into 6,000, sir. 20,000 into 6,000, 1,20,000. Next 25,000 into 6,000. 25,000 into 6,000, sir. One minute. Here ratio, sir. Here ratio already mentioned. 1 minute. Here ratio 20:25:15:10, sir. That is 20 plus 25 plus 15 plus 10 equal to 70, sir. 70. So 70. Okay. 70. Here fixed overhead amount 4,20,000, sir. 4,20,000 divided by 70. 4,20,000 divided by 70. 4,20,000 divided by 70. Divided by 70 is equal to 6,000, sir. Then apply the ratio. Apply the ratio. 20 is to 25 is to 20 is to 25 is to 15 is to 10. 15 is to 10. 20 is to 25 is to 15 is to 10. So 20 into 6,000, 1,20,000. 25 into 6,000, 1,50,000. Next 15 into 6,000, 90,000. Next 10 into 6,000, 60,000. Same rule apply in variable hours. In variable hours case, horsepower hours used. Horsepower hours used, sir. Okay, right. Next, total overheads ready. Then start here. Service department X providing services to more departments. Therefore, it should be apportioned first. It should be apportioned first. So, it should be apportioned first. 2,70,000. 6 is to 4 is to 2. 1,35,000, 90, 45. So, this becomes hyphen. Next 1,80,000 plus 45, 2,25,000. So, 4 is to 1. 1,80,000, 45. Then EOHs are ready. So, estimated overhead cost of A department 6,75,000, B department 5,85,000. 5,85,000. Okay, right. Next, calculate factory overhead per labor hour for department A and department B. In department A, direct labor hours 67,500 hours. In department B, 48,750. EOH by direct labor hours. EOH by direct labor hours. Here EOH equal to EOH 6,75,000. 6,75,000 divided by direct labor hours. This is A, this is B. A by B equal to 10 rupees. So, in interpretation, sir, 1 hour direct labor force working in the production department A, estimated factory overhead amount equal to 10 rupees. Estimated factory overhead amount equal to 10 rupees. Next, in production department B, total overhead, that is the EOH. That is the EOH. EOH 5,85,000. Direct labor hours 48,750. So, this is 12 rupees. 1 hour direct labor force working in the department B, estimated factory overhead amount equal to 12 rupees. Okay. So, this is the overhead recovery rates under step ladder method. Step ladder method. So, total completed, sir. So, in direct method, next to reciprocal method, step ladder method. In direct method, no services between the service departments. In reciprocal method, there is a cross service between the service departments. In this method, provider and also receiver. So that first we have to calculate total overheads under simultaneous equation method. So first to frame the equations, algebraic equations, then solve. So finally we get total overhead cost of S1 and total overhead cost of S2. Then second distribution start. Then we get the EOH of P1 and EOH of P2. Step ladder method. Only one side service between the service departments. Only one side service between the service departments. It is calling as step ladder method. So completed, sir. Right. Now take the problem, sir. Right. Take assignment 2, sir. Assignment 2. Okay. Assignment 2. Right. The standard cost of a chemical mixer is as follows. 40% metal A at 20 rupees per kg, 60% metal B at 30 rupees per kg. First point, here company uses more than one raw metal item. So in that case, calculate labor mix variance and also labor yield variance. That is the first point. Next, standard mix ratio is equal 40%, 60%. So standard input quantity mix ratio equal to 40%, 60%. Next, standard price per kg of raw material 20 rupees A, 30 rupees B. 20 rupees per kg of A, 30 rupees per kg of B. Okay. Next, standard loss of 10% of input is expected in production. So that means percentage of standard loss, that is the percentage of standard loss, that is the normal loss, equal to 10% of input. The cost records for a period showed the following uses. 90 kgs of metal A at a cost of 18 rupees per kg, 110 kgs of metal B at a cost of 34 rupees per kg. So, actual usage quantity of raw material, actual input quantity usage, actual usage quantity of raw material, actual usage quantity of raw materials equal to 200 kgs. Next, the quantity produced was 182 kgs. So, actual output revealed, sir. Actual output equal to 182 kgs. Actual output equal to 182 kgs. Okay, right. So here table, sir. Particulars. Standards. Ascertainment of standards for actual output. Ascertainment of standards for actual output. Here actual output equal to 182 kgs. 182 kgs. Next, SQ, SP, SQ into SP. SQ means standard quantity required for actual output. SP means standard price per kg of raw material. SQ into SP equal to standard material cost for actual output. Actuals. Ascertainment of actual material cost for actual output. AQ, AP, AQ into AP. Next, AQ into SP. AQ into SP. AQ into SP. AQ into SP. Here two material items are used, namely A, B. A, B. Raw material item A raw material item B. So standard mix of raw materials 60, 40, 60. 40, 60. 40% to 60%. So input equal to 100%. So during the processing time or during the processing loss, standard loss 10%. So output equal to 90%. Output equal to 90%. Right. So here actual output revealed in this period 182 Ks. Actual output revealed 182 Ks. 182 Ks. So 182 Ks. So therefore input required, standard input required for 182 Ks. Standard input required for 182 Ks. Standard input required for 182 Ks equal to 182 divided by 90 into 100. 182 divided by 90 into 100. 182 divided by 90 into 100. So 202.22. 202.22 Ks. Approximately 202 Ks. Approximately 202 Ks. 202 Ks. So here output equal to 182 Ks. So as per standard percentage, output equivalent to 90%. So standard input required for 182 Ks. 182 Ks equivalent to 90%. So therefore 182 divided by 90 into 100, ultimately we get input quantity. So standard input required for 182 Ks equal to 202.22 Ks, approximately 202 Ks. So 202 into 10%, 20.2. So 20.2, approximately 20. Now 202 total input quantity, standard input required for this output equal to, standard input required for this output equal to 202. Out of 202, 40% sharing first item cell, 80.8. Next 202 into 60%, 121.2. 121.2. Okay, right. Right. So next, standard price, sir. Standard price. Standard price per kg of each item A20, B30. 20, 30. 80.8 into 20 rupees. 1616. 121.2 into 30. 3636. 36 plus 36. 3636. 1616 equal to 5252. This is calling as standard material cost for actual output. So as per company experience, as per our experience, so for this output, material work should be completed in 5252. Next, AQ, actual quantity. Actual quantity. Actual quantity consumed for this output equal to 90,110. 90,110. 90 Ks, 110 Ks. So 120 Ks. Sorry, 200 Ks. 200 Ks. 200 Ks. Actual output equal to 182 Ks. So 182, 200 difference 18. So here percentage of standard loss, so 10%, sir, but percentage of actual loss, so 18 divided by 200 into 100 is equal to 9%. So here yield variance favorable, sir. Yield variance favorable. As per company experience, percentage of standard loss equal to 10%, but actually incurring loss equal to 9%. So yield variance favorable, sir. Right. Next, actual price paid per kg of raw material. Actual price paid 1834. 1834. So 90 into 18 is equal to 1620. Next, 110 into 34 is equal to 3740. 3740 plus 1620 is equal to 5360. 5360. Next, AQ into SP, 90 into 20 is equal to 1800. 90 Ks. So that is the standard cost of actual usage quantity. So this is the usage quantity as per previous rates. Usage quantity as per previous rates, A value 1800. Next item 110 into 30 is equal to 3300. 3300. 3300. 3300 plus 1800 is equal to 5100. 5100. So as per previous rates, usage quantity value 5100 plus as per current rates 5360. Therefore, extra paid amount equal to 260. That is called price variance. That is called price variance. So now material cost variance is equal to SQ into SP minus AQ into AP. Standard material cost incurred for this output. So as per company experience, for this output, material work should be completed in 5252. 5252. But actually incurred 5360. 5360. That equal to 5252 minus 5360 is equal to 108. 108 adverse. 108 adverse. Next, material price variance. Material price variance. It is the deviation between standard price per kg of raw material and actual price per kg of raw material at consumed quantity. That equal to AQ into SP, AQ into SP minus AQ into AP. AQ into AP. So here AQ into SP 5100. So usage quantity as per previous rates 5100. Usage quantity as per current rates value 5360. So extra amount paid, sir, 260. 260 adverse. 260 adverse. Next, material usage variance. Is the deviation between standard quantity required and actual quantity consumed at standard price. So, SQ into SP minus AQ into SP. Sir, here SQ into SP 5252. 5252 minus AQ into SP 5100. 5100. Sir, here usage quantity favorable, sir. So 5252 minus 5100 is equal to 152 favorable, sir. So 152 favorable, 260 adverse. So answer 108. 108 adverse. So here material price variance plus material usage variance equal to material cost variance. So material cost variance proved. Next, here more than one raw material item is used, then mix variance exists and yield variance exists. Material mix variance. Metal mix variance. So it is metal mix variance. It is that portion of metal usage variance. Metal mix variance is that portion of metal mix variance. Metal mix variance is that portion of metal yield variance. Sorry, metal usage variance. Material usage variance. Material usage variance. Metal usage variance. Metal mix variance is that portion of metal usage variance. Metal usage variance, which is due to the deviation between deviation between standard mix in actual proportion. Standard mix here usage deviation between actual usage quantity in standard proportion and actual usage quantity in actual proportion with the standard rate. So symbolically metal mix variance equal to actual usage quantity in standard proportion denoted by RSQ. Actual usage quantity in standard proportion and actual usage quantity in actual proportion AQ with the rate standard price SP. So that is equal RSQ into SP minus AQ into SP. So metal usage variance, metal mix variance is that portion of metal usage variance which is due to the deviation between actual usage quantity in standard proportion and actual usage quantity in actual proportion with the standard rate or standard price. That is metal actual usage quantity in standard proportion nothing but RSQ, sir. Actual usage quantity in standard proportion denoted by RSQ, actual usage quantity in actual proportion AQ. So multiply with the standard price. Now calculate the RSQ values. Sir, here actual usage quantity 200 KS. Actual usage quantity 200 KS. Actual usage quantity in standard proportion that is denoted by RSQ. Standard proportion 40% of 200. 40% of 200. 40% of 200, 80 Ks. 60% of 200, 60% of 200, 120 Ks. So this is the actual usage quantity in standard proportion. As per company experience, usage as per standard usage ratio, RSQ value is 80, 120. So value RSQ into SP, RSQ into SP, RSQ into SP. So 80 into 20, 80 into 20, 80 into 20, 1600, 1600. Next 120 into 30, 120 into 30 is equal 3600. So value 3600 plus 1600 is equal 5200. 5200. So now apply the values. RSQ into SP, RSQ into SP, 5200, 5200 minus AQ into SP, AQ into SP, 5100, 5100 is equal 100 rupees favorable, sir. 100 rupees favorable. Next, material yield variance. Material yield variance. Material yield variance, sir. So here for 202 input, 182 case output. For 200 case input, output equal to, for 202, for 202, 182, 182. For 200, for 200, question mark, 182 divided by 202 into 200. So 182 divided by 202 into 200 is equal to 180 approximately. 180. 180. So that is the standard yield for actual usage quantity. Standard yield for actual usage quantity. The standard yield for actual usage quantity. For actual usage quantity equal to 180 Ks. Actual yield for actual usage quantity. For actual usage quantity equal to 182 Ks. So here excess yield, sir. Excess yield equal to 2 Ks. 2 Ks. Excess yield equal to 2 Ks. Excess yield equal to 2 Ks. Then material yield variance is equal to favorable, sir. Material yield variance is equal to favorable. 2 Ks into standard cost for 1 unit output. Standard cost of 1 unit output to, sir, 182 Ks output value 5252. So 5252 divided by 182 is equal 28.2. Standard cost of 1 kg output yield. 1 kg output yield equal to 28.85714. 28.85714. So into 2. So answer 58 approximately. Answer 58 approximately. 58 approximately. So that is favorable. That is favorable. So here usage 152, sir. 1 minute, sir. Due to decimals, answers may be variated, sir. So in another way, metal yield variance equal to formula SQ minus RSQ into SP. SQ into SP minus RSQ into SP. SQ into SP, SQ into SP, 5252. 5252. Minus RSQ into SP, 5200. 5200. 5200. This is equal 52 favorable. So here due to decimals in this model due to decimals answers may be variated. Reason here 202 182. So 182 divided by 202 into 200, that is equal to 180.2 1980. 1980. So 180.1980, but approximately 180. So 0.1980. Due to decimals answers may be variated. Suppose 180.1980, in that case excess yield equal to 1.80198 into 28.85714, that is equal to 52 answer. So due to decimals answers may be deviated. Suppose in this case original value 180.1980, 180.1980, 1980. In that case excess yield equal to not 2 case 180.1980 minus 182 is equal to 1.802. So 1.802 into 28.85714, so equal to 52. In that case that is 52. So due to round offs answers may be deviated. So in this model answers may be varied. If you take full decimals, answer will be 52. Answers will be 52. Okay, right. So second alternative is very easy. So metal yield variance equal to SQ minus RSQ of SP. SQ into SP minus RSQ into SP. Therefore 52 favorable. So this is the material yield variance. Material yield variance. Next one. Next one. Assignment 9, sir. Assignment 9. Assignment 9. The standard labor employment and the actual labor engaged in a week for a job are as under. So, standard number of workers in the gang, 25 skilled workers, 25 semi-skilled workers, 15 unskilled workers. Here one thing is observed, here company employing with more than one grade of workers. Therefore, here labor mix and labor yield also exists, sir. So, here 5 variances are calculated, sir. Next, the actual number of workers employed, 30 skilled workers, semi-skilled 10, unskilled 10. Sir, total gang contains composition labor force, total composition 25 plus 10 plus 15 is equal to 50. Actual gang force 30 plus 10, 40 equal to 50. Equal to 50. Standard wage rate per hour, actual wage rate per hour. Standard wage rate per hour, SR, actual wage rate per hour, AR. Actual wage rate per hour, AR. Okay. Next, percentage of standard labor mix. 25 divided by 50. So 50%, sir. So 10 divided by 50. 10 divided by 50 into 100. 20%, sir. 15 divided by 50 into 100. Into 100 equal to 6%. 1 minute, sir. So 10 divided by 50 into 100, 20%. Next, 15 divided by 50 into 100, 30%. Next, actual labor mixer, 30 divided by 50 into 100, 60%. 10 divided by 50, 20%. 20%. Here one thing you observed, percentage of standard labor mix is not equal to percentage of actual labor mix. If percentage of standard labor mix is not equal to percentage of actual labor mix, then labor mix variance exists. Labor mix variance exists. Right. During the 35 hours working week, that means available working hours in a week per worker equal to 35 hours. Available working hours in a week per worker equal to 35 hours. Next, the gang produced 2000 standard labor hours of work. So, given output equivalent to 2000 hours, sir. So, given actual output. So, here a job means actual output. So, here actual output equivalent to 2000 standard labor hours of work. So, that means standard input hours allowed for a given work or for a given job equal to 2000 hours. 2000 hours. Out of 2000 hours, 50% skilled workers, 20% to semi-skilled workers, 30% to unskilled workers. Okay, right. So, standard input hours allowed for a job equal to 2000 hours. 2000 hours. 2000 hours. 2000 hours. Next, 2000 hours. Particulars. Standards for a job. SH, SR, SH into SR. Next, actuals for a job. AH, AR, AH into AR. Next AH into SR. Here one thing is observed, working hours and paid hours both are same. Working hours and paid hours both are same. Here working hours equal to 50 members, so 35 hours. So actual working hours equal to actual working hours equal to 50 into 40 hours, sir, equal to 2000 hours. Actual paid hours also 2000 hours. Reason, there is no idle time. In this problem, there is no discussion about the idle time. That means idle time equal to 0. So in that case, working hours and paid hours both are same. Working hours and paid hours both are same. Okay. Right. Particulars. Here 3 categories of workers are employed. Skilled workers, semi-skilled workers, next to unskilled workers. So out of total input, skilled workers percentage is 50%, sir. Semi-skilled workers percentage is 20%, sir. Unskilled workers percentage is 30%. 30%. So input. Right. Here standard input hours for this output equal to 2000 hours. 2000 hours. 2000 hours. Standard input hours. The gang produced a job that is equivalent to 2000. That means standard hours allowed for this job equal to 2000 hours. 2000 hours. Right? Okay. So 50% of 2000 hours, sir. 50% of 2000 hours, so 1000 hours. Next, 20% of 2000 hours. 20% of 2000 hours. 400 hours. Next, 30% of 2000 hours. 600 hours. So, standard wage rate. Standard wage rate per hour. Standard wage rate per hour 543. 543. 5000 rupees. 1600. 1800. 400 into 4, sir. 1600. 600 into 3. 1800. 1800 plus 1600 plus 5000. It's equal to 8400. 8400. So that means labor work should be completed in this amount, sir. So as per company experience for this job, labor work should be completed in 8400. But actual incurred, I will find. Just wait, sir. So here 30 members. Here actual working hours and actual paid hours both are same. Am I right? Here actual working hours and actual paid hours both are same because here idle time equal to 0. Okay, right. So 30 members into 35 hours. 30 members, available working hours in a week per worker 35 hours. 30 into 35. is equal 1050 hours. 1050 hours. Next, 10 into 35. 10 into 35, 350 hours. Next, 10 into 35, 350 hours. 350 hours. Okay, 30, 10, 10, 50. So 30 into 35, sir. 30 into 35, 1050. Okay, right. Sir, here a small mistake. Here weekly working hours not 40, sir. Your weekly working hours equal to 35 hours. 35 hours. 35 hours. So 15 to 35 hours. 1750. 1750 hours. Now here 1050 plus 350 plus 350 is equal to 1750. Right. 1750 hours. Right. Actual wage rate per hour. Your actual wage rate per hour equal to 674. 674. 674. 1050 into 1050 into 6 is equal to 6300. Next, 350 into 7 is equal to 2450. Next, 350 into 4 is equal to 1400. So 1400 plus 2450 plus 6300 is equal to 10,150, sir. 10,150. But our experience, this work should be completed in 8,400, but actually incurred 10,150. So therefore, extra labor cost incurred equal to 1750. 1750. Next, here paid hours as per previous rates. Here AH means paid hours and also working hours. Here paid hours and working hours both are same. So paid hours as per previous rates, that is calling as AH into SR, that is the standard cost of actual paid hours. So 1050 into as per previous rates into 5 is equal to 5250. 5250. Next, 350 into 4, 1400. 350 into 4, 1400. Next, 350 into 3 is equal to 1050. 1050. So 1050, 1400, 5250 is equal to 7700. 7700. So this is the AH into SR. Next, labor cost variance equal to SH into SR minus AH into AR. That is standard labor cost for actual output and actual labor cost for actual output. So 8,400 as per our experience, but actually incurred 10,150. So 10,150 minus 8,400 is equal to 1,750 adverse. 1750 adverse. Labor rate variance. So standard wage rate per hour and actual wage rate per hour at paid hours, AH. So AH into SR minus AH into AR. So paid hours as per previous rates value, paid hours as per previous rates 7,700. Paid hours as per current rates 10,150. 10,150 is equal 10,150 minus 7700 is equal to 2450 adverse. Next, labor efficiency variance. Labor efficiency variance, it is the deviation between standard hours allowed and actual working hours. It is the deviation between allowed time and working time of SR. So that is the SH into SR minus AH into SR. AH into SR. So SH into SR is equal to 8,400 minus AH into SR 7,700 is equal to 8,400 minus 7,700 is equal to 700 favorable, sir. So finally rate plus efficiency equal to cost. Please check 2450 minus 700. Correct, sir. 1750. Next, labor mix variance. It is the deviation between actual working hours in standard proportion, actual working hours in standard proportion, Next, actual working hours in actual proportion of SR. So symbolically, actual working hours in standard proportion is nothing but RSH minus AH of SR. That equal to RSH into SR minus AH into SR. Sir, here RSH values. Here 1750. Actual working hours. Actual working hours in standard proportion is 50, 20, 30. So 1750 into 50%. 875 hours. 1750 into 20%. 350. Next 1750 into 30%. 525. 525 plus 350 plus 875 is equal to 1750. RSH into SR. So 875 into SR 5 rupees is equal to 4375. Next 350 into 4 is equal to 1400. Next 525 into 3 is equal to 1575. So 1575. 1575 plus 1400 plus 4375 is equal to 7350. So here 7350 minus AH into SR. 7700. 7700 is equal to 350 adverse. Next, labor yield variance. Shortcut formula SH minus RSH of SR. SH into SR minus RSH into SR. SH into SR 8400 minus RSH into SR 7350. So 8400 minus 7350 is equal to 1050 favorable. 1050 favorable to 350 adverse. 700 labor efficiency wins. Tally, sir. Tally. So this is the labor variances. Next to overhead variances. Overhead cost variances. Sir, already discussed, sir, overhead cost variance at the time of introduction. Absorbed or applied, absorbed overhead cost or applied overhead cost or estimated overhead cost or recovered overhead cost, all are same. So absorbed overhead cost minus actual overhead cost. Actual overhead cost. So overhead cost variance certain portion, variable overhead cost variance, variable overhead cost variance, fixed overhead cost variance, fixed overhead cost variance, variable overhead cost variance, fixed overhead cost variance. In variable overhead cost variance, absorbed VOH cost, minus actual VOH cost, actual VOH cost. Fixed overhead cost variance, absorbed fixed overhead cost minus actual fixed overhead cost. So here procedure, step 1 calculate the rate, sir. Step 2 calculate the absorbed overhead cost. Step 3 actual overhead cost. Actual overhead cost directly given in the problem. So then calculate the variance. So step 1 rate calculation, step 2 absorbed overhead cost, step 3 actual overhead cost that is directly available in the problem. Step 4 variance. So this is the procedure. So overhead cost variance, VOH cost variance certain portion, FOH cost variance certain. VOH cost variance is that portion of total overhead cost variance which is due to the deviation between absorbed overhead cost and actual overhead cost. So formula is same, absorbed minus actual. So just the terminology little bit change. So in case of total overhead cost variance, absorbed total overhead cost minus actual total overhead cost. In case of variable overhead cost variance, absorbed VOH cost minus actual VOH cost. In case of fixed overhead cost variance, absorbed FOH cost. In case of fixed overhead cost variance, absorbed FOH cost minus actual FOH cost. Okay. Now I'm going to discuss overhead cost variances. Right. XYZ Limited has furnished you the following information for the month of August 2019. Budgeted output 30,000 units. Actual output 32,500 units. Budgeted hours 30,000 hours. Actual hours 33,000 hours. Budgeted fixed overhead cost 45,000. Actual fixed overhead cost 50,000. Budget variable overhead cost 60,000. Actual variable overhead cost 68,000. Next, budget working days 25 days. Actual working days 26 days. Calculate VOH cost variance, VOH expenditure variance, VOH efficiency variance, FOH cost variance, FOH volume variance. Suppose calculate total overhead cost variance. First bit. Total overhead cost variance. Total overhead cost variance. So assignment 12. Assignment 12. Total overhead cost variance. First, rate calculation. Total overhead recovery rate per unit. Total overhead recovery rate per unit is equal to EOH by budget output. Budget output. EOH value. So this is the budget overhead cost 1,05,000. 1,05,000. Budget output to 30,000 units. 30,000 units. 1,05,000 divided by 30,000 units is equal to 3.5 per unit. 3.5 per unit. 3.5 per unit. Now calculate the absorbed overhead cost, absorbed total overhead cost. First point, absorbed total overhead cost. Absorbed total overhead cost. Absorbed total overhead cost equal to actual output into overhead recovery rate per unit. So estimated total overhead cost on output basis formula, actual output into overhead recovery rate per unit. Your actual output equal to 32,500. 32,500 into overhead recovery rate per unit 3.5. 3.5. So 32,500 into 3.5. 3.5 is equal to 1,13,750. 1,13,750. That is the absorbed total overhead cost. Next, actual total overhead cost. Actual total overhead cost incurred. Actual total overhead cost incurred is equal to, that is directly available in the problem. So 50 plus 68. 50 plus 68 is equal to 118. 118. So 1,18,000. So therefore, total overhead cost variance equal to total overhead cost variance equal to absorbed total overhead cost, absorbed total overhead cost minus actual total overhead cost. So here absorbed total overhead cost equal to 1,13,750, 1,18,000 actual total overhead cost. So 1,13,750 minus 1,18,000 is equal to 4,250. Is equal to 4,250. 4,250 adverse. 4,250 adverse. This is the total overhead cost variance. Same procedure will be followed in case of variable overhead cost variance and fixed overhead cost variance. In case of variable overhead cost variance, procedure number 1, rate POH recovery rate per unit, in brackets that is denoted by SR. Budget VOH cost divided by budget output. Budget VOH cost. Here budget VOH cost equal to 60,000 rupees. 60,000 rupees. Budget output equal to 30,000 units. So 60,000 divided by 30,000. 60,000 divided by 30,000 equal to 2 rupees per unit. 2 rupees per unit. 2 rupees per unit. 2 rupees per unit. Now calculate number 1. Absorbed VOH cost. Same formula, actual output into VOH recovery rate per unit. VOH recovery rate per unit. Actual output Their actual output equal to 32,500 units. 32,500 units into VOH recorded per unit. VOH recorded per unit equal to 2 rupees. That equal to 32,500 into 2. It's equal to 65,000 rupees. Equal to 65,000 rupees. Next, number 2. Standard VOH cost. Standard VOH cost. Standard VOH cost. Standard VOH cost. Standard VOH cost equal to standard cost for standard VOH cost for actual output. Standard output for actual hours. Standard output for actual hours into SR. Here actual working hours equal to 33,000 hours. As per company budgeting information, 1 unit time equal to 1 hour. 1 unit time equal to 1 hour. Budget output divided by budget hours. Sorry, budget hours by budget output. Budget hours by budget output. Standard time allowed for 1 unit equal to budget hours by budget output. That is equal to 30,000 divided by 30,000, 1 hour. So 30,000 units. 30,000 units time allowed equal to 30,000 hours. So as per budgeting information, 30,000 units time equal to 30,000 hours. Therefore, 1 unit allowed time equal to 1 hour. So standard time allowed for 1 unit equal to 1 hour. So 33,000 hours actual working hours. So here working hours, actual working hours 33,000 hours. Standard output for actual working hours. As per standards for this working hours, standard output equal to 33,000 hours into 33,000 hours, sir. 1 unit equal to 1 hour, sir. So therefore 33,000 units. Standard output equal to for actual hours. Standard output for actual hours equal to 33,000 units. 33,000 units. Reason 1 unit equal to 1 hour. As per budgeting information, time allowed for 1 unit equal to 1 hour. That means 1 hour equal to 1 unit. So standard output for actual working hours here, actual working hours equal to 33,000 hours. So 33,000 hours is nothing but 33,000 units into SR. Rate per unit 2 rupees. 2 rupees. 2 rupees. That is equal 33,000 into 2 is equal to 66,000 rupees. Next 3. Actual VOH cost incurred. Actual VOH cost incurred. Actual VOH cost incurred. That is directly available in the problem. Actual VOH cost incurred. Actual VOH cost incurred 68,000. 68,000. So these 4 steps are main steps. VOH recorded per unit. Next absorbed VOH cost. Next standard VOH cost. Next actual VOH cost. Now calculate the VOH variances. First one VOH cost variance. Next one VOH cost variance. Next VOH expenditure variance. Next VOH efficiency variance. VOH cost variance. VOH cost variance. VOH cost variance 1 minus 3. So that means estimated VOH cost, that is the absorbed VOH cost, that is recovered VOH cost. Absorbed VOH cost or estimated VOH cost or recorded VOH cost, all are same. So here estimated VOH cost equal to 65,000. Actual VOH cost equal to 68,000. So 65,000 estimated VOH cost. Estimate VOH cost 65,000, but actually incurred 68,000. Extra cost incurred 3,000 adverse. So due to overhead rates increase, due to increase in overhead rates, due to increase in overhead rates, due to some amount due to workers efficiency. So due to increase in overhead rates, that variance is calling as VOH expenditure variance. VOH expenditure variance. VOH expenditure variance. VOH expenditure variance due to workers efficiency, that is VOH efficiency variance. VOH efficiency variance. VOH efficiency variance. So VOH efficiency variance equal to 2 minus 3, sir. Efficiency 1 minus 2, sir. 1 minus 2. Absorbed VOH cost minus standard VOH cost. Absorbed VOH cost minus standard VOH cost. So VOH efficiency variance equal to 1 minus 2. 1 minus 2. 1 minus 2. Absorbed VOH cost minus standard VOH cost. Here absorbed VOH cost equal to 65,000 minus 66,000. 65,000 minus 66,000. That equal to 1,000 adverse. Next, VOH expenditure variance equal to 2 minus 3, sir. 2 minus 3. 2 minus 3. Standard VOH cost minus actual VOH cost. So, as per company standards, as per this output, 66,000, sir, but actually incurred 68,000. So, 66,000 as per company experience, but actually incurred 68,000 due to increase in rates. Due to increase in rates, 2,000 adverse. 2,000 adverse, 1,000 adverse equal to VOH cost variance equal to 3,000 adverse. 3,000 adverse. So finally 1 minus 2 equal to VOH efficiency variance. Efficiency variance. 2 minus 3 equal to VOH expenditure variance. VOH expenditure variance. Next, 1 minus 3 equal to VOH cost variance. VOH cost variance. VOH cost variance. So 1 minus 2 efficiency, 2 minus 3 expenditure, 1 minus 3 cost variance. So here efficiency variance equal to 1,000 rupees adverse. Next, expenditure variance equal to 2,000 adverse. Next, cost variance equal to 3,000 adverse. So here 4 steps are very, very important. VOH recovered per unit. Next step, absorbed VOH cost. Next step, standard VOH cost. Next step, actual VOH cost. So actual VOH cost directly available in the problem. Absorbed VOH cost. Absorbed VOH cost on output basis. Formula actual output into VOH recovered per unit. Next, standard VOH cost. Standard VOH cost means standard output for actual working hours. So here 1 hour, 1 unit allowed time equal to 1 hour. So that means 1 hour equal to 1 unit. Here actual working hours equal to 33,000 hours. Therefore 33,000 units, that is the standard output. 33,000 units, that is the standard output. Into overhead recovered per unit 2 rupees. So finally 66,000. So 1 minus 2 efficiency, 2 minus 3 expenditure, 1 minus 3 cost variance. So this is the VOH variances. Next, fixed overhead variances. Same steps. First one, rate. Fixed overhead recovery rate per unit. Per unit. Yes, sir. Is equal to budget fixed overhead cost divided by budget output. Budget fixed overhead cost. So here budget fixed overhead cost. Budget fixed overhead cost is equal to 45,000, sir. 45,000. Budget output equal to 30,000. Budget output equal to 30,000. 30,000 units. So overhead recovered per unit, 45,000 divided by 30,000 equal 1.5 per unit. 1.5 per unit. That is the FOH recovered per unit. FOH recovered per unit. FOH recovered per unit. Now, number 1, absorbed fixed overhead cost. Absorbed fixed overhead cost. Absorbed fixed overhead cost. Absorbed fixed overhead cost equal to, on output basis, formula actual output into SR. Your actual output equal to 32,500 units. 32,500 units into SR 1.5. So 32,500 into 1.5. 48,750. 48,750. So that is the absorbed FOH cost. Number 2, budget FOH cost. Budget fixed overhead cost directly available in the problem. Budget fixed overhead cost. So budget fixed overhead cost equal to 45,000. 45,000. Next, number 3. Number 3, actual fixed overhead cost incurred. Actual fixed overhead cost incurred equal to actual fixed overhead cost incurred equal to 50,000, sir. 50,000. So 1, 2, 3 ready. 1, 2, 3 ready. Number 1, sir, FOH fixed overhead cost variance. Fixed overhead cost variance 1 minus 3. Cost always 1 minus 3, sir. Here 1, absorbed or estimated fixed overhead cost 48,750. Estimated amount in cost accounting, estimated amount is 48,750, but actually incurred, sir. But actually incurred 50,000, sir. But actually incurred 50,000. So 48,750 minus 50,000 is equal to 1,250 adverse. 1,250 adverse. Sorry, FOH cost variance, VOH cost variance equal to total overhead cost variance. Here total overhead cost variance equal to 4,250, sir. Adverse. Now proved, sir. So fixed overhead cost variance 1 minus 3, that is equal to 1,250. 1,250. Next, number 2. Fixed overhead cost variance due to increase in overhead rates. Due to increase in or decrease in overhead rates. Increasing or decreasing overhead rates. That means due to change in overhead rates. Due to change in overhead rates. Next, due to change in volumes. Due to change in volumes. So fixed overhead cost variance due to increase in overhead rates. Next, due to change in volumes. Due to change in volumes. So due to increase in overhead rates. Due to change in overhead rates or due to increase or decrease in overhead rates. That is calling as fixed overhead expenditure variance. Fixed overhead expenditure variance. due to change in volume, that is the fixed overhead volume variance. Volume variance. Sir, expenditure variance always 2 minus 3, sir. In VOH case also, expenditure variance 2 minus 3. Here 2 minus 3, 2 minus 3, 2 minus 3. 2 minus, this is 2, budget FOH cost minus actual FOH cost. 5,000. 45,000 minus 50,000. 45,000 minus 50,000 is equal to 5,000 adverse. So FOH expenditure variance equal to budget FOH cost minus actual FOH cost. Next, fixed overhead volume variance 1 minus 2. 1 minus 2. Absorbed FOH cost minus budget FOH cost. 48,750. 48,750 minus 45,000. 45,000 equal to 48,750 minus 45,000 is equal to 3,750. 3,750. 3,750. That is favorable. That is favorable. So here FOH expenditure variance plus FOH volume variance equal to FOH cost variance. Am I right? So 3750, 5,000 difference is equal to 1,250. 1,250 adverse. Yes, correct. So finally, 1 minus 2 equal to fixed overhead volume variance. Volume variance equal to 3750 favorable. Next, 2 minus 3 always expenditure variance. Fixed overhead expenditure variance. Expenditure variance. Fixed overhead expenditure variance is equal to 5,000 adverse. 5,000 adverse. Next, 1 minus 3 is equal to fixed overhead cost variance. Fixed overhead cost variance, that is equal to 1,250. 1,250 adverse. 1,250 adverse. Valid. Sir, fixed overhead cost variance plus variable overhead cost variance equal to total overhead cost variance. That is also proved, sir. Fixed overhead cost variance 1,250 adverse plus variable overhead cost variance 3,000 adverse, sir. 3,000 adverse. That equal total overhead cost variance. 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 Therefore, total overhead cost variance equal to total overhead cost variance equal to 4,250 adverse. 4,250 adverse. Is the total overhead cost variance calculation. Here total overhead cost variance also 4,250. So this is the overhead variances. This is the overhead variances. Now Start the marginal costing chapter, sir. So, next chapter, marginal costing chapter. This is next technique, marginal costing technique. Marginal costing technique. So, marginal costing technique. Features of marginal costing technique. Number one, cost classification. Cost classification. Cost classification. Like variability wise, sir. Variability basis. Variability basis. Like fixed expenses, variable expenses. That is fixed cost and variable cost. Number two. Second one, variable costs. Variable cost should be treated as product cost. Product cost. Variable cost should be treated as product cost. It includes direct material cost, next direct wage cost, next direct expenses, direct material cost, direct wage cost, direct expenses. It includes direct material cost, direct wage cost, direct expenses. Next, variable portion of overheads. Variable factory overheads, variable factory overheads, variable admin overheads, variable selling and distribution overheads, variable factory overheads, variable admin overheads, variable selling and distribution overheads. So these 6 elements collectively known as variable costs. Variable costs. Sir, first four elements varies with production volume. Varies with production volume. First four elements varies with the production volume. That means production volume increases, these four elements cost also increase. Next two elements varies with the sales volume. Varies with the sales volume. Varies with the sales volume. Suppose in case production volume and sales volume both are same, in that case 6 elements directly charged. Suppose in case production volume not equal to sales volume, please follow this pro forma. First we have to calculate variable production cost. That means direct material cost, direct wage cost, direct expenses, variable factory overheads is collectively known as variable production cost. Variable production cost. Adjust the inventory levels relating to finished goods. Then we get the variable COGS. Variable COGS. So from variable COGS onwards, all elements varies with the sales volume. So then charge the variable admin overheads, variable selling and distribution overheads. We get variable cost of sale, simply known as variable cost. So variable cost of sale, nothing but variable cost. So this is the second element. Variable cost should be treated as product cost. Third point. Fixed costs are considered as fixed costs are considered as period cost. Period cost. Fixed costs are considered as period cost. So completely burned by the company. Completely burned by the company. It includes fixed factory overheads, next fixed admin overheads, fixed selling and distribution overheads, fixed factory overheads, fixed admin overheads, fixed selling and distribution overheads. These three elements are collectively known as fixed costs. So under marginal costing technique, fixed costs are considered as period cost. So these are the main features: classification, next to product cost, next to period costing. Product cost means what are the elements charged to the product, that elements collectively known as product cost. Period cost means that is completely burned by the company. Now, so these are the features of the marginal costing. Now, under marginal costing technique, income statement. Income statement. Under marginal costing technique. Under marginal costing technique. Under marginal costing technique. Income statement under marginal costing technique. Income statement under marginal costing technique. Income statement under marginal costing technique. Particulars, amount. Suppose if production volume not equal to sales volume, in that case, how to calculate the profit? Right. So this is the pro forma. Sales A next less variable cost of sale. Variable cost of sale. Variable cost of sale. Variable cost of sale. It includes variable production cost, variable COGS. So first we have to calculate variable production cost. Variable production cost. Variable production cost. Variable production cost, that means production volume into variable production cost per unit. Production volume into variable production cost per unit. Variable production cost per unit. Sir, variable production cost per unit means it includes direct material cost per unit, direct labor cost per unit, direct expenses cost per unit, variable manufacturing overhead cost per unit. Okay. Then adjust the inventory levels relating to finished goods. Add cost of opening inventory of finished goods. Opening inventory of finished goods. Cost of opening inventory of finished goods. Less cost of closing inventory of finished goods. closing inventory of finished goods. Then we get variable COGS. 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 This is B. This is B. A minus B. Sir. Here, variable COGS. Then charge. Variable admin expenses and variable selling and distribution expenses, sir. So, add variable admin overheads. Variable admin overheads. Variable admin overheads. Variable admin overheads. Add variable selling and distribution overheads. We get variable cost of sale. Variable cost of sale. Variable cost of sale. So these two elements varies with the sales volume. This is B. Suppose production volume, sales volume both are same. In that case, directly at a time added all elements: material cost, labor cost, direct expenses, variable production overheads, variable admin overheads, variable selling and distribution overheads. So all elements at a time charge. But in this pro forma, production volume not equal to sales volume. So that first of all, we have to calculate the variable production cost, adjust the inventory levels, Then we get the variable COGS, add variable admin overheads, variable selling and distribution overheads, variable cost of sale. Suppose no production volume equal to sales volume. In that case, inventory levels nil. In that case, 6 elements directly charged. We get variable cost of sale. That is easiest way, right? Okay. But in this pro forma, inventory levels are maintained. So that find out the variable production cost, adjust the inventory levels, we get variable COGS. Then add the variable admin and variable selling. We get variable cost of sale. A minus B. Contribution. Contribution equal to A minus B. So margin less fixed costs. Finally, we get profit under marginal costing technique. Profit under marginal costing technique. Right. Next problem. So one minute, sir. This is the marginal costing, sir. Take the problem, sir. CRD 26. ERD 26. Right. Right. XYZ Limited has a production capacity 2 lakhs units per year. But as per available resources, company select select capacity or normal capacity or budgeting capacity. As per available resources, company selected capacity or normal capacity or budgeted capacity equal to 90%. So that is the 90% of 2 lakhs, 1,80,000 units. So that is the budget capacity. Budget capacity. Budget capacity. Budget capacity equal to 90% of 2 lakhs. So as per available resources, here selected capacity or budget capacity or normal capacity equal to 1,80,000 units. So that means if company works with 100% activity level, in that case volume of output equal to 1,80,000 units. Next, standard variable production costs are 11 rupees per unit. So standard means last year variable production cost per unit 11 rupees. The fixed cost means fixed production overhead cost equal to 3,60,000. Variable selling cost equal to 3 rupees per unit. Fixed selling cost equal to 2,70,000 per year. The unit selling price equal to 20. Okay. In the year just ended 30th June 2006, production volume equal to 1,60,000 units. Production volume equal to 1,60,000 units. That means 1,60,000 divided by 1,80,000 into 100. So here company just working with 88%, 88.88%. Okay, right. Next to production volume 1,60,000. Sales volume, sir. Sales volume. Sales volume. Sales volume. Here 1,50,000 units were sold, sir. Sales were 1,50,000 units. One thing is clear, here inventory levels are maintained. Production volume is not equal to sales volume. In that case, first of all, we have to calculate variable production cost, adjust the inventory levels, we get variable COGS. Then add variable admin and variable selling, we get variable cost of sale. Right. Now, closing inventory of finished goods. Closing inventory of finished goods. Finished goods. Closing inventory of finished goods equal to 20,000 units. 20,000 units. Closing inventory of finished goods equal to 20,000 units. 20,000 units. Okay. So closing inventory of finished goods equal to 20,000 units. Right. Next. Opening inventory, sir. Here sales volume 1,50,000, closing inventory 20, total availability 170, but production is 160. Therefore, opening inventory of finished goods equal to 160. Opening inventory of finished goods equal to 10,000 units. 10,000 units. Next, last year variable production cost per unit. Last year variable production cost per unit. Last year variable production cost per unit 11 rupees, sir. Current year variable production cost per unit. Current year variable production cost per unit. Current year variable production cost per unit equal to current year variable production cost per unit equal to sir, here actual variable production cost for the year were 35,000 other than the standard. So current year variable production cost per unit. Last year 11 rupees, sir. Current year more than. So current year variable production cost for the year were 35,000 higher than the last year. Standard means last year. So 35,000 higher than the last year for total production. Here total production equal to 1,60,000. So for 1,60,000 units, extra cost incurred 35,000. So per unit equal to 0.21875. Am I right? So 35,000 divided by 1,60,000 is equal to 0.21875. So finally 11.21875. 11.21875. So this is the current year variable production cost per unit. Now closing stock value of finished goods. Closing stock of value of finished goods equal to closing stock of finished goods equal to closing stock of finished goods equal to here closing stock units 20,000 units. 20,000 units. If there is no specific information about the inventory valuation, please follow the FIFO method. FIFO method means please value the inventory as per current period production cost. Here current period production cost per unit equal to 11.21875. So 11.21875. So 20,000 into 11.21875. 20,000 into 11.21875. So equal to 2,24,375. Opening stock of finished goods. Opening stock of finished goods. Opening stock of finished goods. Here opening stock 10,000 units, sir. So last year production cost per unit only 11 rupees. So current year opening stock become last year closing stock. So last year closing stock valued as per last year production cost per unit. Last year production cost per unit 11 rupees. So 10,000 into 11. 10,000 into 11. 1,10,000. So input study. Input study. Now prepare the income statement. Income statement. Here one thing is very clear. Here production volume not equal to sales volume. Production volume not equal to sales volume. In that case, first we have to calculate the variable production cost, then adjust the inventory levels, we get the variable COGS, then charge the variable admin expenses and variable selling expenses. Ultimately, we get variable cost of sales. Sales minus variable cost of sale is equal to contribution. Contribution minus fixed expenses equal to profit. Okay. What they are asking this question? Calculation of profit for the year. Calculation of profit for the year by marginal costing method. So first we have to complete A2, sir. A2. So calculation of profit. Calculation of profit for the year by using Marginal costing method. Marginal costing method. Particulars amount. Right? Now, first sales revenue. Here sales volume 1,50,000 units into 20 rupees, sir. 30 lakhs. A. Less variable cost of sale, sir. Variable cost of sale. Variable cost of sale. Variable production cost. Variable production cost. Here production volume 1,60,000 units, sir, into 11.21875. So 1,60,000 into 11.21875. 11.21875 is equal to 17,95,000, sir. Then adjust the inventory level, sir. Opening should be added. Cost of opening inventory of finished goods. Opening inventory of finished goods. Here finished goods, opening inventory finished goods volume 10,000 units into 11 rupees. 11 rupees. So 1,10,000, sir. Less cost of closing inventory of finished goods. Cost of closing inventory of finished goods. So that is 20,000 units into 11.21875. So 20,000 into 11.21875 is equal to 2,24,375. 375. So 17,95,000 plus 1,10,000 minus 2,24,375 is equal to 16,80,625. That is the variable COGS. Here variable admin content nil, sir, but variable selling content given in the problem 3 rupees per unit. So variable expenses, variable selling expenses, variable admin expenses varies with the sales volume. So here sales volume equal to 1,50,000 into 3. So 4,50,000. So add variable admin overheads. Variable admin overheads at the rate of 3 rupees per unit. So 1,50,000 unit sales volume, sir, into 3 rupees. So 4,50,000. 4,50,000. So 16,80,625 plus 4,50,000 is equal to 21,30,625. So this is the variable cost of sale. This is B. This is B. This is A. So sales minus variable cost of sale, contribution. A minus B is equal to 8,69,375. Then less fixed costs. Fixed costs. Here fixed production overhead cost. Fixed production overhead cost fixed production overhead cost equal to fixed production overhead cost, that is fixed production overhead cost 3,60,000, fixed selling overhead cost, fixed selling overhead cost equal to, here clear mention 2,70,000. So 3,60,000 plus 2,70,000, 3,60,000 plus 2,70,000 is equal to 6,30,000. So finally profit under marginal costing technique 375 is equal to 2,39,375. Please check the answer. 2,39,375 correct answer. So this is the marginal costing technique. So next technique, absorption costing technique. Absorption costing technique. So features in marginal costing technique, first feature, sir, marginal costing technique feature 1, cost classification. Here cost classification functional basis, sir. Here cost classification functional basis. Cost classification functional basis. Functional basis. Like total production overhead cost, total production overhead cost, B, total admin overhead cost, total production cost, sir. Total production cost, next total admin overhead cost, next to C, total selling overhead cost. So this is the classification. So functional basis classification, total production cost, total admin overhead cost, total selling overhead cost, selling and distribution overhead cost. Total production cost includes direct material cost, direct labor cost, direct expenses, variable production overhead cost, and also include fixed production overhead cost. So total production cost, 5 elements, sir. So here total production cost should be treated as product cost. Second, total production cost, not production overhead cost, production cost. Production cost includes 5 elements. Production overhead cost only 1 element. So total production cost should be treated as product cost. Total production cost should be treated as product cost. It includes number 1, direct material cost per unit, direct material cost. Number 2, direct wage cost. Number 3, direct expenses cost. Number 4, variable production overhead cost. That means variable factory overhead cost. Number 5, fixed production overhead cost. So please observe first 4 elements collectively known as variable production cost. This is used in marginal costing technique, sir. Variable production cost is used in marginal costing technique for inventory valuation and product costing. This is variable production cost. This is the variable production cost. Variable production cost is used for product costing and inventory valuation in marginal costing technique. In absorption costing technique, not only variable production overheads but also consider fixed production overheads. So that is the main difference between these two. So in absorption costing technique for inventory valuation and product costing purpose, consider 5 elements. In marginal costing technique, only 4 elements are considered for inventory valuation and product costing. So first 4 elements variable production cost, next 5th element fixed production overhead. So combinedly called as or collectively called as total production cost. Total production cost. In this problem, variable production cost for the current year, is equal to 11.21875. Fixed production overhead cost per unit. How to calculate the fixed production overhead cost rate per unit, sir? Simple. In overhead chapter already discussed, sir. EOH by output or budgeted overhead cost divided by budget output. So here fixed production overhead cost already mentioned in the problem. So 3,60,000 divided by budget output. Here budget output already discussed. Here budget output equal to budget capacitor budget output 1,80,000 units. 1,80,000 units. 1,80,000 units. So that equal to 2 rupees per unit. Here one thing is clear. Variable part completely varies with the actual production volume. Fixed part completely depends on the budget production volume. So if actuals are not equal, if actuals are not met with budgets, then fixed production was under recovered. Here 1,80,000 units budget production volume, but actual production volume 1,60,000. So not fully recovered fixed production overheads, under recovered. Under recovered amount equal to 20,000 units into 2, 40,000 rupees. So finally conclude that variable production cost completely varies with actual production volume. If there is no production volume, there is no variable production cost. But fixed overhead cost completely depends on budget production volume. So if company meet with budgets, then total amount fully recovered. If company doesn't meet with budgets, then under recovered. In this problem, budget production volume equal to 1,80,000, but actual production volume equal to 1,60,000. So unutilized volume equal to 20,000 units. 20,000 units into rate 2 rupees. So therefore 40,000 rupees the under recovery or under absorbed, under recovery of fixed production overheads. That should be deducted from gross margins. Okay. Now, so in absorption costing, total production cost per unit equal to total production cost per unit equal to 13.21875. 11.21875 plus 2 is equal to 13.21875. One more thing is here under recovery of fixed production overheads. Under recovery of fixed production overheads is equal to under recovery of fixed production overheads equal to unutilized volume equal to 20,000 units. How to calculate unutilized volume? Simple, sir. Here budget volume equal to 1,80,000, but actual production volume equal to 1,60,000. Unutilized volume equal to 20,000 units into 2 rupees equal to 40,000 rupees. So first feature classification of expenses functional basis. Second feature Here total production cost should be treated as a product cost. Remaining two, total admin overhead cost, total selling overhead cost shall be treated as a period cost. So third point, total admin overhead cost. Total admin means variable and fixed. Total admin overhead cost and total selling and distribution overhead cost shall be treated as period cost. Completely borne by the company. Okay. So here inventory valuation purpose, consider 13.21875. In marginal costing only 11.21875. That is the main difference. Okay. Now calculation of profit for the year. Calculation of profit for the year. Profit for the year by using absorption costing method. Absorption costing method. Absorption costing method. So in absorption costing method, first take the revenue. Revenue, sales. Sales. Here sales volume 1,50,000 units into 20 rupees. 1,50,000 into 20. 30 lakhs. A. Less cost of goods sold. Cost of goods sold. How to calculate the cost of goods sold? First we have to calculate the total production cost. Then adjust the inventory levels. We get the cost of goods sold. Total production cost. Total production cost. Total production cost, that is production volume 1,60,000 units into total production cost per unit 13.21875. 13.21875. So 1,60,000 units into 13.21875. 13.21875 is equal to 21 lakhs 15,000. 21 lakhs 15,000. Adjust the inventory levels. Add cost of opening inventory of finished goods. Opening stock of finished goods. Sir, this is absorption costing method, sir. Variable and also consider fixed. So variable part 11 rupees, sir. Fixed part 2 rupees. 13. 13 into 10,000 units, sir. 13 into 10,000 units. 13 into 10,000 units. 1,30,000. Less cost of closing stock of finished goods. Closing stock of finished goods. So 11.21875 plus 2 into 20,000 units, sir. Closing stock 20,000 units. So 13.21875. 13.21875 into 20,000 is equal to 2,64,375. So finally, COGS B point. So 21 lakhs 15,000. 21 lakhs 15,000 plus 1,30,000. 1,30,000 minus 2,64,375. So 19 lakhs 80,625. 19 lakhs 80,625. This is B. So gross margin, sir. Gross margin. So 30 lakhs minus 19 lakhs 80,625 is equal to 10 lakhs 19,375. This is A minus B. Here, fixed factory was under recovered, sir. Less act under recovery of fixed production overheads. Fixed production overheads. So already calculated in working notes, sir. So 40,000, sir. 40,000. Therefore, actual gross margin 9,79,375. That is the actual gross margin. Actual gross margin. Next, here period cost fixed. Here period cost equal to total admin expenses, total selling and distribution expenses. In this problem, total admin expenses completely nil, sir. So next, total selling and distribution overheads. Total selling and distribution overhead expenses. So variable at the rate of 3 rupees per unit. 3 rupees per unit. 3 into 1,50,000 sales volume. 4,50,000 fixed 2,70,000, sir. 2,70,000. So finally, profit. So 4,50,000, 2,70,000. 2,59,375. 2,59,375. Please check the answer. Correct, sir. So this is the absorption costing method and the marginal costing method. Next, under marginal costing technique, 3 features are very, very important. Classification of expenses, variable and fixed. Variable part should be treated as a product cost. Fixed part completely borne by the company. These 3 features are used for studying the break-even point. So marginal costing features are helpful for studying the break-even point. So break-even point means number of units to be sold for the recovery of fixed cost is nothing but break-even point. It can be expressed either in units or in rupees. So break-even point in units equal to fixed cost by contribution per unit. So it can be expressed either in units or in rupees. So BEP in rupees equal to BEP in units into selling price per unit. So once firm reached the BEP, remaining part is calling as margin of safety. So margin of safety also expressed in 2 times, in units and in rupees. Margin of safety also can be expressed in units and rupees. MOS in units equal to total sales in units minus BEP in units. Total sales in units minus BEP in units. Remaining part is calling a margin of safety units. In another formula, profit by CPU. Margin of safety in rupees equal to total sales in rupees minus BEP in rupees. Another formula, profit by PV ratio. Profit by PV ratio. PV ratio means is nothing but contribution ratio. For example, if selling price equal to 10 rupees, variable cost equal to 8 rupees, 2 rupees equal to contribution. So in terms of percentage, that is 20%. So total sales value 10 rupees for 1 unit. Out of that, 8 rupees is the variable cost part, remaining part contribution part. So contribution ratio equal to 2 by 10 into 100 is nothing but 20%. So remaining part variable cost ratio, that is 80%. Suppose if contribution ratio equal to 20%, contribution amount equal to 20% of sales. If variable cost ratio is 80%, then variable cost amount equal to 80% of sales. So main important formulas I will show, sir. In units, in rupees, particulars. BEP, fixed cost by contribution per unit. Contribution per unit equal to selling price per unit minus variable cost per unit. In rupees, fixed cost by PV ratio. Fixed cost by PV ratio. So in units, denominator is CPU. In rupees, denominator is PV ratio. Another formula, BEP in units into selling price per unit. So this is the first one. Next, MOS. MOS in units equal to profit by CPU. Profit by CPU. Same denominator. Profit by CPU. Here profit by PV ratio. So suppose question is asking MOS in rupees, then profit by PV ratio. So in rupees, denominator is PV ratio. If it is in units, denominator is CPU. If it is in units, denominator is CPU. If it is in rupees, denominator is PV ratio. Another alternative, MOS in units into selling price per unit. Selling price per unit. Sir, another formula, MOS in rupees, total sales in rupees minus BEP in rupees. Another formula, total sales in rupees, total sales value minus BEP in rupees. So this is the MOS. Next, if desired profit is given, then desired sales in units. Desired sales in units. Fixed cost less profit by contribution per unit. Sir, fixed cost plus profit is nothing but desired contribution. So if desired profit is given, then calculate the desired contribution divided by CPU, then we get the desired sales volume. Suppose desired sales in rupees, same fixed cost plus profit by PV ratio. If desired profit is given, then desired sales in rupees equal to F plus P by PV ratio, or desired sales in units into selling price per unit. Desired sales in units into selling price per unit. So these are the main important 6 formulas. So here CPU formula, selling price per unit minus variable cost per unit. Contribution equal to sales minus variable cost. See the difference. Here contribution per unit selling price per unit minus variable cost per unit. Here contribution equal to sales minus variable cost. Suppose sales for 10 units volume, variable cost also for 10 units volume. Then we get the contribution for 10 units volume. So contribution equal to sales minus variable cost. Right. Next. Suppose here PV ratio formula, general formula C by S into 100. If denominator is in 10 unit, if the denominator takes for 1 unit volume, numerator also takes for 1 unit volume. If the denominator takes for 10 units volume, numerator also takes for 10 units volume. So that is the PV ratio equal to C by S into 100. C means contribution, S means sales into 100. So PV ratio always expressed in percentage. Sometimes suppose period 1, first 6 months period, sales volume 8 units, sales amount 80 rupees. In period 2, next 6 months, period 2, sales volume 10 units, sales amount 100 rupees. Profit. Here profit equal to 6 rupees. Here profit equal to 10 rupees. So sales and profits are given at 2 different volumes. In that case, PV ratio formula, that is the special formula, PV ratio equal to change in profit by change in sales into 100. Change in sales into 100. Change in profit by change in sales into 100. Here change in profit 4 rupees by change in sales 20 into 100. So 20%, sir. So if sales and profits are available at 2 different volumes, sales and profits are given at 2 different volumes. In that case, PV ratio can be calculated by using a special formula. PV ratio equal to change in profit by change in sales in 100. In general case, C by S into 100. But sales and profits are given at 2 different volumes. In that case, this is the special formula. PV ratio equal to change in profit by change in sales into 100. Next. Period 1. Sales volume 8 units. Total cost 74 rupees. In period 2, sales volume 10 units, 90 total cost. Total cost means variable cost and fixed cost. So here total cost amounts are given at 2 different volumes. Total cost amounts are given at 2 different volumes. In that case, first we have to calculate variable cost per unit. So variable cost per unit equal to change in total cost divided by change in sales, change in volume, change in sales volume. So change in total cost, sir, 16 divided by change in volume 2 is equal to 8 rupees per unit. That is the variable cost per unit. So variable cost per unit equal to change in total cost divided by change in volume. So total cost values are given at 2 different volumes. In that case, variable cost per unit equal to change in total cost divided by change in volume. Now take the problem. Sir, assignment 1. Following figures have been extracted from the books of Messrs. RST Limited. So here 2 financial years data given in the problem, sir. 16-17 sales value 4 lakhs rupees. 16-17 sales value 4 lakhs. Loss amount equal to 15,000. 17-18 sales value 5 lakhs, sir. Loss amount profit equal to 15,000. So here Price structure and cost structure same, sir. Reason here there is no information about the cost structure and price structure. That means in two financial years, structure remains same. Cost structure means total amount of fixed cost per unit variable cost. Price structure means selling price per unit. If there is no discussion about the structure, in that case, in both financial years, structure will be same. If there is no discussion about the structure, in that case, structure will be same. So 16-17 structure, 17-18 structure, both are same. Here no discussion. So that means price structure same, cost structure same. Okay, right. Now here first bit is PV ratio. Sir, here special formula, sir. Here sales and profits are available in two different volumes. So PV ratio formula, change in profit by change in sales into 100. Here change in profit minus 15 to plus 15, 30,000, sir. 30,000 divided by change in sales 1 lakh, sir, into 100, sir. So 30,000 divided by 1 lakh into 100. 30%, sir. PV ratio 30%. Sir, PV ratio 30%, contribution equal to 30% of sales. Am I right? So next bit fixed cost, sir. In marginal costing equation, F plus P equal to C. Am I right? So fixed cost equal to contribution minus profit. Take one financial year data. You can select any financial year. Answer will be same. You can select any one, sir. Suppose select 17-18, sir. Here contribution equal to, sir, 17-18 PV ratio 30%, 16-17 PV ratio 30%. Reason here structure will be same, sir. Structure same, sir. If there is no changes in the structure, so PV ratio doesn't change. 16-17 PV ratio 30%, 17-18 PV ratio also 30%. So contribution equal to 30% of sales. Suppose select 17-18, sir. PV ratio 30%, sir. Contribution equal to 30% of sales. 30% of 5 lakhs. So 5 lakhs into 30%. So 1,50,000. 1,50,000 minus profit 15,000. So 1,15,000 minus 15,000 equal to 1,35,000. Answer 1,35,000. Next, break-even point. So, sir, here break-even point. That means in rupees. If there is no specific information, please prefer the in rupees. Break-even point in rupees equal to fixed cost by PV ratio. Here fixed cost equal to 1,35,000 divided by PV ratio equal to 30%, 0.3. Divided by 0.3 is equal to 4,50,000. Equal to 4,50,000. 4,50,000. Check. Yes. 4,50,000. Next one. Sales required to earn a profit of 40,000. Suppose sales required to earn a profit of 15,000. In that case, sales amount equal to 5 lakhs. That is directly given in the problem. Sales required to earn a profit of 15,000. In that case, answer will be 5 lakhs rupees. But here questioner is asking profit of 45,000, not 15,000. At 15,000 profit, sales amount equal to 5 lakhs. But here questioner is asking profit at 45,000, sir. Profit of 45,000, calculate the sales amount. So desired profit is given, then desired sales calculate, sir. So desired sales equal to, desired sales in rupees equal to, desired sales in rupees equal to F plus P by PV ratio. So here fixed cost equal to 1,35,000. Desired profit given in the problem 45,000 divided by PV ratio equal to 0.3. So 1,35,000 plus 1,40,000, 1,35,000 plus 45, 1,35,000 plus 45,000 is equal to 1,80,000 divided by 0.3 is equal to 6 lakhs. 6 lakhs. 6 lakhs. Okay. Next, margin of safety in the financial year 17-18. Margin of safety in rupees. If there is no specific information, please prefer the rupees. MOS in rupees equal to actual sales in rupees minus BEP in rupees. Here actual sales in rupees 17-18 actual sales 5 lakhs. minus BEP. BEP equal to 4,50,000. So 5 lakhs minus 4 lakhs 50,000 answer, sir. Completed. Next assignment 2, sir. Assignment 2. Assignment 2. When volume is 10,000 units, okay, average cost per unit is 5 rupees. Volume 10,000 units. The average cost per unit 5 rupees. Next, volume 12,000 units. The average cost per unit to 4.5. Simple logic, sir. Volume increases, average cost per unit decreases. Okay. So here volume 10,000 units, average cost per unit 5 rupees. Then total cost equal to 10,000 into 5. 10,000 into 5 is equal to 50,000, sir. Next, 12,000 into average cost per unit 4.5. We get total cost equal to 54,000. Now total cost amounts available at 2 different volumes, then variable cost per unit. Here first bit also variable cost per unit. So variable cost per unit. Change in total cost. Divided by change in volume. Sir, here change in total cost 4,000, sir. Divided by change in volume 2,000, sir. Is equal to 2 rupees per unit. Please check the answer. 2 rupees per unit, correct answer. Next, fixed cost, sir. So fixed cost amount. Fixed cost equal total cost minus total variable cost. Select one activity level, sir. Suppose you take 10,000 units activity level. In that case, fixed cost equal total cost at 10,000 units minus total variable cost at 10,000 units. The total cost at 10,000 units, sir, 50,000 rupees. 50,000 rupees. Total variable cost at 10,000 units. Per unit 2 rupees, sir. 10,000 units into 2. 20,000. So E equal to 30,000. Please check the answer. 30,000. Correct answer. Next, profit volume ratio. So profit volume ratio. Here selling price per unit given in the problem, sir. Not given in the problem, sir. Selling price per unit is not available. Okay. Here clue is there. Break-even point is 5,000 units. Okay. Break-even point is 5,000 units. Break-even point, BEP, break-even point is equal to 5,000 units. Break-even point 5,000 units. So break-even point equal to fixed cost divided by contribution per unit equal to 5,000 units. So here fixed cost readily available, sir. Fixed cost equal to 30,000 divided by 5,000 equal to CPU. So 30,000 divided by 5,000 is equal to 6 rupees. CPU 6 rupees. CPU 6 rupees. Now variable cost per unit 2 rupees. So here selling price per unit minus variable cost per unit equal to contribution per unit. Am I right? Here selling price per unit unknown factor, sir. Variable cost per unit 2 rupees, sir. Contribution per unit 6 rupees. So therefore selling price per unit equal to 8 rupees. Am I right? Selling price per unit equal to 8 rupees. Now PV ratio equal to C by S into 100. So contribution, suppose if numerator takes for 1 unit volume, denominator also takes for 1 unit volume. So here C contribution per unit 6 rupees, sir. Selling price per unit 8 rupees, sir, into 100. So 6 divided by 8 into 100 is equal to 75%. 75%. 75%. So here contribution per unit to 6 rupees, sir. So variable cost per unit to 2 rupees. Variable cost per unit to 2 rupees. So selling price per unit to 6 plus 2, 8. So PV ratio equal to C by S into 100. 6 by 8 into 100, 75%. So PV ratio 75%. Variable cost ratio, sir. Variable cost ratio 100 minus PV ratio. 100 minus PV ratio is equal to 100 minus 75 is equal to 25%. 25%. So links very important, sir. PV ratio 75%, variable cost ratio 25%. Suppose in case of total sales, BEP part equal to 40%. BEP part 40%. Until that means BEP break-even point equal to 40% of total sales. Remaining 60%, sir, margin of safety. Margin of safety. So BEP 40% of total sales. Therefore, margin of safety equal to 60% of total sales. Total sales. So BEP percentage equal to BEP in rupees divided by total sales into 100. Margin of safety in percentage equal to MOS in rupees divided by total sales. These are very important formulas. BEP in percentage equal to BEP in rupees divided by total sales into 100. Margin of safety percentage equal to margin of safety in rupees divided by total sales into 100. So total sales, very important. Denominator total sales. So out of total sales, certain part is break-even part, certain part is margin of safety. So BEP part 40%, remaining 60% margin of safety. Okay, like that. So PV ratio 75%, variable cost ratio 25%. Okay. Next problem, sir. Assignment 12. A company has introduced a new product and marketed 20,000 units. Variable cost of the product is 20 rupees per unit. Fixed overheads equal to 3,20,000 rupees. So here given data, assignment 12, sir. Right. Here a company has introduced a new product, marketed volume equal to 20,000 units. Volume equal to 20,000 units. Variable cost per unit equal to 20 rupees. So therefore, total variable cost. So 20,000 units in variable nature per unit remains constant into 20. So 20,000 into 20, 4 lakhs. 4 lakhs. This is the total variable cost. Next, total fixed cost. Total fixed cost 3,20,000. 3,20,000. Okay. You are required to calculate the selling price per unit. Here, desired profit equal to 10% on sales value. Here, total cost equal to variable cost plus fixed cost. Variable cost 4 lakhs, sir. Fixed cost to 3,20,000, sir. So 7,20,000. That is the total cost. So here rate of profit equal to, first bit, rate of profit equal to 10% on sales. 10% on sales. That equal to 10 by 90 on cost. 10 by 90 on cost. So that is profit. Profit equal to 10 by 90 on cost. 10 by 90, here cost study, sir, 7,20,000. 7,20,000. 7,20,000. So 7,20,000 into 10 divided by 90 is equal to 80,000 rupees. 80,000 rupees. So desired profit ready. Desired profit ready is equal to 80,000 rupees. Sales is equal to cost plus profit. Here cost equal to 7,20,000 plus profit equal to 80,000 is equal to 8 lakhs. 8 lakhs. Therefore, selling price per unit equal to total sales value divided by volume. Total sales 8 lakhs divided by volume equal to 20,000 units. So 8 lakhs divided by 20,000 units is equal to 40 rupees. 40 rupees. That is the selling price per unit. Selling price per unit. 40 rupees. So here question is asking calculate the selling price per unit. Completed, sir. Next, BEP. BEP in rupees equal to fixed cost by PV ratio. So here contribution equal to F plus P, sir. Fixed cost plus profit. So here fixed cost equal to 3,20,000. 3,20,000 plus profit equal to 80,000. That equal to 4 lakhs. Contribution equal to 4 lakhs. PV ratio equal to contribution by sales into 100. So contribution 4 lakhs divided by sales 8 lakhs into 100. So 4 lakhs divided by 8 lakhs into 100 equal to 50%. So PV ratio ready. Then BEP in rupees equal to BEP in rupees equal to fixed cost by PV ratio. Here fixed cost equal to 3,20,000 by PV ratio equal to 0.5. So 3,20,000 divided by 0.5 equal to 6,40,000. 6,40,000. Please check the answer. Yes, 6,40,000. Your answer is not available, sir, but correct answer. Next, margin of safety. Margin of safety, MOS in rupees. MOS in rupees equal to profit by PV ratio. Here profit already calculated, sir. Profit equal to 80,000 rupees. 80,000 rupees divided by 0.5. So 80,000 divided by 0.5 equal to 1,60,000. 1,60,000. Sir, 6,40,000 plus 1,60,000, 8 lakhs total sales. Tallied, sir. Total sales also 8 lakhs. So in total sales, certain parties break-even point, break-even sales, break-even portion, remaining certain parties margin of safety portion. So total 8 lakhs rupees break-even portion equal to 6,40,000. Margin of safety portion equal to 1,60,000. 1,60,000. So this is the first bit, sir. Next, second bit. If the selling price is reduced by the company by 10%, so that is the revised selling price per unit equal to revised selling price per unit equal to 90% of 40. 90% of 40 equal to 36. Okay. Next, demand is expected to be increased by 5,000. Selling price to be reduced. Ultimately, demand will go up by 5,000 rupees. So revised sales volume equal to previous sales volume 20,000 units. Now 5,000 increase. So 20,000 plus 5,000 equal to 25,000 units. 25,000 units. 25,000 units. Next, what will be the impact on profit and impact on BEP and impact on margin of safety? So here volume increased by 5,000, price structure decreased by 10%. Okay, remaining same. So that means fixed cost is same, no change. Fixed cost equal to same 3,20,000. Fixed cost 3,20,000. 3,20,000. Variable cost per unit. So previously PV ratio, before changes in prices, PV ratio 50%, sir. That means variable cost ratio 50%. So 50% of selling price means your selling price equal to 40 rupees. So PV ratio 50%. Contribution equal to 50% of 40, 20 rupees. Remaining part variable cost, that is also 50% of 40, 20 rupees. So variable cost per unit no change. So 20 rupees. 20 rupees. Okay, right. Now contribution per unit. Selling price per unit minus variable cost per unit. Here selling price decreased by 10%, therefore revised selling price per unit equal to 36 minus variable cost per unit equal to 20 equal to 16 rupees. Contribution per unit. Contribution per unit. Okay. Now calculate impact on profit. First of all, calculate the profit. Profit equal to F plus P equal to C, sir. Profit equal to contribution minus fixed cost. Here contribution per unit 16 rupees into volume. Here volume 25,000 units. 25,000 units minus fixed cost 32 lakh, 3,20,000. 3,20,000. So 25,000 into 16, 4 lakhs minus 3,20,000. So 80,000, sir. 80,000. So amount is same, but rate of profit is different, sir. So rate of profit previously 10% on sales. Now rate of profit on sales equal to profit by sales into 100. Now sales equal to 25,000 units into 36. 25,000 units into 36. Profit equal to 80,000 into 100. So 80,000 divided by 25,000 units into 36 equal to 9 lakhs into 100. So 80,000 divided by 9 lakhs into 100 is equal to 8.89%. 8.89%. So rate of profit decreased from 10% to 8.89%. Rate of profit decreased by here 10 minus 8.89, 1.11%. Rate of profit decreased by 1.11%. So that is the impact on profit. Next, impact on BEP. New BEP equal to fixed cost by PV ratio. So here PV ratio, structure changes, PV ratio affected. If structure changes, PV ratio is affected. So PV ratio as per new structure C by S into 100. As per new structure, contribution per unit equal to 16 rupees. Selling price 36 into 100. So 16 divided by 36 into 100 is equal 44.44%. Now fixed cost equal to same 3,20,000 divided by 0.4444. So 3,20,000 divided by 0.444444 is equal to 7,20,000, sir. Is equal to 7,20,000. Sorry, here 7,20,000. Okay. So previously break-even sales equal to 6,40,000. Now break-even sales equal to 7,20,000. So break-even sales increased by how much, sir? Break-even sales increased by 7,20,000 minus 6,40,000. 6,40,000 equal to 80,000. So break-even sales increased by 80,000 rupees, sir. break-even sales increased by 80,000 rupees. Break-even sales increased by 80,000 rupees. So this is the second bit. Next, third bit. Sir, one more. Here, impact on profit, impact on BP, impact on margin of safety, sir. Okay. Margin of safety, MOS in rupees. So profit by PV ratio. Sir, here profit also 80,000 rupees, but PV ratio affected, sir. So PV ratio 0.4444. So 80,000 divided by 0.444444 is equal 1,80,000, sir. 1,80,000 rupees. 1,80,000 rupees. Here margin of safety, previously margin of safety equal to 1,60,000. So it is good sign, sir. Margin of safety increased by 20,000 rupees. Margin of safety increased by 20,000 rupees. MOS in rupees increased by 20,000 rupees. So second bit complete, sir. Next, third bit. Third bit. So third bit. Apply the original data. Calculate the margin of safety. Profit equal to 64,000. So margin of safety is equal profit by PV ratio. Here profit given in the problem. If profit is 64,000 rupees, PV ratio, that means original PV ratio 50%, sir, 0.5. So MOS in rupees equal to 64,000 divided by 0.5 is equal to 1,28,000. 1,28,000. So this is the marginal costing chapter, sir. Next to process costing, sir. So this is the types of costing, one of the types of costing. So process costing. Features very, very important, sir. Features. Number one, classification of expenses. So classification of expenses important, sir. Classification of expenses functional ways, sir. Classification of expenses functional basis. Functional basis. That means it includes functional basis classification includes total production cost, next total admin overhead cost, total selling and distribution overhead cost, total production cost, total admin overhead cost, total selling and distribution overhead cost. Here production cost includes direct material cost, direct wage cost, direct expenses, total factory overheads or total manufacturing overheads or total production overheads. Only these elements are considered while calculating the unit cost. Only these elements are considered while calculating the unit cost. These two elements directly charge it to costing, profit and loss account. So these two elements directly charge it to the profit and loss account. So while calculating the unit cost, only consider the production cost. So production cost includes direct material cost, direct wage cost, direct expenses, total factory overheads. So how to calculate the unit cost and process costing, sir? Total input cost minus realizable value of normal loss divided by input in units minus normal loss in units. So unit cost equal to input cost minus realizable value of normal loss, realizable value of normal loss, realizable value of normal loss divided by input in units minus normal loss in units, normal loss in units. So this is the formula for calculating the unit cost. So cost is ascertained at each stage of production separately. Such type of cost ascertaining program is calling as process costing. Examples: oil refinery industries, cement industries, steel industries. These are the best examples. Take the problem. Right. Wait. See this problem. A product passes through process 1, process 2. Particulars pertaining to process 1 are as under. Materials issued to process 1 amounted to 80,000 rupees, whereas 60,000 rupees. Manufacturing overheads were, that is the total factory overheads or total manufacturing overheads were 52,500. Normal loss anticipated was 5% of input. So 9,650 units of output were produced and transferred to process 1, from process 1 to process 2. So here input raw material issued to process 1 were 10,000 units. There were no opening stocks. Scrap realizable value 5 rupees per unit. So you are required to prepare process 1 account or abnormal gain or abnormal loss account. So first we have to prepare production statement. So production statement. Production statement in quantity. Production statement in quantity. Process 1 in quantity. Particulars. Input quantity introduced into the process 1. Input quantity introduced into the process 1. Here input quantity introduced into the process 1 is equal, input raw material introduced into the process 1 equal to 10,000 units. 10,000 units less normal loss. Normal loss is 5%. That is 5% of input, 10,000 units. So 500 units. So expected output as per industry norms. Expected output as per industry norms. So input quantity introduced into the process 1 10,000 units. So as per industry norms, quantity loss equal to, as per industry norms, quantity loss or expected quantity loss, that is the normal loss equal to 5% of input. So expected output equal to 9,500 units. So here actual output equal to 9,650. Actual output equal to 9,650 units. Okay, so this is the actual output. Here actual output is more than the industry output. So actual output is more than the expected output as per industry norms. Therefore, here 150 is the abnormal gain. 150 units abnormal gain. Abnormal gain. So total scrapped units equal to expected quantity loss 500, but out of that 150 converted as gain units. So therefore, total scrapped units equal to 500 Total scrapped units. Total scrapped units. Total scrapped units in process 1 equal to, as per industry norms, quantity loss equal to 500 units. Out of that, 150 units converted as gain. So finally, scrapped units equal to 350 units. So total scrapped units in process 1 equal to 350 units. So this is the basic information about this problem. So first we have to prepare the production statement in quantity. So production statement format input to less expected quantity loss, that is the normal loss, that is the unavoidable quantity loss. Then we get the expected output as per industry norms. Compare with actual output, find the abnormal loss or gain. So here abnormal gain. So as per industry norms, quantity loss 500. Out of that, 150 units converted as gain. Therefore, actual output equal to 9650. So abnormal gain equal to 150 units. Now process 1 account. Process 1 account. Process 1 account. Process 1 account. So quantity, rate per unit, amount, particulars, debit to credit, particulars, quantity, rate per unit, amount. 2. Input raw material introduced. Input raw material quantity introduced. Here input raw material quantity 10,000 units. Rate per unit not mentioned, sir, but value is directly given 80,000. So 80,000 divided by 10,000, 8 rupees, sir. 8 rupees per unit. Next, here additional raw material cost incurred for this input nil, sir. Additional raw material cost incurred for this input nil, sir. Next, wage cost incurred. Wages incurred for this input equal to, wage cost incurred for this input equal to 60,000 rupees, sir. 60,000 rupees. Direct expenses cost incurred for this input, sir. Nil, sir. Total manufacturing overheads. Total manufacturing overheads charged for this input 52,500. 52,500. Okay. So don't charge admin expenses and selling expenses while calculating the unit cost. These two are period cost. Directly charged to P&L account. Directly charged to P&L account. So while preparing the process account, only production cost elements are considered. What are the production cost elements? Input raw material cost, additional raw material cost, wage cost, direct expenses, and manufacturing overheads. Total manufacturing overheads. Next, as per industry norms, normal loss pass on to customer. As per industry norms, normal loss equal to 5% of input. So 5% of input equal to 500 units. 500 units. Expected realizable value of normal loss per unit equal to 5 rupees, sir. 5 rupees. So 500 into 5 rupees, that is 2,500. 2,500. 2,500. So cost per unit, sir. Average cost per unit. So input cost. How much input cost? 80,000 plus 60,000, 1,40,000. 1,40,000 plus 52,500 is equal to 1,92,500 minus scrap value, realizable value of scrap 2,500. 2,500. divided by input in units 10,000 units minus normal loss in units 500. 500. So 1,92,500 minus 2,500 is equal to 1,90,000 divided by 9,500 units. So 1,90,000 divided by 9,500, sir. 20 rupees. So unit rate calculation completed. So once unit rate confirm, then calculate the abnormal cost elements cost value. So here unit rate 20 rupees, sir. Then decide the abnormal cost elements. Here abnormal items, yes, here abnormal gain, sir. So therefore cost of abnormal gain equal to cost of abnormal gain equal to cost of abnormal gain equal to here abnormal gain volume 150 units, sir. 150 units. Here unit value already decided, sir. Here unit cost value already decided 20 rupees. Therefore cost of abnormal gain equal to 20 into 150 is equal to 3,000 rupees. Journal entry, sir. Concern process account debit to abnormal gain account, sir. Journal entry. Concern process account debit to abnormal gain account. So here process one account debit to abnormal gain account. 3,000 rupees. Process one account debit abnormal gain account 3,000 rupees. So process one account to abnormal gain account. To abnormal gain account. Amount, sir, abnormal 3,000 rupees. 3,000 rupees. Now units transferred to process 2. Units transferred to process 2. Units transferred to process 2. Here units transferred to process 2 already calculated, sir. 9,650. 9,650. Unit value already calculated, sir, 20 rupees. So final value 9,650 into 20 rupees. 1,93,000. 1,93,000. So 10,000 units. 10,000. Here abnormal units 150, sir. So 10,000 plus 10,000 plus 150. 10,000 150. Next 80,000 plus 60,000 1,40,000. 1,40,000. 1,92,000. 500. 1,92,500 plus 3,000. 1,95,500. Here 9,650 plus 500. 9,650 plus 500 is equal to 10,150. Hyphen. Next 1,93,000 plus 2,500 is equal to 1,95,500. So this is the process one account. Now normal loss account. Normal loss account. Debit to credit. Right. So here normal loss as per industry norms 500 quantity loss, realizable value, expected realizable value 5 rupees. So normal loss account debit to process one account. To process one account. To process one account. So 500 expected quantity loss 500. Expected realizable value 5 rupees. So total value 2500. 2500. So here real scrapped units only 350 units, sir. These are sold in the market by cash 350 350 into 5 is equal to 1750. Next 150 pies 750. Due to abnormal gain, missing the opportunity benefit to 750 rupees, sir. This opportunity cost adjusted through gain. So this amount taken from gain account, sir. Abnormal gain account. Abnormal gain account. Abnormal gain account. So here opportunity cost 150 at the rate of 5 rupees, 750, that is the opportunity cost. Due to abnormal gain, here opportunity cost equal to 750. So this amount taken from abnormal gain account. So finally 500, 2500, 500, 2500, 2500. Next, abnormal gain account. Abnormal gain account. Debit to credit. Abnormal gain account. Already abnormal gain entry has already passed, sir. Abnormal gain process one account debit to abnormal gain account. In abnormal gain account, by process one account. By process one account. So 150, 23,000. Right. Now here opportunity cost already adjusted in abnormal gain account. So abnormal gain to normal loss account. Normal loss account. 150, 5 rupees, sir. 750 adjusted. Now net gain equal to net gain 150, 3,000, 150, 3,000 minus 750, 2,250, the net gain. So net gain transfer to costing profit and loss account. So this is the problem number 1, assignment 1. Next one, sir. Next, assignment 5. Assignment 5. Assignment 5. Guntur Limited manufactures hockey bats, buys wood as its direct material. So product name hockey bats. Product requires a raw material item wood. Next, the forming department process the hockey bats, and the hockey bats are then transferred to finishing department. In finishing department, stickers are applied. The forming department begin manufacturing 5,000 initial bats during the month of December, for the first time. So here date of commencement of month of commencement to December month, sir. So December 1st. December 1st. So the forming department beginning manufacturing 5,000 initial bats during the month of December for the first time. So first time input quantity introduced into the process, forming process, 5,000 bats. Next, during this process, material cost incurred 20,000 rupees. Conversion cost means labor cost and overheads. So conversion cost means labor cost plus total manufacturing overhead cost equal to 8,500. Right. Next, a total of 5,000 occupiers were completed. So input quantity introduced into the process 5,000, 4,000 fully completed, sir, and transferred to finishing department. The rest 1,000 were still in the forming process at the end of the month. So at the end of the December month, 1,000 still in process. That is the closing work in progress. That is the unfinished work. So here 5,000 introduced, sir. 4,000 fully completed, sir. 100% completed. 1,000 unfinished work, sir. Unfinished work means work in progress. Work in progress. One thing is observed, sir. Here normal loss nil, sir. Here quantity loss nil. Okay. Next, all of the forming departments direct materials are placed. Direct materials were placed. That means material work always 100%. So all material items are introduced at the beginning of the process, so that material work completion is always 100%. But on an average, only 25% of the conversion cost was applied to the to the end of the work in progress. So work completion of the conversion cost equal to 25%. So work completion of the material segment equal to 100%. Reason, here materials are introduced at the beginning of the process. So direct materials, all of the forming department direct materials were placed. Means at the time of beginning of the process, first material introduced, sir. So all material items are introduced at the beginning of the process, so that always material work completion is 100%, sir. Okay, right. Now statement, production statement. Production statement 5. Production statement. Production statement in quantity. Production statement in quantity. So forming department, forming process in quantity. Particulars. Particulars. First, input quantity introduced. Input quantity introduced into the process 5,000 units. Less normal loss. Normal loss nil. So 5,000 units. This is expected. Sorry. Out of that, 1,000 unfinished work, sir. Closing work in progress. Closing work in progress 1,000 units. Then expected output. Expected output. Expected output equal to 4,000. Less actual output equal to actual output equal to 4,000. Expected output as per industry norms 4,000. Actual output also 4,000. Therefore, no abnormal events, no abnormal loss, no abnormal gain. So abnormal loss or gain nil, sir. Abnormal loss or gain nil. So here work in progress element exists, sir. So in this segment, how to calculate the cost per equivalent unit? Simple. First, conversion of partly completed to fully completed. That is the equivalent units. Okay. Then cost divided by equivalent units. Then we get the cost per equivalent unit. So here statement 1, statement of equivalent production. Here production details 5,000 input introduced. Out of that 4,000 fully completed, 1,000 partly completed. So 4,000 fully completed, that means 100% completion in all segments. 1,000 units partly completed, material work fully completed, conversion segment only 25% completed. Then converted into equivalent units. Then ready, equivalent units ready. Segment wise equivalent units ready. Then segment wise cost details also ready. So cost divided by equivalent units, we get the cost per equivalent unit. Then decide the unit cost value. Okay, right. Now Statement of equivalent production. Statement of equivalent production. Equivalent production. Statement of equivalent production. Particulars, units, raw material segment, conversion cost segment. Conversion cost segment. Conversion cost segment. Percentage of work completion, equivalent units. Percentage of work completion, equivalent units. Equivalent units. First one, units introduced and completed. Units introduced and completed. Introduced and completed. Units introduced and completed, sir. Here, units introduced 5,000. Out of that, introduced and completed equal to 4,000 units, sir. 4,000 units. Material work 100% completed. Conversion cost work also 100%. Sir, here completed. Completed means in all sections, work completion is 100%. 100% of 4,000, sir, 4,000 units. 100% of 4,000, sir, 4,000 units. Next, here normal loss, nil, no need to write. Next, closing work in progress. Closing work in progress. Here closing work in progress 1,000 units, sir. Material elements, all material items are introduced at the beginning of the process so that work completion of material 100%, sir. So here clearly mentioned, all of the forming departments direct materials were placed. Were placed means all material items are introduced at the beginning of the process so that material work completion always 100%. So conversion cost segment to work completion is 25%. So 100% of 1,000, here 250. 250. Right. So total 5,000 units. Next 5,000 units. Next 4,250 units. 4,250 units. So that is the statement of equivalent production. Next, statement of cost per equivalent unit. Statement of cost per equivalent unit. Statement of cost per equivalent unit. Particulars, raw material cost, conversion cost total. So cost incurred during the process. Cost incurred during the process. Cost incurred during the process. Here cost incurred during the process 20,000 material cost incurred. Conversion cost incurred 8,500, sir. So 28,500. 28,500. In material segment, cost incurred equal to 20,000 rupees. For this amount, total units completed, sir, 5,000 units. For this amount, number of units fully completed, sir, 5,000 units. 5,000 units. That is the equivalent units. Equivalent units. This is A, this is B. Sir, in conversion cost segment, cost incurred 8,500, sir. For this amount, number of units fully completed, sir, 4,250 units. 4,250 units. 4,250 units. So therefore, cost per equivalent unit, sir. Cost per equivalent unit. Cost per equivalent unit. A by B. A by B. 20,000 divided by 5,000. 20,000 divided by 5,000 is equal to 4 rupees. Next, 8,500 divided by 4,250 is equal to 2 rupees. So, equal to 6 rupees. Equal to 6 rupees. Okay. Right. So, this is the equivalent units of production of each conversion cost per equivalent unit completed. Next, decide the cost of closing work in progress and cost of output. Cost of output, that is calling as statement of apportionment of cost. Statement of apportionment of cost is nothing but process cost sheet. Process cost sheet. So, in this statement, decide the value of work in progress and decide the value of finished units. Okay. Now, process cost sheet, sir. Particulars amount. First, your questioner is asking cost of closing work in progress and cost of finished products. Cost of finished products. Cost of finished products. So, here finished units equal to 4,000 units into 100% completed, sir. Cost per equivalent unit to 6 rupees. 6 rupees. So, value 4,000 into 6 is equal to 24,000 rupees. 24,000 rupees. Number 2, cost of closing work in progress. Cost of closing work in progress. Cost of closing work in progress. That is 1,000 units, sir. That is 1,000 units. 1,000 units. Raw material 1,000 units. Raw material work 100% completed in work in progress segment, sir. For work in progress units, material work fully completed, 100% completed, sir. So, therefore, equivalent units to 1,000 units into equivalent unit cost to 4 rupees. 4 rupees. 1,000 into 4 is equal to 4,000. 4,000. Next, conversion cost. Conversion cost. Conversion cost to 1,000 units. Work completion 25%. Percentage of work completion 25%. Therefore, equivalent units equal to 1,000 units into 25%, 250. Equivalent unit cost to 2 rupees. 2 rupees equal to 250 into 2, 500 rupees. So, 4,500 rupees. So finally 24,000 plus 4,500 is equal to 28,500. So tally, sir, 28,500 total. So this is the problem number 5. Okay, this is the process costing. Next, ABC costing, sir. Activity based costing. Activity based costing. Activity based costing. Okay. So previously, traditional costing approach has been followed, sir. Now, activity based costing, sir. What is the difference between traditional costing system and activity based costing system? In traditional costing system, total overheads varies with the single overhead recovery rate. Entire company, entire factory overheads varies with the single driver. In activity based costing, total overheads can be identified different activities. Each activity assigned a separate driver. So here multiple drivers are there. In traditional accounting, only one driver. Only one driver. For example, in traditional costing, first of all, calculate the machine hour rate. Machine hour rate. That means here entire overheads varies with machine hours. That means machine hours increase, overheads also increase. So machine hour rate, for example, 20 rupees. This rate is used to charge the overheads to the products. Total overheads varies with machine hours. Driver name equal to machine hours. That is the traditional costing. But in activity based costing, first step, total overheads can be identified different activities. Step 1, total overheads can be identified different activities. Each activity assigned a separate driver. Then calculate the cost driver rates. These driver rates are used to charge the overheads to the products. That is the difference. Okay, right. Now take the problem. Assignment 1, sir. A company manufactures 3 products, namely A, B, and C, in a factory. The following cost data and as under. So the following cost data for the month of March 2018 are as under. Here production volume of product A 10,000 units, production volume of product B 15,000 units, production volume of product C 20,000 units. 1 unit required time of A 3 hours, 1 unit required time of B 4.5 hours, 1 unit required time of C 4 hours. Mission hour per unit. 1 unit required time of mission hours of 6, B 4, C 5. Next, setup time of machines. Next, number of orders. Next, machine operating cost. So here, machine operating cost, machine setup cost, order processing cost. So these are the overheads. So, and total overheads 34 lakhs 50,000, 34 lakhs 50,000, 4 lakhs 36,000, plus 2,56,000. So 41,42,000. 41,42,000. 41,42,000. So here already total overheads identified three major activities: machine operating activity, machine setup activity, order processing activity. Machine operating activity, that is the machine running activity. Next, machine setup activity. Next, order processing activity. So total overheads, so 41,42,000. Total overheads can be identified three major activities. Right. Now calculate the cost driver rates. Machine operating cost or machine running cost driver name equal to machine hours. Next, machine setup cost driver name number of setups. Next, order processing cost driver name number of orders. Okay, right. So here setup of machines, so 20 setups to 25 setups to 30 setups. Number of orders, so 15 orders to 12 orders to 10 orders. So for this production, number of setups 20 setups. For this production, number of orders 15 orders. Next, for this production, in case of B, for this production, number of setups 25 setups, number of orders 12 orders. For this production, number of setups 30, number of orders 10. Okay, but here machine hours only per unit is available, sir. Per unit available. Then for total production, calculate, sir. Okay, right. So first bit, cost driver rate. Assignment 1. Assignment 1. Calculation of cost driver rate. Calculation of cost driver rate. Cost driver rate. First, activity or cost pool name. Cost pool name or activity. 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 Here three activities are there. Machine operating activity. Machine operating activity. Machine operating activity. Next, number 2, machine setup activity. Machine setup activity. Next, order processing activity. Order processing activity. Machine operating activity, machine setup activity, order processing activity. Next, cost pool amount. Cost pool in rupees. Machine operating cost to 34,50,000. 34,50,000. Next to machine setup cost to 4,36,000. Next to order processing cost 2,56,000. 2,56,000. Right. Next, costful in rupees. Next, cost driver name. Cost driver name. Here, cost driver name, machine operating cost driver name, machine hours. Machine hours. Next, setup of machines. So that is the number of setups. Number of setups. Next, the number of orders. Number of orders. So this is the cost driver name. Cost driver quantity. Cost driver quantity. CDQ values. Here number of setups, 20 setups for A, 25 setups for B, 30 setups for C. So 45 plus 30, 75. 75 setups. Number of orders. 10,000 units of A, number of orders 15 orders. 15,000 units of B, 12 orders. 20,000 units of C, 10 orders. 15 plus 12 plus 10. So 15 plus 12 plus 10 is equal to 37. 37 orders. 37 orders. Next, machine hours, sir. Sir, 1 unit required time 6 hours. 10,000 units required time 60,000 hours. 1 unit required time 4 hours, sir. 15,000 into 4, 60,000 hours. So here 1 unit term, 1 minute. 1 unit to 5, sir. So 20,000 into 5, 1 lakh. So 60,000 plus 60,000, 1 lakh 20,000 plus 1 lakh, 2 lakhs 20,000 hours. 2 lakhs 20,000 hours. So driver names assigned, driver quantity calculated. Now cost driver rate. Cost driver rate. So machine operating cost 34 lakhs 50,000. Driver name machine hours. This amount varies with machine hours, sir. Here total machine hours spent 2 lakhs 20,000 hours. So rate per hour equal to 34 lakhs 50,000 divided by 2 lakhs 20,000 hours. So rate 15.6818. Next, 4 lakhs 36,000 divided by 75. 5,813.33. Next, 2 lakhs 56,000 divided by 37. 6,918.9189. 9189. So these rates are used to charge the overheads to the products. These rates are used to charge the overheads to the products or to the job. Please fetch the driver rates. 15.68 correct. 5,813.33 correct. 3333 4 digits. 6,918.92. Okay. Now, second bit. Calculate overhead rate per unit using activity based costing system. So here company produces more than one product. Definitely you should prepare the statement of apportionment of overhead cost sheet. So statement of apportionment of overhead cost. 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 Product A, CDQ amount. Product B, CDQ amount. Product C, CDQ amount. Particulars. Product A, CDQ amount. Product B, CDQ amount. Product C, CDQ amount. Okay. First, machine operating cost. Machine operating cost. Machine operating cost. Machine operating cost. Okay. Machine operating cost. CDQ values. Machine hours. Product A spent 60,000 hours. Next to 60,000 hours. Next to 1 lakh hours. Here rate equal to 15.6818. 15.6818. 15.6818. So 15.6818 into 60,000 is equal to 9,40,908. 9,40,908. 9,40,908. Next, 9,40,908. Next, 15.6818 into 1 lakh. 15,68,180. So total amount, sir, 34 lakhs 50. So here 15 lakhs 68,184, sir. So total 15 lakhs 68,184 plus 9,40,908 plus 9,40,908. 34 lakhs 50,000. Correct answer. Next one, machine setup cost. Machine setup cost. Machine setup cost. So machine setup cost, so driver name, number of setups. Product A spent 20 setups. 20 setups. Next, product B, 25 setups. Product C, 30 setups. 30 setups. 30 setups. Now rate equal to 5813.33. So 5813. 5813. 5813.3333. 5813.3333 into 20 is equal to 1,16,267. Next, 5813.3333 into 25. 1,45,333. Next, 5,813.33333 into 30. 1,74,400. So finally total 1,74,400 plus 1,45,333 1,45,333 plus 1,16,267. Tally sir, 4,36,000. Correct. Next, order processing cost. Order processing cost. Right. Here number of orders, 15 orders for this production. 15 orders. Next, 12 orders. Next, 10 orders. Okay. Rate per order, 6918.9189 into 15. 1,03,784. Next, 12 into 6918.9189. 83,027. 83,027. Next, 10 into 6918.9189. 69,189. 69,189. Now, EOH of product A. That once check sir, 69,189 plus 83,027 plus 1,03,784 is equal to 2,56,000. Correct answer. Right. Now, 9,40,908 plus 1,16,267 plus 1,03,784. 1,16,000, 11,60,959, 959. Next, 9,40,908, 1,45,333, 83,027 is equal to 1 lakh 11 lakhs 69,268. 268. Next, 15 lakhs 68,184, 1,74,400, 69,189. So 18 lakhs 11,773. So 11 lakhs 69,268, 11 lakhs 60,959. So 41 lakhs 42, correct answer, sir. Yes, correct. So here question is asking calculate the overhead rate per unit. So here overhead study, sir, total overhead study. A, B production volume, sir. Production volume in units. Production volume in units. So production volume of product A 10,000 units. 10,000 units. Production volume of B 15,000 units. Production volume of C 20,000 units. A by B overhead recovery rate per unit. So that is the overhead cost per unit, sir. Overhead rate per unit. In case of product A, 11,60,959 divided by 10,000. Sir, 116.0959. 0959. Correct answer, sir. 116.0959. Correct. Next, 11,69,268 divided by 15,000. 77.9512. Next, 18,11,773 divided by 20,000 is equal to 90.58865. Now, overhead recovery rates are overhead cost per unit under activity based costing. So, this is the assignment 1, sir. Next one, assignment 3, sir. Woolmark Limited manufactures 3 types of products, namely P, Q, and R. The data relating to a period are as under. Machine hours per unit. So, product P requires number of machine hours 10 hours. Product Q requires 18 machine hours. Product R requires 14 machine hours. Direct labor hours per unit of P 4, Q 12, R 8. Direct material cost per unit. So P required 90 rupees material cost per unit, sir. P 80 rupees or 120. So production volume of product P 3000 units, production volume of product Q 5000 units, production volume of product R 20,000 units. Currently, the company uses traditional costing method. Okay. So that means total overheads varies with single driver. So currently company uses traditional costing method and absorb all production overheads on the basis of mission hours. Total overheads varies with mission hours. Therefore, here driver name equal to mission hours. So a total mission hours equal to 3000 into 10, 30,000 hours. 5,000 into 18. 5,000 into 18. 90,000 hours. Next, 20,000 into 14. 2,80,000 hours. 2,80,000 hours. So 14 into 20,000 hours. 2,80,000 plus 90,000 plus 30,000. So equal to 4 lakhs hours. Denominator ready. Now total overhead cost. Sir, here total overhead cost not given in the problem, sir. But here mission hour rate directly given in the problem, sir. Mission hour rate overhead, mission hour rate of overhead is equal to 6 rupees per hour. So here total overhead cost not directly given, but rate equal to 6 rupees per hour. Therefore, total overhead cost equal to 4 lakhs into 6 is equal to 24 lakhs, sir. So total overhead cost 24 lakhs. 24 lakhs. Next, the mission rate of overhead is equal to 6 rupees per hour, already calculated, sir. Next, direct labor hour rate equal to 20 rupees per hour. That means direct labor cost, hourly wage rate equal to 20 rupees per hour. The company proposes to use the activity based costing system, and the activity analysis is as under. P batch size units 150, Q batch size 500 units, R batch size 1000 units. Next, the total production overheads are analyzed as under. Machine setup cost 20% of total overhead cost. Total production overhead cost already calculated at 24 lakhs. So 20% of 24 lakhs. 20% of 24 lakhs. 4,80,000. Next, 30% of 24 lakhs. 24 lakhs into 30%. 7,20,000. Next, the inspection cost 40% of 24 lakhs. 40% of 24 lakhs. 9,60,000. 9,60,000. Next, 10% of 24 lakhs, 2,40,000. 2,40,000. So here total overheads can be identified 4 major activities: mission setup activity, mission operating, that is the mission running activity, inspection activity, material procurement activity. Okay, right. Now calculate the cost per unit of each product using the traditional method. Sir, cost per unit means material cost per unit, labor cost per unit, overhead cost per unit. Okay, right. Sir, here material cost per unit 90, sir. 90. Labor cost per unit, labor hour rate 20 rupees, sir. Labor cost 4 into 20, 80 rupees, sir. 80 rupees. Next, overhead rate 6 rupees, sir. Here 1 hour, 1 unit required time 10 hours. So 10 hours into 6, 60 rupees, sir. 60 plus 80 plus 90. So 90 plus 80, 1 minute. 60 plus 80 plus 90. is equal to 230, sir. Please check the answer. 230. Yes, correct answer. So traditional method easy, sir. Very easy. So material cost per unit 80 rupees, sir. Labor cost per unit 12 into 20. 12 into 20 is equal to 240. Next, here under traditional costing method, mission hour rate equal to 6 rupees per hour. Here total overheads varies with the mission hours. Here driver name equal to mission hours. Single driver. So 18 into 6. 18 into 6. 108. So 108 plus 240 plus 80 is equal to 428, sir. Correct answer. 428. Next, in case of R, material cost per unit 120, sir. Labor cost to 20 into 8, 160. 160. Next year, overhead rate equal to 6 rupees per mission hour. 14 into 6. 84, sir. 84. 84 plus 160 plus 120 is equal to 364. Is equal to 364. Correct answer. Now, going to activity based costing system. Here total production overheads can be identified 4 major activities. So mission setup cost activity, mission running cost activity, inspection cost activity, material procurement activity. Amounts readily available. Then CDQ values, sir. CDQ values not ready, sir. Please ready the CDQ values. Here number of purchase orders per batch 3, sir. 150 per batch. Number of purchase orders per batch. Per batch 3. In case of P. In case of Q 10. In case of R 8. Number of inspections per batch 5, 4, 3. Okay. Right. Here mission setup cost. Driver name is setup time. Number of setups. Here number of setups. 1 minute. Machine setup cost 4,80,000, sir. Driver name, number of setups. Number of setups. Number of setups. Next, machine running cost 7,20,000, sir. Driver name, number of mission hours. Inspection cost, here number of inspections readily available. Material procurement cost, number of orders. Here, see the solution, sir. Assignment 5. Yes. One minute. Sir, this is ABC, sir. So here problem change, sir. So 1 minute. I will do, sir. So here there is no printer solution, sir. I will do, sir. Next, calculate the cost driver quantities. Next, cost driver rates. Cost driver rates. Calculation of cost driver rates. So activity based costing. So first step 1, calculation of cost driver rates. Cost driver rates. cost driver rates. Number 1, column 1, cost pool name, cost pool name or activity name or activity name. Next, cost pool in rupees, cost pool in rupees. This is assignment 5, sir. Assignment 5. Assignment 5. Assignment 5. Already traditional completed, sir, orally. Next, activity based costing. So cost pool in rupees. Next, cost driver name, sir. Next, cost driver quantity. Next, cost driver rate, sir. Cost driver rate. Okay. So first, here total overheads, total production overheads can be identified 4 major activities. Machine setup activity, machine setup activity, machine setup activity. Next, machine running activity, machine running activity. Next, the inspection activity, inspection activity, inspection activity. Next, the material procurement activity, material procurement activity, procurement activity. Machine setup activity, machine running activity, inspection activity, procurement activity. Okay. Cost pool amounts 4,80,000, 4,80,000. Next, 7,20,000, 7,20,000. Next, 9,60,000. Next, 2,40,000, 2,40,000. So total 2,40,000 plus 9,60,000 plus 7,20,000 plus 4,80,000 is equal to 24 lakhs. Next, assign the driver names, driver quantity, then calculate the cost driver rates. Assignment 3 under progress, sir. So first bit already completed, sir. Cost per unit of each product using traditional method already completed, sir. So answers already checked, sir. Okay, next second bit to calculate the cost per unit of each product using activity based costing, sir. Under activity based costing, first we have to calculate cost driver rates. Before doing this step, first total overhead cost can be identified by major activities, sir. 1, 2, 4 major activities, sir. Machine setup activity, Cost amount 4,80,000. Machine running activity 7,20,000. Next, inspection activity 9,60,000. Next, metal procurement activity 2,40,000. Total 24 lakhs. Next, cost driver name, sir. Here, machine setup cost, sir. Number of setups. Here, number of setups not given, sir, then equivalent to number of batches. Number of setups, if number of setups not available, then take the number of batches. Number of batches. Number of batches. Next, activity, machine running activity. Machine running activity, machine hours, sir. Machine hours. Machine hours. Next, inspection activity, sir. Number of inspections. Number of inspections. Number of inspections. Number of inspections. Next, next activity, material procurement activity. So number of orders, sir. Number of orders. Number of procurement orders. Simply number of orders. Right. So here number of batches, sir. P production volume 3,000 units, sir. PQ production volume 5,000, sir. R production volume 20,000, sir. So number of batches equal to so each batch volume 150 units. For 3,000 production, number of batches to be prepared, sir. 3,000 divided by 150, that equal to 20 batches. Next, each batch in case of Q, each batch volume equal to 500 units, sir. So for 5,000 production activity, number of batches to be prepared, 5,000 divided by 500, sir, is equal to 10. Next, 20,000 divided by 1,000 is equal to 20. So total 50 batches, sir. 50 batches. So here total CDQ 50 batches. 50 batches. Next, mission hours, sir. Mission hours already calculated, sir. Here mission hours 10 hours per unit, sir. For 3,000 units, 30,000 hours, sir. Next, 5,000 into 18, sir. 90,000 hours, sir. Next, 14 into 20,000, sir. 14 into 20,000 is equal to 2,80,000 hours, sir. Total 2,80,000 plus 90,000 plus 30,000 is equal to 4 lakhs hours, sir. 4 lakhs hours. 4 lakhs hours. Next, number of purchase orders per batch. Per batch 3 orders, sir. Here 20 batches. 20 batches into 3, 60 orders. Next, 10 batches into 10, 100. Next, 20 batches into 8 equal to 160. 160. So 60 plus 100 plus 160 is equal to 320, sir. 320. 160 plus 160, 320. So 320 purchase orders, sir. 320 purchase orders. 320 purchase orders. Next, inspection, sir. Here number of inspections per batch 5, sir. Here total batches 20. So 20 into 5, 100. 4 into 10, 40. 3 into 20, 60. So 200, sir. 200. 200 inspections. 200 inspections. Now calculate the cost driver rate. 4,80,000 divided by 50. 4,80,000 divided by 50 is equal 9,600 rupees per batch. Next, 7,20,000 divided by 4 lakhs equal to 7,20,000 divided by 4 lakhs hours. So 1.8 per hour. 1.8 per hour. Next, 9,60,000 divided by 200 inspections. 9,60,000 divided by 200 is equal 4,800 per inspection. Next, 2,40,000 divided by 320, 750. 2,40,000 divided by 320 is equal to 750 per order, per purchase order. So these are the cost driver rates. These rates are used for charging the overheads to the respective products. So next, statement of apportionment of overhead cost. Statement of apportionment of overhead cost. Statement of apportionment of overhead cost and overhead cost per unit. Overhead cost per unit. Overhead cost per unit. Particulars. Product A, product B, product C. Product C. TDQ amount. TDQ amount. TDQ amount. So first one, machine setup cost. Sir, here product names not ABC, sir. PQR. Okay. PQR. PQR. Okay. Right. Next. First one. Machine setup cost, sir. Machine setup cost. Machine setup cost. CDQs, number of setups. Here number of batches. Here number of batches, 20 batches, 10 batches, 20 batches. So 9,600, sir, per batch. 9,600. 9,600 into 20 equal to 1,92,000. Next, 9,600 into 10, 96,000. 9,600 into 20. 1,92,000. Okay, next one. Machine running cost, sir. Machine running cost. So, machine running cost, machine hours, sir. Here, machine hours 30,000 hours. 30,000 hours. Next, 90,000 hours. Next, 2,80,000 hours. 2,80,000 hours. Rate 1.8, sir. 1.8. 30,000 hours into 1.8 is equal to 54,000. Next, 90,000 into 1.8, 1,62,000. Next, 2,80,000 into 1.8 into 1.8, 5,04,000. 5,04,000. Next to inspection cost, sir. Inspection cost. Inspection cost. So number of inspections, sir. Number of inspections 100, 40, 60. 100, 40, 60. 100 inspections, 40 inspections, 60 inspections. So rates are inspection rate 4,800, sir. 4,800. 4,800 into 100 is equal to 4,80,000. Next, 4,800 into 40, 1,92,000. 4,800 into 60, 2,88,000. This is the inspection cost, sir. Next, material procurement cost. Material procurement cost. Material procurement cost. Orders. Material procurement cost orders. Here 60 orders, 60, 100, 160. 60 orders. Next, 100 orders. Next to 160 orders. Rate 750, sir. 60 into 750, 45,000. Next, 750 into 100, 75,000. Next, 160 into 100, sorry, 750 into 160, 750 into 160, 1,20,000, 1,20,000, 1,20 plus 75 plus 45, 2,40,000. Correct. Now, total EOH. Sir, 1,92,000 plus 54,000 plus 4,80,000 plus 45,000. 7,71,000, sir. 7,71,000. Next product, second product Q, 96,000 plus 1,62,000 plus 1,92,000. Next 75,000 is equal to 5,25,000. 5,25,000. 1,92,000 plus 5,04,000 plus 2,88,000 plus 1,20,000. 11,04,000. 11,04,000. This is A. This is B. This is A, sir. EOH. B. Production in units. Production in units. Production in units. 3,000 units. 3,000 units. B. 5,000 units. 5,000 units. 5,000 units. Next 20,000 units. 20,000 units. Now, overhead cost per unit. Overhead cost per unit. 7,71,000 divided by 3,000 equal to 257, sir. Next 5,25,000 divided by 5,000. 105, sir. Next 11,04,000. 11,04,000 divided by 20,000 is equal to 55.2. Once again, 11,04,000 divided by 20,000 units, 55.2. Now calculate the unit cost, sir. Now calculate the cost per unit. Simple, sir. Here material cost per unit 90, sir. Labor cost per unit 4 into 20 rupees. 4 into 20, 80 rupees, sir. 80 rupees. Next overhead cost per unit 257. 257. Add them 90 plus 80 plus 257. 427 answer, sir. 427 correct answer. Next one. Next one. 80, sir. Here hourly rate 12 into 20. 12 into 20 is equal to 240. 240, 80, 240, 105, sir. 105. So 105, 240, 80. 425 answer, sir. Please check it. Correct answer. Next one. Direct material cost per unit 120. Next 8 into 20, 160. Next 55.2. 55.2. 55.2 plus 160 plus 120 is equal 335.2, sir. Yes, correct answer. 335.2. So this is the ABC costing, sir. Next to service costing, sir. Service costing. Service costing, sir. Cost is ascertained where the services are rendered. Cost is ascertained where the services are rendered. Such type of cost ascertaining program is calling as service costing. Service sectors examples, sir. Transportation service sector, hotel service sector, next hospital service sector. So these are the examples. First, transportation service sector, sir. Transportation service sector. Transportation service sector. Transportation service sector. In this segment, two components are there. Passenger transportation service. Passenger transportation service. Passenger transportation service. Next to goods transportation service. Goods transportation service. Goods transportation service. Passenger transportation service, goods transportation service. Right. So first passenger transportation service. So in this case, first we have to calculate cost per passenger kilometer. Cost per passenger kilometer. Cost per passenger kilometer is equal operating cost per annum divided by passenger kilometers per annum. Passenger kilometers per annum. Sir, how to calculate passenger kilometers per annum, sir? Number of buses into distance covered in one way into number of one-way trips per day into number of operating days in a month into number of months in a year. Number of buses, distance covered in one way, number of one-way trips per day, number of days in a month, number of months in a year, number of months in a year, equal to total kilometers run into average number of passengers occupied. Sir, how to calculate average number of passengers occupied? Total seats in a bus into percentage of occupancy. Then we get the average number of passengers occupied. So average number of passengers occupied into run kilometers. Then we get passenger kilometers per annum. How to calculate operating cost per annum, sir? Simple, sir. Variable charges, fixed charges, semi-variable charges. These three elements summation is nothing but operating cost. So first we have to prepare the operating cost sheet. In operating cost sheet, expenses classification, variable, fixed, semi-variable. So here variable charges. First one, fuel consumption. Next one, other chemical solution, that is the engine oils, cost of engine oil. Next, consumable stores. Depreciation on vehicle on running basis. These are the examples for variable charges. Semi-variable charges, only repairs and maintenance. Remaining all fixed category. Okay. Next, fare rate per passenger kilometer. Fare rate per passenger kilometer. Fare rate per passenger kilometer is equal to total takings per annum divided by total takings per annum divided by passenger kilometers per annum. Total takings per annum divided by passenger kilometers per annum. Sir, how to calculate total takings, sir? First of all, we have to calculate operating cost, then add the margin. We get the total takings per annum. Total takings per annum divided by passenger kilometers per annum. Then we get fare rate per passenger kilometer. Fare rate per passenger kilometer. So these are the main points regarding the passenger transportation services. Okay, now start the problem. The following information relates to a bus operator. Cost of the bus 50 lakhs. Lifetime 5 years. Total seating capacity 50 passengers. Average capacity which is used 90%. Therefore, average number of passengers occupied 90% of 50. So 45, sir. Next, number of round trips per day 4. Next, number of round trips per day 4. Next, distance of route distance 20 kilometers. That means one way distance 20 kilometers. Working days in a month 25. So here cost of the bus 50 lakhs. So that means here a bus, that means one bus, distance covered in one way 20 kilometers. Number of one way trips per day, round trips 4. Number of one way trips per day 8. The round trips 4 means number of one way trips 8, sir. To and fro. Number of one way trips per day. Number of operating days in a month 25 days. Number of months in a year 12 months. Number of months in a year 12 months. Equal to total run kilometers per annum. So 1 into 20 into 1 into 20 into 8 into 25 into 12, 48,000. Here one important point, sir. Normal percentage of vehicles laid up for repairs. So here total run kilometers, out of that 5% due to repairs, sir, laid down. So therefore take the only 95%. 95% is equal to 45,600. 45,600 into average number of passengers occupied 45, sir. 45,600 into 45 is equal to 2 lakhs, 20 lakhs, 52,000, 20 lakhs, 52,000 passenger kilometers. Passenger kilometers. 20 lakhs, 52,000 passenger kilometers. 20 lakhs, 52,000 passenger kilometers. See the question. Correct, sir. 20 lakhs, 52,000 passenger kilometers per annum. Now, calculate the operating cost. Sir, interest, fixed charges are 12% per annum. So 12% of 50 lakhs. Next, kilometers per liter of fuel. So here, mileage per liter of fuel equal to 20 kilometers. For 20 kilometers run, 1 liter fuel consumption. For 45,600 liters, 45,600 kilometers run, number of liters consumed. 45,600 divided by 20 is equal to 2,280 liters. 2,280 liters. Right. Here, cost of fuel 700 rupees per liter per 10 liters, sir. So per liter 70 rupees, sir. 2280 into 70 is equal to 1,59,600. 1,59,600. So that is the variable charges, sir. So 1,59,600 cost of diesel consumption. Next, repairs and maintenance, that is semi-variable, sir. Next, salary to supervisor, that is fixed, sir. This is fixed. This is also fixed. Repairs and maintenance semi-variable, sir. Semi-variable. Taxes and insurance also fixed, sir. Road license fixed, sir. Engine oil and lubricants for 1200 kilometers run 2500, sir. 1200 kilometers run 2500. 1200 kilometers run 2500, sir. So here 45,600 kilometers run. 45,600 kilometers run. Question mark. So 2500 divided by 1200 into 45,600 is equal to 95,000, sir. Yes, correct answer, 95,000. So add them, sir. Fixed charges, salary of driver, salary of conductor, salary of supervisor, road license, taxes and insurance. Here depreciation periodic basis, sir. So that will be shown under the fixed charges. Next, interest, that is the fixed charges. So finally total fixed charges 30,64,000. Next, variable charges, only two elements: cost of diesel consumption, engine oil, lubricants. Total running charges 2,54,600. Semi-variable charges only one element, sir, repairs and maintenance. That is 2,40,000. So add these three, then we get the total operating cost 35,58,600. Right. So here clearly mentioned, assuming 15% profit on total takings. Here total takings equal to 100%, sir. Total takings 100%, sir. Total takings 100%. Out of that 15% takings margin, that is the profit margin. Next, 10% takings as commission. Remaining 75% operating cost. So here operating cost 75%, sir. Operating cost 75%. Operating cost 75%. So 75% cost 35,58,600. 35,58,600 divided by 75 into 100. Then we get the total takings 47,44,800. Next commission, next profit. So ultimately we get total takings 47,44,800. Here question is asking calculate the fare rate per passenger kilometer. So fare rate per passenger kilometer equal to total takings per annum divided by passenger kilometers per annum. Finally 2.31228. So this is the fare rate per passenger kilometer. So in case of road transportation, that is the ton kilometers per annum, sir. In case of road transportation, outward journeys and return journeys are calculated separately. So in case outward journeys, definitely with load, sir. But in case of return journeys, sometimes with load, sometimes without load, sir. So calculate separately and then add. We get the total ton kilometers. Total ton kilometers. Here question is asking calculate cost per ton kilometer. Formula total operating cost divided by ton kilometers per annum. Ton kilometers per annum. Then we get the cost per ton kilometer. So in road transportation, ton kilometers calculated differently. Outward journeys calculated separately, return journeys calculated separately. So add them, then we get the total ton kilometers, like that. Okay. So that is the transportation service. Next, hotel service, sir. Hotel service. Hotel costing. Hotel costing. Hotel costing. In hotel costing, cost units are cost unit, room days, room days. So first we have to calculate room days per annum. So room days per annum equal to number of rooms in a hotel, number of rooms in a hotel, number of rooms in a hotel, number of rooms in a hotel into percentage of occupancy, percentage of occupancy, number of rooms in a hotel into percentage of occupancy. Next, number of operating days in a month, number of operating days in a month into number of months in a year, number of months in a year. So number of rooms in a hotel into percentage of occupancy into number of operating days in a month into number of months in a year. So our number of rooms in a hotel, number of rooms in a hotel into percentage of occupancy into number of operating days in a year. So here number of operating days in a month into number of months in a year. Simply number of operating days in a year. Number of operating days in a year. In a year. So number of rooms in a hotel into percentage of occupancy into number of operating days in a year. So first of all we have to calculate room days per annum. Some expenses completely depends on room days. Those are calling as variable charges. So here variable expenses, room attendant wages, heating charges, lighting charges. Heating charges, lighting charges completely depends on the room occupancy. So when room was occupied, room attendant wages incurred. Next, lighting charges and heating charges incurred. So these are the variable charges. Semi-variable charges, one and only one, repairs and maintenance of hotel buildings and hotel equipments. Next, remaining all fixed charges. So then prepare the operating cost sheet, we get the operating cost. Add margin, we get total takings. Total takings divided by occupied room days. Then we get the rent to be charged per room day. So rent to be charged per room day equal to total takings divided by days, room occupied days. Then we get the rent to be charged per day. So this is the brief explanation for hotel costing. Take the problem. So a hotel is being run in a hill station with 200 single rooms. The hotel offer concessional rates during 6 off-season months in a year. So here off-season months 6 months, seasonal months 6 months. During the period of half of the full room rent is charged. During the off-season, half of the full room rent is charged. The management profit margin is targeted at 20% of the room rent. Okay. The following are the cost estimates and other details for the year ending 31st March 2019. Occupancy during the season 80%, in off-season 40%. So here hotel contains 200 single rooms. Okay, right. So CRD 10. Room days. Calculation of room days per annum. First, season. During the season period, during the season, number of rooms in a hotel 200 rooms, percentage of occupancy 80%, sir. Percentage of occupancy 80%. Next, number of days in a month. Number of days in a month 30 days, sir. 30 days. Number of seasonal months 6 months. 6 months. So that is equal 200 into 80%. 160 into 30 into 6 is equal 28,800 room days. Next, half season, sir. Half season 200 rooms into percentage of occupancy. Percentage of occupancy 40%, sir. Yes, 40%. 40% into 30 days into 6 months is equal 200 into 40% into 30 days into 6 months, 14,400 room days. So total occupied room days equal to total occupied room days per annum. Total occupied room days per annum equal to 14,400 plus 28,800 is equal to 43,200. This is total occupied room days per annum. Total occupied room days per annum. Now calculate the variable charges. Variable charges completely depends on room occupied days. First one, room attendant wages. So on the basis of occupancy of rooms in a month, so room attendant's wage equal to 43,200 occupied room days into wages 15 rupees, sir. Occupied room day 15 per occupied room day 15 rupees wage amount. So 43,200 into 15 is equal to 6,48,000. Next, here one important point, sir. Sixth point, monthly lighting charges are 110 rupees, sir, except in 4 months in winter. In winter, only 30 rupees per room. Okay. So, and this cost on the basis of full occupancy for a month. Okay, sir. So, here, winter period, part of half season, sir. Half season part 6 months, sir. Out of 6 months, half season part, 4 months winter part, sir. Okay, right. Next, so calculation of lighting charges. Calculation of lighting charges. Season. In season, lighting charges 110 rupees per month, sir. Monthly lighting charges, sir, 110 rupees, sir. So per day 110 divided by 30. is equal 3.666666. So these in season period occupied room days equal to 28,800. 28,800 into 110 by 30. So per day 3.666666. Okay. So final amount to is equal 1,05,600, sir. 1,05,600. 600. Please check it. 28,800. 28,800 into 110 divided by 30. So 1,05,600. Next off season. Off season. Non-winter months, sir. Non-winter months. Non-winter period. So non-winter period 2 months, sir. So 200 rooms. 200 rooms into 40%. Off-season occupancy 40% into 30 days. Into 30 days. Into 2 months. Into 2 months. That equal to 200 into 40%. 80 into 30 into 2 is equal to 4,800 room days into 110 by 30. So 110 by 30 into 110 divided by 30. 17,600. Next, winter. 200 rooms into 40%, 30 days into 4 months. Into 4 months. So 200 into 40% into 30 into 4. 9,600 room days into 30 by 30. In winter, monthly charges 30, sir. 30 by 30. So 9,600 rupees. So finally, lighting charges equal to total lighting charges. Total lighting charges. Total lighting charges. 1,05,600 plus 17,600 plus 9,600. So 9,600 plus 17,600 plus 1,05,600 is equal to 1,32,800. 32,800. So this is 1,32,800. Okay. Room attendant wages 6,48,000. 6,48,000. Okay. Next, staff salaries excluding the room attendants, so 8 lakhs. Okay. Right. Repairs of building. So this is variable, sir. Next, laundry charges. Okay. Fixed. This is fixed. This is fixed. Interior charges fixed. Miscellaneous expenses fixed. Okay. Next one. Annual depreciation is to be provided. Buildings 5%, sir. So here buildings cost to total investment of hotel 300 lakhs, sir, of which 80% relates to building. So 80% is 240 lakhs. 300 into 80%. 240 lakhs. 240 lakhs into 5%. So 12 lakhs. 12 lakhs. Next, balance 20%, sir. That is furniture and other equipments. So 20% of 300, 300 into 20%, 60. 60 into here depreciation 15%, sir, into 15%, 9 lakhs. 9 lakhs. Next, the monthly lighting charges 1,32,800. So add them, sir. Add them. So 6,48,000 plus 8 lakhs, 8 lakhs, 8 lakhs plus 3 lakhs plus 1,40,000 plus 2,50,000 plus 2,200,000 plus 12 lakhs plus 9 lakhs plus 1,32,800 is equal to 45 lakhs 71,000. 45 lakhs 71,000. So here 45 lakhs 71,000, sir. Profit 20% of the room rent. Room rent 100%, sir. Out of that profit margin 20%, sir. Cost equal to 80%. So divide by 80 into 100 is equal to 57 lakhs 13,750. 750. Now equivalent to off-season room days or equivalent to full season room days. Sir, here already room days calculated, sir. Room days calculated, sir. So in season rental charges, you clearly mentioned during the period of off season, half of the full room rent to be charged. So that means 14,400 off season room days collection equal to 14,400 into 50%. So 7,200, sir. So 14,400 off season room days collection equal to 7,200 seasonal room days collection, sir. Simple. 14,400 into 50%, 7,200. 14,400 off season room days collection equal to 7,200 seasonal room days collection. So finally 28,800 plus 7,200 is equal to 36,000 equivalent seasonal room days. Equivalent seasonal room days. So divide by 36,000. So 36,000. Now 57 lakhs 13,750 divided by 36,000 is equal to 158.71, sir. 158.71. Yes, 158.715 means 158.715, sir. So approximately 158.72. That is the correct answer. So that is the rent chargeable per day during the season. In off season, take the 50%, 79.36. So this is the hotel costing, sir. Okay. Now next chapter, cost accounting system. Nothing but bookkeeping. So in cost accounting, bookkeeping, two types. Non-integrated accounting system. Non-integrated accounting system. Integrated accounting system. So non-integrated accounting system, integrated accounting system. Non-integrated accounting system, two separate sets are maintained. Where it is a system of accounting, two separate sets are maintained. One for cost records and another for financial records. So in this system, reconciliation statement is required. Okay. So non-integrated accounting system, where it is a system of accounting. Non-integrated accounting system, it is a system of accounting where two separate sets are maintained, one for cost records and another for financial records. Reconciliation statement is required. Integral accounting system, it is a system of accounting where only one set of books are maintained, only one profit and loss account, no need of reconciliation statement. So that is the difference between non-integrated accounting system and integrated accounting system. Non-integrated accounting system, classification of accounts. So three real accounts, three real accounts, that is raw material control account, raw material control account, next work in progress control account, next finished goods control account, finished goods control account, finished goods control account, next all nominal accounts, all nominal accounts, all nominal accounts, all nominal accounts, three real accounts, all nominal accounts. Here one thing is observed, here personal accounts are not maintained. Sir, how to fulfill the double entry system in this system, sir? Here one artificial account is used for fulfilling the double entry system. That artificial account name is cost ledger control account. Cost ledger control account. Cost ledger control account. Okay, this account is used for fulfilling the double entry system. For example, raw material purchased on cash. In financial books entry, raw material account it are to cash account. In cost accounting, raw material control account it are to, here cash account is not maintained, so that use the cost ledger control account. So final entry raw material control account it are to cost ledger control account, like that. Okay. So this is the non-integrated accounting system. Here reconciliation statement is required. Is the problem. Amar Manufacturing Company opens the costing records with the balance on 1st July 2020 as follows. Here material control account shows a debit balance of 62,000, working process control account 31,250, finished goods control account 62,000. So these three are real accounts. This is running business. So opening balances directly given. Next, production overhead control account 4,200. So last period under recovery of production overheads carry forward, sir. Same policy will be followed in current period also. Administrative overhead control account excess credit balance, that is over absorbed. So that is carry forward to next period. Selling and distribution overhead control account excess debit balance, that is the under absorbed, Simply carry forward. Cost ledger control account 1,56,575. The following are the transactions for the quarter ended 30th September 2020. That means here second quarter transactions are given in the problem. Materials purchased, sir, raw material control account at R2, cost ledger control account. Either cash or credit. Here cash account not maintained, personal accounts not maintained. So that raw material control account at R2, cost ledger control account. Next, material issued to job, work in progress control account at R2, raw material control account. Material issued to work maintenance, that is the factory overhead control account at R2 or production overhead control account at R2, raw material control account. Next, raw material issued to administrative department, admin overhead control account at R2, raw material control account. Raw material issued to sales department, selling and distribution overhead control account at R2, raw material control account. So now closing balance, find out the closing balance. See the answer. So here opening balance, sir. Here real account opening balance always shows debit balance. Next purchase. Next raw material issued to production. Next raw material issued to maintenance, factory maintenance. Raw material issued to admin department. Raw material issued to selling and distribution department. Therefore closing balance equal to 37,450. Next wage control account. So here total wages equal to 74,650 plus 32,500 is equal to 1,07,150. 1,07,150. So that is the total wages paid. So wage control account at R2, cost ledger control account. Here cash account is not maintained. Next, how much amount charged as a direct wage? 74,650. That is the work in progress control account at R2, wage control account. Next, indirect wage. So here there is no specific information. That means indirect wages related to production. Production overhead control account at R2, wage control account. So see the solution. So total wage paid 1,07,150. Out of that 74,650 charged as a direct wage, 32,500 charged as a indirect wage related to production. Okay. Next one, transportation for indirect materials. So that is the production overhead. Other production overheads incurred 1,21,125. So total production overheads incurred 1,21,125. 1,21,125 plus 4,200 is equal 1,25,325. 325. Now take the production overhead control account. In production overhead control account, what are the transactions involved in this account? First, production overhead charged to production. So that is the work in progress control account at production overhead control account. So here production overhead charged amount, where it is given, sir? Here given production overhead charge. In cost accounting, how much production overhead amount charges are 1,79,550. Then compare with actuals. Actual indirect material relating to factory, actual indirect wage relating to factory, actual indirect expenses relating to factory. See the account, sir. So here first charge. From work in progress control account debit to production overhead control account. Next, indirect expenses relating to production actually incurred. Indirect wage relating to factory actually incurred. Indirect expenses relating to factory actually incurred. Okay. So finally, closing balance under absorbed, sir. Under absorbed. So carry forward to next period. Next. Admin overheads. Sir, admin overheads charged to production 26,450. Admin overhead charged to sales department 7,400. So here two charges are there. One charge related to production, one charge related to sales. So here one charge related to production, work in progress control account data to admin overhead control account. Next, cost of sales account debit to admin overhead control account. So two charges. Next, compare with actuals. Then calculate undercharge or overcharge. Right. See the answer. Here, two charges, sir. One is cost of sale, charge 1, and another one is finished goods control account. So here there is an option, sir, either finished goods control account or work in progress control account. So there is an option. Some companies follows work in progress policy, some companies follows finished goods policy. Okay, right. So here in this problem, company follows finished goods policy. So here admin expenses charged to finished goods, sir. Some companies directly administrative overheads related to production charged to work in progress. So two policies are there, either work in progress policy or finished goods policy. Both are valid, sir. Right. Next. So here overcharge, carry forward, sir. Overcharge. Next, work in progress control account. So here work in progress control account, two balance brought down, metal issued to production, payers charged to production. Next, direct expenses charged to production, factory overhead charged to production. Some people admin overheads also charged to production, but here admin overhead charged to finished goods, sir. So finally, total work in progress cost incurred 5,24,150. Out of that, fully completed amount 4,79,200. Remaining amount to 44,950. That is the closing balance of work in progress. Next, finished goods control account. So here finished goods control account, opening balance. Administration overhead charged to finished goods. Okay. Next, to current period production transfer from work in progress 4,79,200. So total goods available 5,67,650. Out of that, closing inventory of finished goods 79,000. Remaining cost of sales. Next, selling and distribution overheads. So here charge. See the question. Here selling and distribution overheads charge amount is 41,000, sir. So 41,000. Cost of sales account debit to selling and distribution overheads account. Cost of sales account debit to selling and distribution overhead control account. Next, compare with the actuals. Then find out the undercharge or overcharge. So here overcharge, sir. Next, finished goods produced. So where it is placed, sir? It is placed in work in progress control account. So finished goods control account data to work in progress control account, sir. Next, finished goods sold. Where it is placed, sir? In finished goods control account. So cost of sales account debit to finished goods control account. Next, sales 7,21,500. So finally, profit or loss. Here profits are profit as per cost records equal to 1,84,450. Then prepare the trial balance on 30th September 2020. So this is the non-integrated accounting system. Okay. Now in this system, definitely you should prepare reconciliation statement. So here cost record shows 1,84,450 profit, but financial record shows some other balance. So there is a deviation between these two. So what are the causes, sir? 5 causes. Number 1, pure financial items and non-cost related items are appearing only in financial books, not in cost books. Pure financial items and non-cost related items are appearing only in financial books, not in cost books. That's why these two books are deviated. Next, non-operating incomes. Non-operating incomes are appearing only in financial books, not in cost books. Next, notional item. Notional items are appearing only in cost books. Notional items are appearing only in cost books, but not in financial books. That's why these books are deviated. These books profits are deviated. So 2 completed. Next one, method of depreciation. Next, method of inventory valuation. Method of inventory valuation. Next one, under or over absorbed overheads. Under or over absorbed overheads. In cost accounting, estimated overheads are charged. In financial accounting, actual overheads are charged. Sometimes estimations are more than the actuals. Sometimes actuals are more than the estimations. So that these books profits are deviated. Okay. So these are the 5 causes. Pure financial items and non-cost related items and non-operating incomes are appearing only in financial books, not in cost books. Next, notional items are appearing only in cost books, but not in financial books. Next, under or over absorbed overheads. Next, method of inventory valuation. Next, depreciation. Method of depreciation. Right. Take the next one. Next. Assignment 8, sir. Assignment 8. The following is the summarized trading and profit and loss account of XYZ Limited for the year ending 31st March 2019. So here financial records disclose a net profit of 3,22,500. So direct material cost actually incurred 14,16,000. Direct wage cost actually incurred 7,42,000. Sir, in financial statements only actuals are noted. Works overheads incurred. So this is financial statement. This is incurred value. That is actually incurred value. Next, administrative overheads actually incurred. Selling and distribution overheads actually incurred. Next, sales 30,000 units, finished stock 2,000 units, work in progress value 54,000. So here opening inventory is nil, sir, but closing inventory is there. So total production volume equal to assignment 8, sir. Assignment 8. Right. So production volume equal to production in units. Production in units equal to sales in quantity plus closing stock in quantity minus opening stock in quantity. That sales in quantity 30,000 units plus closing stock in quantity 2,000 units minus nil 32,000 units. Next, the company cost records show that course of manufacturing a standard unit works overhead have been charged 20% on prime cost. So that is the factory overhead rate equal to 20% on prime cost. Administration overheads are charged with the production activities and were recovered at 5% per finished unit. Here finished units equal to, that is the production volume equal to 32,000 units. So 32,000 units into 5. Selling and distribution overheads are estimated at 6 rupees per unit sold. Here sales volume equal to 30,000 units into 6 rupees. So here recovery rates are already calculated. So company cost accountant had already calculated recovery rates. Right. You are required to prepare costing profit and loss account indicating the net profits. So here simply prepare the cost sheet, sir. No need to prepare the all ledger accounts. Directly prepare the cost sheet. So while preparing the reconciliation statement, in that case, profits as per cost records simply through cost sheet. Simply through cost sheet, sir. So cost sheet. That is the cost statement. Cost sheet. Particulars, amount. Amount. Particulars, amount. So direct material cost. So in cost records, there is no information about the direct materials. That means in both books, that is same. So direct material cost equal to 14,16,000. 14,16,000. Next, direct wage cost equal to 7,42,000. 7,42,000. Prime cost. 14,16,000. 14,16,000 plus 7,42,000 is equal 21,58,000. 21,58,000. 21,58,000. Add factory overheads charge. Here recovery rate directly given in the problem. 20% on prime cost. 20% on prime cost. So here prime cost equal to 21,58,000 into 20%. 4,31,600. So plus 21,58,000 is equal 25,89,600. That is gross factory cost. Here adjust the inventory levels of work in progress. Opening should be added, closing should be deducted. So here opening inventory of work in progress nil, sir. Closing inventory of work in progress 54,000. So there is no discussion in cost records about the work in progress. Simply both books value is same. In both books value is same. So less cost of closing inventory of work in progress. Closing inventory of work in progress 54,000. 54,000. So 25 lakhs 35,600. 25 lakhs 35,000. That is net factory cost. Net factory cost. Add administrative overheads. Administrative overheads. Administrative overheads related to production. Related to production. Administrative overheads related to production. Administrative overheads related to production. Here admin overhead recorded equal to 5% per finished unit. So here total finished unit sum 32,000 units. 32,000 units sum into 5 rupees. 32,000 into 5 rupees. So 16 lakhs. in lakhs. 25 lakhs, 35,600 is equal to 41 lakhs, 35,600. So COP, cost of production. So cost of production. The cost of production of 32,000 units. So here opening inventory of finished goods nil, sir. Cost of closing inventory of finished goods. Closing inventory of finished goods. Closing inventory of finished goods. So for here there is no information about the inventory valuation. Simply follow the FIFO method. FIFO method means current period production cost. Here current period production cost per unit to 41,35,600 divided by 32,000 is equal to 129.375. So that is 41 lakhs 35,600 divided by 32,000 units into closing stock volume, sir. Closing stock 2,000 units. So into 2,000. So 25,000, 2 lakhs 58,475. So final answer 38 lakhs 77,125. This is the cost of goods sold. This is the cost of goods sold. Next, add absorbed selling and distribution overheads. Distribution overheads. That is, here selling and distribution overhead recovery rate equal to 6 rupees per unit sold. 6 rupees per unit sold. So here 6 rupees per unit sold. Here sales volume equal to 30,000 units. 30,000 units. 30,000 into 6. 1,80,000. So 1,80,000 plus 38,77,125 is equal 40,57,125. 125. So this is the total cost or cost of sales. Cost of sales. So sales value, sir, 30 lakhs. Sales value 30 lakhs. Sales value 30 lakhs. So add or less profit or loss. So difference ten lakhs 57,125. Loss. Loss, sir. One minute. This is the problem number 8. Right. Here cost of production prime cost 21,58,000. Please check it. Yes. Next to factory cost 25,35,600. Correct. Administrative overheads 32,000 into 5. 1 minute, sir. Here a small error, sir. Not 16 lakhs, that is 1,60,000. The typographical error 1,60,000. 1,60,000. Next 1,60,000 plus 25,35,600 is equal 26,95,600. Okay. 26,95,600 divided by 32,000 into 2,000 is equal 1,68,475. 475. Right. Now 26 lakhs 95,600. 25 lakhs 27,125. So now compare with 30 lakhs. So okay, now check the answer. In this question, selling and distribution order 6 rupees. Okay. So COGS 25 lakhs 27,125. Okay. Next 1,80,000. Next. Here cost of sales amount to 1 minute. 25 lakhs 27,125 plus 1,80,000. So 27 lakhs 7,125. 125. Right. Next 30 lakhs difference. 2 lakhs 92,875. 2 lakhs 92,875. Yes, correct answer. So here a typographical error, sir. So 1,60,000, sir. 1,60,000, not 16 lakhs. 1,60,000. So here in cost records, profit as per cost records 2,92,875. But profit as per financial records 3,22,500. So there is a deviation. There is a deviation. Right. Now prepare the reconciliation statement. Reconciliation statement. Reconciliation statement. Reconciliation statement. Reconciliation statement. particulars amount. Particulars amount. Right. Net profit as per cost records. Net profit as per cost records. So net profit as per cost records 2,92,875. 92,870. Then add items and less items. Right. First cost. Pure financial items, non-cost related items, and non-operating incomes are appearing only in financial books, not in cost books. But in financial books, no pure financial items, no non-cost related items, no operating incomes. So no need to reconcile. Number 2, under or over absorbed overheads. Yes. So here in cost accounting, factory overheads amount charged 4,31,600. In financial accounting, actually incurred 4,26,000. So that in cost accounting, overhead expenses overcharge. Expenses overcharge, ultimately cost records profits decrease. So you should add. Add. Factory overheads overcharge. Their expenses overcharge in cost books, ultimately cost books profits decrease. Treatment you should add. Ultimately we get net profit as per financial records. Sir, how much amount added, sir? 4,31,600 minus 4,26,000. 5,600, sir. Next, in cost accounting, administrative overheads charged 1,60,000. 1,60,000, but actually incurred 1,50,000. These expenses also overcharge. Admin expenses overcharge in cost books. So expenses overcharge in cost books. Ultimately, cost books profits decrease. So treatment add. Admin overheads overcharge. Amount, sir. 1,50,000, 1,10,000, sir. Next, selling and distribution. In cost accounting, selling and distribution or charge 1,80,000, sir. Here 1,65,000. This is also overcharge. So expenses overcharged in cost books. Expenses overcharged in cost books. Ultimately, cost books profits decrease. Treatment you should add. Selling and distribution overheads overcharge. So 1,80,000 minus 1,65,000, 15,000. Next, 2 points completed. Nostal items, third point. Nostal items are appearing only in cost books, not in financial books. Here, nostal items nil, sir. Next, depreciation nil, sir. Next, inventory valuation. Work in progress, inventory of work in progress, same in both books, no need of reconcile. Next, inventory of finished goods, sir. So in cost accounting, closing stock of inventory of finished goods 1,68,475. In financial accounting 1,67,500. So here closing inventory overvalued, sir. Closing inventory means credit item. Credit item is overvalued in cost books. Ultimately, cost books profits increase. So cost books profits increase. Treatment you should deduct. Sir. So closing inventory of finished goods overvalued. So difference 1,67,500, 1,67,500, 1,68,475, 975, 970. So 15,000 plus 10,000 plus 5,600 equal 30,600 plus 2,92,875, 3,23,475, 23,475 minus 975, 3,22,500, sir. Yes, correct answer. 3,22,500. So net profit as per financial records. So this is the non-integrated accounting system, sir. Okay. Right. Production budget completed, sir. Next, raw material consumption budget in quantity. Raw material consumption budget in quantity. Raw material consumption budget in quantity. So raw material consumption equal to production in quantity into raw material required per unit. So raw material consumption budget Q1, Q2, Q3, Q4 total particulars. A. Production in units. Production in units. 31,500. Next to 38,250. Next to 42,000. 42,000. Next to 48,250. 48,250. 31,500 plus 38,250. 42,000. 48,250. So 1,60,000. Next B. Raw material required per unit. Raw material required per unit. So here 1 unit required quantity of raw material equal to 1 unit required quantity of raw material equal to 2 Ks. 1 unit required quantity of raw material equal to 2 Ks. 1 unit required quantity of raw material equal to 2 Ks. So 2 Ks. In any quarter, usage is uniform. So 1 unit required quantity of raw material 2 Ks. 2 Ks. Next, raw material consumption in quantity. A into B, 31,500 into 2, 63,000 kgs. 38,250 into 2 kgs, 76,500 kgs. 42,000 into 2, 84,000 kgs. Next, 48,250 into 2, 96,500 kgs. Next, 16,000 into 2 is equal to 32,000. 1,60,000 into 2 is equal to 3,20,000 kgs. 3,20,000 kgs. Now, second bit complete, sir. Third bit, raw material purchase budget in quantity and value. So, total purchase quantity, total annual requirement in quantity, sir. First of all, we have to calculate total annual requirement of raw material. So, third bit, calculation of total annual requirement of raw material. Total annual requirement of raw material. Total annual requirement of raw material. So, how to calculate annual requirement? In reverse mode direction, annual consumption of raw material. In reverse mode direction, closing should be added, opening should be deducted. So, annual consumption of raw material. Annual consumption of raw material. Annual consumption of raw material equal to 3,20,000 kgs. Then adjust the inventory levels. Closing should be added, opening should be deducted. Cost of closing inventory of raw material. Closing inventory of raw material. Here, closing inventory of raw material directly given in the problem. Closing inventory of raw material. The opening stock of raw material at the beginning of the year 10,000 kgs. Closing stock at the end of the year is required to be maintained 5,000 kgs. 5,000 kgs. Less cost of, quantity of opening inventory of raw material. Quantity of opening inventory of raw material. Opening inventory of raw material is equal to 10,000 kgs. 10,000 kgs. $3,20,000 plus 5,000 minus 10,000. 3,15,000 kgs. That is annual purchase quantity of raw material. Annual purchase quantity of raw material. So, ready? So, budgeted purchase quantity of raw material per annum equal to 3,15,000 kgs. So, here clearly mentioned, the company proposes to purchase the entire annual requirement of raw materials in the first 3 quarters. Total requirement will buy in first 3 quarters. So, here total requirement already calculated, sir, 3,15,000 kgs. So in first quarter, 30% of 3,15,000. So purchase quantity equal to 94,500, sir. Next, second quarter, 50% of 3,15,000. 3,15,000 into 50%. 1,57,500. Next, 20% of 3,15,000. 3,15,000 into 20%. 63,000. So totally 3,15,000. So in quarter one, unit price of raw material 2 rupees. In quarter two, unit price of raw material 3 rupees. In quarter three, unit price of raw material 4 rupees. So this is the purchase quantity. Next, value. Value equal to quantity into price. 94,500 into 2. 1,89,000. 1,57,500 into 3 rupees. 4,72,500. Next, 63,000 into 4 rupees. 2,52,000. 2,52,000. 4,72,500. 1,89,000. 9,13,500. Okay. So correct answer 9,13,500. Total 3,15,000. Okay. Next to stores ledger. Stores ledger cut of the raw material using first in first out method. So stores ledger, sir. Receipts, issues, balance. Q1. Q1 opening. Here opening, sir. Opening quantity, opening stock of raw material quantity 10,000 KS. 10,000 KS. Okay. 10,000 KS. Here opening stock of raw material is in the beginning of the year 20,000 rupees. So 10,000 KS, 20,000 rupees. That means 2 rupees per kg. Am I right? So 10,000 KS, 2 rupees, 20,000. Next. Next. Q1 receipt, sir. Q1 purchase 94,500 KS. 94,500 KS. Rate 2 rupees. So 94,500 into 2. 1,89,000. So balance 10,000, 2 rupees, 20,000, 94,500, 2 rupees, 1,89,000. Okay. Next. In Q1 consumption, raw material consumption 63,000 KS. So 10,000, 2 rupees 20,000. So total consumption 63,000 kgs. Already 10,000 kgs issued, sir. 53, 2 rupees equal to 1,06,000. So balance, sir, 94,500 minus 53,000, 41,500, 2 rupees, 83,000, 83,000. Q1 completed, sir. Q2 opening balance 41,500, 2 rupees, 83,000. Next purchase quantity 1,57,500, 1,57,500, 3 rupees, 4,72,500, 4,72,500. Next balance 41,500 to 83,000. Next 1,57,500, 3, 4,72,500. Next consumed quantity 76,500, sir. 76,500. So 41,500 to 83,000. So here request total consumption 76,500. 76,500 minus 35,000. 35,000 into 2. 3. 35,000 into 3. 1,05,000. 1,05,000. So 1,57,500 minus 35,000 equal to 1,22,500, 3 rupees. 3,67,500. Q2 completed, sir. Q2 completed. Q3. 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 Balance 1,22,500, 3 rupees, 3,67,500. Purchase quantity 63,000. Rate per unit 4 rupees. 63,000 into 4. 2,52,000. 2,52,000. 1,22,500. 3. 3,67,500. 63,000. 4. 2,52,000. Okay. Now issue 84,000 issue, sir. So 84,000 issue. 84,000 into 3. 84,000 into 3. 2,52,000. So 1,22,500 minus 84,000. 38,500. 38,500. 3 rupees. 1,15,500. 1,15,500. 63,000 or 2,52,000. Okay, right. Next, Q4, 38,500, 3, 1,15,500, 63,000, 4, 2,52,000. Right. Here no purchase, sir, in Q4, only issue, only consumption, 96,500. 96,500. 38,500, 3, 1,15,000. So here total issue 96,500. 96,500 minus 38,500 already issued, sir. Balance 58,000. 58,000. 58,000. 4 rupees. 2,32,000. Now balance 63 minus 58, 5,000 for 20,000, sir. So please check the answer. So here Q3 consumed quantity 2,52,000. Okay. So here answers are not provided, sir. So final answer 5,000 into 4. So here closing inventory 5,000, sir. So 5,000 KS at the rate of 4 rupees 20 rupees. So this is the fourth bit, sir. So this is the budgetary control. Next, contract costing, sir. So in contract costing, it is similar to job costing, but job is larger than job costing. That means more than 12 months period. Examples: construction of bridges, construction of roads, construction of dams, etc. So here two parties are there: contractor, contractee. Who undertakes the work, he is called contractor. Who assign the work is called contractee. So in the examination, question is asking prepare contract account in books of contractor. So books of contractor. Contract account. So the main objective for this account to know the profit or loss on this contract. So whatever expenses incurred simply debited to contract account. Whatever expenses incurred regarding this contract simply debited to contract account. So generally to raw materials, wages, direct expenses, direct expenses. Next to other expenses, that means depreciation on plant, depreciation on plant. By returns, raw material return to stores, raw material return to supplier, that is the returns. Next, by balances, balances. So raw material at site, raw material at site. Plant at site no need, sir, because here directly depreciation plant charged to the contract account. In that case, no need to disclose the opening value of plant and closing value of plant. So simply raw material at site, that's all. Now Now, by cost of work in progress. So this is incomplete contract, sir. So here time period more than 12 months, sir. Contract costing meaning it is similar to job costing, but job is larger than job costing. That means more than 12 months. So in first 12 months, it is not completed, sir. So definitely that is called work in progress. So cost of work in progress, cost of work in progress, cost of work in progress carried on, or cost of contract till the date, cost of contract till the date, or cost to the date, or cost to the date. 2. Cost of work in progress brought down. Cost of work in progress brought down. It includes two elements. One is cost of work certified, cost of work uncertified. So compare with the value of work in progress. Value of work in progress. In this segment, it includes two elements. Value of work certified, cost of work uncertified. So uncertified always mentioned in cost. So cost of work uncertified. Now compare these two. Sometimes notional profit, sometimes notional loss. That is transferred to costing P&L account. Suppose if credit side is more than the debit side, that is calling as notional profit. Notional profit carried on. Notional profit carried on. See the first problem. CRT 1. Contract account. Debit to credit. So the following expenses were incurred on a contract. Material purchase, whatever expenses incurred relating to this contract, simply debited to contract account. To material purchase. To material purchase. To material purchase 6 lakhs. To material purchase 6 lakhs. Next, material drawn from stores. So that means some part directly purchased and issued to site. Some part drawn from stores and issued to site. So raw material drawn from stores. Drawn from stores. Equal to 1 lakh. Next, to wages 2 lakhs 25,000. 2 lakhs 25,000. Next, to plant issued 75,000, sir. To plant issued 75,000. Here clearly mentioned plant information, sir, where it is given. It is estimated that the value of plant as on 31st March 2021, 30,000. At the time of introduce 75,000. At the end of the period 30,000. So the difference is calling as depreciation plant 45,000. So depreciation on plant 45,000. Depreciation plan 45,000. Next, to chargeable expenses. To chargeable expenses. 75,000. Next, apportionment of indirect expenses relating to this contract. To apportionment of indirect expenses. Apportionment of indirect expenses is equal to 25,000. Next, the contract was 20 lakhs and it commenced on April 1st, 2020. Happy. So here, date of commencement of contract 1st April 2020. Books closing, sir, 31st March. 31st March. Okay. Next, the value of the work completed and certified up to 20th February 2021. So, here engineer certified value of contract on February 28th, sir, 13 lakhs. 13 lakhs. So, therefore, from March 1st to March 31st, cost is calling as cost of work uncertified, sir. Okay. So, the value of work completed and certified up to 20th February 2021, 13 lakhs, of which 10 lakhs 40,000 was received in cash. Remaining retention money, sir. So, retention money will be paid at the end of the project. Next, the value of work completed subsequent to the architect certificate, but before 31st March, that is the cost of work uncertified, 60,000. Okay, 60,000. They were also lying on the site materials value 40,000, sir. Right. By returns. Raw material return to stores nil, raw material return to supplier nil, sir. By balances at site. By balances at site. Raw material at site. Raw material at site. So, raw material at site, they were also lying on the site materials value 40,000 rupees. 40,000. Now, 7 lakhs plus 2 lakhs 25,000 plus 45,000 plus 75,000 plus 25,000 is equal to 10 lakh 70,000. 10 lakh 70,000 minus 40,000 is equal to 10 lakhs 30,000 by cost of work in progress carried on. Next, to cost of work in progress brought down. Sir, it includes two elements, sir. One is cost of work certified, cost of work uncertified. Sir, here cost of work uncertified, sir. Cost of work uncertified 60,000, sir. So, remaining balance is calling as cost of work certified. So, 10 lakhs 30 minus 60,000 is equal 9,70,000. 9,70,000 by value of work in progress. Value of work certified. Here value of work certified 13 lakhs. Cost of work uncertified 60,000. So 13 lakhs plus 60,000. 13 lakhs 60,000 minus 9,70,000 minus 60,000 is equal 3,30,000 to notional profit carried on. Notional profit carried on. Notional profit carried on. Check the answer. Yes, correct. You are required to compute the value of work certified, cost of work not certified, and notional profit of the contract. Okay, so complete a notional profit. So this is the contract account. Sometimes question is asking contractee account. Contractee account. Contractee account. Debit to credit. So 2021 by cash account to contract account. So 10,40,000. 10,40,000. 10,40,000. 10,40,000. To balance carried on 10,40,000. So this is the contract account. Okay. Right.